It's indicating a positive start, a strong start, a gap-up start for the Indian market. 152 points uptick is what the Nifty implied open is indicating. Now, all these overnight cues that we have coming in, how is that going to be impacting in terms of important cues for the Indian market? We have a team of research joining us right now to set you up for trade, tell you which are the important stocks to watch out for in the trading session as well. First up, let's go across to Hormaz, who's here to tell us the important cues that he's picking up this morning. Good morning, Hormaz, and welcome back.
Good morning, Vinny. And yes, indeed, the broad premise of the market has been that they have not gone anywhere over the last 2 weeks, and they've been stuck in this range of around 25,500 to 26,000. And even in the last week, despite gaining for 4 out of the last 5 sessions, the index only gained 100 points on a week-to-date basis. But beneath the surface, there is a lot of activity that has been taking place. Last week's high, of course, 25,885. We need to keep an eye out on that. And of course, Thursday's low, which was that panic selling low of 25,388. That is the broad range in which the index has been all through last week. Incidentally, both of these levels were struck on Thursday. But the index to watch today is going to be the Nifty Bank, and there are multiple reasons as to why is that so. Of course, 3 important names that are constituents of this index will be determinants of where the index moves. IDFC First Bank is one of them, AU Small Finance Bank being the other, and of course Axis Bank is one more stock that you need to keep an eye out for today. The other reason is the fact that PSU banks have been driving the Nifty Bank higher. The index was up 5.5% last week. Most of the lenders, be it Canada, PNB, all of them gaining between 6 to 9%. So it'll be interesting to see if there is any follow-up attempt or follow-up buying seen in these PSU banks. The other reason being the fact that unlike the Nifty, there were 2 attempts made by the Nifty Bank to test its record high levels of 61,764. That is the important level. Last week's high was 61,678. So they came close to that. And last week's low of 6,500 is going to be the downside support that you need to watch out for on the Nifty Bank. It's another important week ahead for the IT names as well. A slew of downgrades have come in from Jefferies this morning. We'll talk more about that later on in the show. Why it's also important is because both Nvidia and Salesforce will be reporting results this week, so it keeps the IT stocks in the spotlight. It's an important week otherwise as well. It's the monthly expiry tomorrow for the Nifty contracts, for the Sensex contracts on Thursday. Keep an eye out on all the geopolitical developments, the tariff related issues, the Iran related issues, oil prices impacted as a result of that. So all of this, there's a lot to track in the week ahead. But for now, the GIFT Nifty is indicating a gap up. The question is, will that sustain?
Okay, will that sustain is the key question. Thanks so much for that, Hormaz. But let's move on and now talk about some of the important stocks that you should be keeping on your radar this morning. We have Ria to give us that list. Good morning, Ria.
Well, good morning. Let's start off with UPL first. They are going to be consolidating their Indian and global crop protection businesses, and this will then be demerged from the existing listed entity and then listed separately on the Indian exchanges. So that is one to watch out for. All cargo terminals will also be in focus. For the month of January, the total volumes have increased by 8% on a year-on-year basis, although sequentially they have declined by around 5%. Axis Bank as well as Credit Axis Grameen will also be in focus. Axis Bank has said that they have no intention to submit a bid for a stake in Credit Access. Keep an eye on IDFC First Bank as well. They have disclosed a fraud roughly worth 590 crores at the Chandigarh branch involving government accounts. Moving on to RailTel as well as Ashoka Buildcon, the consortium has won an order worth roughly 1,136 crores for a period of 5 years. Narayana Hrudayala has acquired a 3.3-acre land parcel along with buildings in Electronic City to set up GCCs and to expand the existing business. WeWork as well has inked a deal to expand its leased capacity in Bangalore. They will be adding roughly 3,100 desks by September with an investment of roughly 42 crores. And lastly, also keep an eye on export-oriented stocks. Textile names, the likes of Gokuldas, exports, auto components as well as shrimp stocks as well will be in focus as the new US tariff rates come into effect.
Okay, yes, we'll surely keep an eye out on that. Ria, thanks so much for that. But let's move on. And in the final leg of update, we have Sudarshan joining us to tell us what's going to be happening in the world of FNO. Good morning, Sudarshan. A very exciting weekend. We're waiting for an exciting week as well now.
Good morning, Vinny. So tariff uncertainty is back, and there is another news that's floating, and that will be in the focus is the talks between the US and Iran. That will also keep the market in the check, or the direction will come from those talks also. As far as the Friday session is concerned, market did preempt this US Supreme Court decision of striking down Trump's decision on the tariff front, and that's the reason we saw Nifty holding on to the gains of more than 100 points, and it's back to around the levels of 25,600. Now the data has improved, and it's a significant improvement if you take a look at the both call options data as well as the put options. Call options, what happened? We have seen a huge short covering. What it means that call writers, the positions they had taken earlier, because of the up move that we have seen in the market, they had to unwind their positions. And put writers, where we have seen the significant fall in the premium. That's the reason major put writing and has led to an increase the Nifty put call ratio to 0.97 from the earlier level of 0.71. Even if you come to the FI flows front also, we have seen buying in majority of the segments. You take a look at index futures, buying was more than 690 crore. In the stock futures also, more than 5,000 crore. Bank Nifty options, Bank Nifty futures, everywhere there was buying, and that has led to FIs adding long positions of more than 8,000 contracts. They did add short positions, but if you compare, the short addition is much lesser than long's position. That's the reason long's exposure has increased to 25%, while short exposure has fallen further to 75% from the earlier week level of around 82 to 83%. Now to the options data, 25,500 and 25,400 put options have seen maximum put writing, and those two put options had the maximum fall in the premium, while on the call side, most of the call options from the range of 25,400 to 26,000 have seen a fall in the open interest, but premium has seen a significant rise. So support for Nifty, 25,400 will be very important support. It's very unlikely that Nifty is going to fall below this level in immediate term unless something major news comes. But support 25,324, resistance 25,740. As far as the stocks in the bank are concerned, two stocks remain in the bank, SAIL and Saman Capital. Keep an eye on all the IT stocks, especially Persistent. Some news can be expected over the next few days, but Jefferies has come out with a note downgrading majority of the names, and also Tube Investments, after earnings, the stock had seen a major fall, but over the last few trading sessions, there has been a significant rise in this stock, so keep an eye on this too.
Okay, thank you so much for that, Sudarshan. But on that note, we're going to slip into a very short break. After the break, we'll get you updates with regards to Trump's tariff and what's next for the global trade. Welcome back to Power Breakfast on CNBC TV 18. Now talking about the latest update that have come in. U.S. Supreme Court on Friday struck down global tariffs imposed by the U.S. President Donald Trump. 6 out of the 9 Supreme Court judges, including Chief Justice Roberts, voted to scrap the tariffs. The court ruled U.S. International Economic Power Act, an emergency law from 1970, does not authorize the president to impose tariffs on other nations. The power is only vested with U.S. Congress. Then moving on, President Trump lashed out at the Supreme Court, calling the 6 judges who ruled against the tariff as a disgrace to the nation. And Trump, after initially announcing a 10% global tariff post the Supreme Court decision, raised the global tariff to 15% on Saturday, calling the Supreme Court decision ridiculous, poorly written, and extraordinary anti-American decision. Moving on, let's also listen into some of the experts on what they had to say in terms of the tariff ruling and the implications for the global markets.
It is, but let me first say that although I think Supreme Court made the right decision, EFA does not authorize the president. I think it's unforgivable that the Supreme Court took 9 months to make a decision, and part of the problem now with all this collected, how we're going to get a refund, and did not specify. I mean, I paid higher prices. Why shouldn't I get the refund? Some of the importers got concessions from the countries, the exporters, so they shouldn't get the full refund. That could be a huge political issue, hundreds of billions of dollars. So, I mean, it left a lot of uncertainty on this.
I think at this point, I think the trade war is over, actually, effectively over, actually, because as you know, the 15% is only good for 150 days. So I think from that point of view, I think Trump really has lost all his leverage, I think, in this trade war. I think, as you've heard from all the global leaders, I think it's very clear what's going on here. Yeah, he could go after, countries based on investigations of unfair trade practices, but that's a very, very lengthy process. And one thing that we know about Trump is that patience is not one of his virtues. So I think from that point of view, the whole sort of the leverage that he's had on the whole global community through trade, I would say that has been hugely weakened. And I think, in fact, I would argue that he's also weakened politically at home.
We think actually his place today a little bit better than it was a couple days ago, pre this announcement. But one of the amazing ironies to us at Wells Fargo, Sherry, is when you think about volatility globally, it is incredibly low. It's relatively low in equities, it's very low in FX, it's low in interest rates. And you have this environment where geopolitical shocks seem to happen every other week, and yet markets are shrugging a lot of it off. They're saying, well, okay, but when we look at interest rates, we look at currency pair differentials, they don't move all that much. So options markets and realized volatility are super low. So is that a good environment for EM? Traditionally, yes. Usually it does best when volatility is low. So I think potentially over the next few months it is a positive.
And following the U.S. decision on Trump tariffs, President Trump in a media conference confirmed that the deal with other countries, including India, stand as is. Listen in to what he had to say on the India-U.S. deal.
The India deal is on here.
Mr. President. Thank you so much, Mr. President.
All the deals are on it. We're just going to do it a different way.
The framework which is to be signed with India sometime soon, will that stand now?
Yeah,
and on the decision,
changes.
Nothing changes?
No, nothing changes. They'll be paying tariffs, and we will not be paying tariffs. Our deal with India is they pay tariffs. This is a reversal from what it used to be, as you know. India, and I think Prime Minister Modi is a great gentleman, a great man, actually. But he was much smarter than the people that he was against in terms of the United States. He was ripping us off in India. So we made a deal with India, and it's a fair deal now. And we are not paying tariffs to them, and they are paying tariffs. We did a little flip.
Okay, now let's move on. And Abhimanyu is joining us right now to give us an update in terms of the India-US talks, which are postponed. What's the latest update here? Abhimanyu, over to you.
A very good morning to you too. And all U.S. trade agreements now continue to be in question despite the recent statements made by President Trump, because India has also cancelled the trip of its negotiators to the United States, who was slated to meet the U.S. negotiating team today. Now the visit has been postponed, and Commerce Ministry sources have indicated that the meeting will be rescheduled at a mutually convenient date. And both the sides are of the view for now that the proposed visit will be rescheduled when both the sides have the time to evaluate the latest developments and their implications. So all U.S. trade agreements continue to be in question, even as there have been announcements made by the U.S. administration post the Supreme Court order, which had overturned the tariffs which were initially imposed. Now, not just India, but other countries and geographies may also be re-evaluating their position with respect to a trade deal with the U.S. And last evening, the EU had also issued a statement. The European Commission had sought full clarity on the steps the U.S. intends to take following the recent Supreme Court order, and had sought a fair and predictable treatment for its companies and exporters when dealing with the United States. So clearly, the situation continues to be in a state of flux, even as there is a possibility of Section 301 investigations, which will be launched in the United States. And of course, there would be more developments which would be ensuing in the next few days, based on which any further tariff reduction or any further imposition of tariff would take place. So, of course, the situation continues to be in a state of flux, and all eyes, of course, would be how things are going to pan out in the United States.
Absolutely, Abhimanyu. Important updates, how things pan out over there. Thanks so much for that, Abhimanyu. But on that note, let's also go across and hear in some reactions from India Inc. to the tariff twist.
I think it stabilizes trade to a certain extent. But again, it's for 150 days. And you can count on Mr. Trump to be innovative, to find ways to increase his tariffs. See, the US needs the money, right? And they want to make sure that they protect US. So they will keep trying to find ways and work through some laws to try and increase these tariffs. So I think it's not fully certain. You will see volatility, you will see uncertainty, and the market should be prepared for the same.
Steel is not directly impacted, but I think many of our consumers are probably exporters to the US. So particularly the auto component industry, they're big exporters to the US. So let's wait and see how it plays out. What I understand is there's no negative impact. I think, it's within what was in some sense being structured or planned. I'm also interested to see what it means for Europe, because we also started steel export from Europe to the US, and I don't know if this 10% is applicable globally to European.
Standard 10% global tariffs. So
Because
EU, I think they had 18% with US.
EU,
it comes down to 10 now.
I mean, for the steel industry in EU, it was 50%. So I really don't know where the final number is, but obviously there will be some uncertainty, because President Trump has also said he wants to use other means to bring back some of the tariffs. So we'll wait and see.
Well, what's quite certain is that there's more uncertainty around tariffs. 150 days is not enough for you to plan supply chains and adequately. So it does present another set of uncertainties, though we know the parameters and the boundaries within which we are operating. For us as a company, we have an installation and a manufacturing facility in the United States. So the issue comes down to how do you transfer price between our Indian operations as well as the US operations. But having said that, the US market is a very, very large market. As a near $30 trillion economy, it is very important for India to not only preserve its market share in the United States, but to grow it.
Now, with the tariffs cancelled, the Trump administration may have to refund the amount collected so far. Now, according to the estimates by Penn Watson, a budget model, over $175 billion collected in US tariffs are subject to potential refunds after Supreme Court decision. However, the court ruling did not mention how the United States government would initiate the refunds. Currently, more than 1,000 lawsuits have been filed by importers in the US trade court seeking refunds. US Supreme Court Justice Brett, in his dissent to the verdict, also said and warned that issuing refunds would present practical challenges. He said, and I quote, US may be required to refund billions of dollars to importers who paid IEEPA tariffs, even though some importers may have already passed on costs to the consumers or others. As was acknowledged at an oral argument as well, the refund process is likely to be a mess, end of quote. Now, moving on, and in the US markets, what actually happened? That Wall Street ended Friday's trading session higher following that Supreme Court decision on tariffs, potentially providing relief for companies burdened by higher costs from the duties, as well as easing concerns about sticky inflation still plaguing the US economy. So that was the update there. Dow, Nasdaq, S&P 500, most of them closed in the green. Now, on that note, we're going to slip into a very short break. After the break, we'll come back with cues in the world of commodities. Stay tuned. Thanks for staying tuned into Power Breakfast on CNBC TV 18. Now let's get the latest update in the world of commodities. What's happening there after the uncertainty that we've seen in terms of tariffs? Manisha Gupta is joining in with us as always. Good morning, Manisha.
Morning, Vinny, and thank you for that. Well, we're looking at very strong gains coming in for the precious metal prices. If you look at gold, it's trading at a 3-week high above $5,100 an ounce. There is a risk aversion, and that's helping many of these precious metals. Well, the U.S. president announcing plans to raise global tariffs from 10 to 15% for the next 150 days under Section 122. This is what is bothering the global markets right now. And in addition to that, you have the U.S. and Iran fears as well, while the negotiations will resume in Geneva on Thursday. But in the meanwhile, both the countries really seem to be building up their military presence on ground, and that is keeping the prices higher. Silver is up 5% in the Asian markets right now. It's trading about $87 an ounce. The U.S. fourth quarter GDP numbers coming in much lower quarter-on-quarter basis also has been supportive. And then you have the crude oil prices, slight profit taking onto this one today.
Okay, thank you so much for that, Manisha. But with that, we're absolutely out of time on this edition of Power Breakfast on CNBC TV 18, with the Nifty implied open indicating a gap up start for the Indian market. Stay tuned in. Up next, your Pasar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, good morning.
Hi, good morning. And tariffs are back in the headlines.
That's right. I'm smarting a little bit from last night's loss. Team India going down to South Africa, but we've got an interesting week coming up for the markets, and hopefully our boys come up on top against the Windies
down,
as well
not
as
out, right?
That's correct, but the margin of loss was too high. That means we need to beat the Windies as well as Zimbabwe by a greater margin to get our run rate intact. But I think we need to track the run rate of the markets, and things should look pretty much better, I guess.
Pulse of the market, right?
Yeah, pulse.
Great pulse. Well, let's just take it from the top then in terms of what we need to know. This is, of course, starting a new week, and tariffs are, as Rima said, back in the mix of it. Now, I'll just kind of sort of run through just the sequence of events. The US Supreme Court, of course, threw out the IEEPA tariffs. But as was expected, this was widely expected from the market. So the US market reaction was next to nothing at all. Very, very contained. Trump, as expected, announced 10% global tariffs and then later raised those tariffs to 15%. So now, as things stand right now, the global tariffs are 15%. These 15% have come through. These 15% tariff has come through True Social post. There will be an executive order which will come, and that should come today, tomorrow. We'll wait for it. The reason we'll wait for it is not because the 15% will be there or not. The 15% will be there, but will there be exemptions in that executive order? For example, in the case of India, if tariffs are 15%, electronic exports are exempted. Will most likely, I think these exports will be exempted, and I think those exemptions, etc., should be part of the executive order or perhaps in another document. Now, these 15% tariffs this is under a section called 122 will remain in place till late July. This is basically, you can impose these for 150 days, and then they can extend it with congressional approval for another 150 days. And by the way, there is lots of chatter that this itself may be a little, this may be borderline illegal, and this I think is being challenged in courts. And I think the basic crux of the issue is Section 122 allows US to impose tariffs if there is a balance of payment deficit, not a trade deficit. I mean, US does not have a balance of payment deficit. The world is going and investing and committing investments into the US. It's got a trade deficit. So on that question, there may be legal challenges, and many are pointing that out, but the reason why I'm not putting too much emphasis on that and seeing that as a relief is because it will take time. I mean, it's not going to happen quickly. This took, 6-7 months. So even if there are challenges to this Section 122, by the time it works its way through the courts, I think it will take time. Now, so that's till late July, 15%, right? Now, after late July, there could be longer lasting, potentially higher tariffs, because that then will require Section 301. Under Section 301, the Trump administration has already indicated they will use this section. And this basically requires investigation. So, the USTR, the US Trade Representative's Office, will have to order investigations into X industry in X country, Y industry in Y country. That's cumbersome. It takes time. But I'm assuming, and I think as the president himself said, these investigations will kick off immediately, and they will find a way to find results of these investigations by late July, when these with these tariffs, the 122 15% tariffs start to come to an end. How long will this take? I mean, just to go back to history, when 301 was used against China in 2018, it took 6 months for the results to come out. So it's possible. I mean, if you just go by that, it's possible that you stay at 15% for 5 months anyway, maybe a little longer. And then once the results of these investigations come up, you basically will roll over to these new tariffs, which perhaps could be higher as well. Now, expect India's tariffs to be around 15% or rise to around 18%. And I've said this when it came out on Friday evening as well, that don't expect very much by way of change. This is about this country and that country, but this is also about a dollar revenue which the US wants to collect to counter it. And these are substantial. So, for most countries, I mean, there may be a bit of lead and lag. For example, if somebody was at 0%, now they've gone to 15%. Now they'll have to be given exemption. Somebody is at 25%, they've gone to 15%. So there will be advantage. Like, for example, Malaysia is charged at 19% now they're 15%, which means there's an advantage. But that advantage or disadvantage will not last very long is the point I'm making. They will recalibrate these tariffs using 301, Section 301, to get tariffs to where they were before the US Supreme Court ruling. So that's a short point that I wanted to make. Now, just a quick look at what we heard from the US trade representative, etc. Now, by the way, the trade deal will have to be reworked because the basis of the trade deal was the IEEPA tariffs, and that is gone. And I think we are hearing it from the Indian side and others as well. This is what the US trade representative said. He said US plans to stand by its trade deals and expects its partners to do the same. Besant said that they don't expect tariff revenue to be very different from what they assumed in 2026. So this also gives you a sense of the fact that they will recalibrate all of this. Trump, by the way, we will hear from President Trump on video tomorrow, and it will be Wednesday early morning for us, I think, the State of the Union address. And I think he's, of course, going to lash out against the US Supreme Court justices, etc. There is the US-Iran bid as well. On Friday, going into the weekend, it was looking like perhaps there would be escalation. Talks are set to resume in Geneva on Thursday, so we'll see how this goes. In terms of market reaction, as I said, immediately on Friday, Wall Street reaction wasn't very much. Dollar is down this morning. The dollar index is down about, I think, 1/3% or so to 97.44. So that is meaningful. Gold futures are at about 5,100. Silver has come off sharply to about $86, $87 or so. So that's essentially some signaling as we start out our session. Now, the Nifty levels, we are within, despite Friday's bump, we are within a downward sloping short-term channel. We closed exactly at the midpoint of that downward sloping channel, which is 25,570. The support, the lower end of the channel is 25,270, which is the support, and the upper end of that channel is 25,840. So 25,300, 25,800. That's basically the upper end and the lower end of the channel, and we are right in between. GIFT Nifty will give you a sense of how we likely to start, and then we will take it from there. I think it's about 180 odd points higher at this point. I think we will get in the F&O stats in just a bit, but I think the IDFC First Bank management call is underway right now, so why don't we cut to it for 2 minutes?
Then we thought to ourselves that we should take this investor call right now and explain to you what the implication is. So this is broadly the subject of it. And before we come to the financial implication, I must just say that this is a specific isolated incident that happened in one branch with one client group, which is the group that has been named out there by us. And therefore, we will, this is basically a case where debit instructions have come supposedly from the client, which our people, which clearly to us indicates a fraudulent activity, have passed the entries and have transferred the money to certain parties outside the bank from the client's account. Now they've also used checks. When in hindsight looks forced, but someone has cleared it. So this looks to us, on the basis of the work we've done, clearly a case of an employee fraud. And it also, our internal fingerprints and our details are quite clear that external parties are also involved here. So this is a serious matter for us. We have run this bank now for 10 years. And we have never seen an instance like this of this order of magnitude. Certainly not. The bank has really excellent controls across the system. As you know, we are a very technology ahead bank or a technology first bank, and on all fronts like Mule and AML, etc., bank is doing very well in terms of overall numbers and controls and so on. But this is not a digital transaction. This is a physical transaction where people have come, the checks have been forged. This is the oldest kind of fraud probably known to banking. So how this has happened is obviously happened with the connivance of employees. There is maker, checker, authorizer, the whole system exists, but obviously there's some, bunch of people have come together to make it happen. So we will get to the bottom of this. We will spare no one, and we have quickly moved in. We have appointed a forensic auditor for this, KPMG.
Okay, we will get to the bottom of it. That's the message from IDFC First Bank management after that fraud which they revealed. As I said, let's go back to the markets and the F&O positioning, the stats. How do they look? Nigel has walked across the wall. Nigel, over to you.
Well, given that the GIFT Nifty is suggesting that we're going to see a big gap up, by the end of today, actually, you'll want to see that sort of a gap up sustaining and maybe build on from there as well. That's going to be rather important. Remember, we get into expiry tomorrow. So the bulls actually will be latching onto these gains. In terms of flows, the DI is net bought on Friday, while the FI is net sold. You put the institutional number together, the net buy number was close to around 1,600 crores. You like that. The FI as well, they seem to have sensed that there was a risk to their aggressive defensive stance. Let me explain. They added close to around 8,000 long contracts for a close to around 3,000 short contracts. And in percentage terms, the FI short positioning added around 75%. That's the lowest that we've seen in the last 4 months or so. Looking at the stock futures, well, they added longs and they covered some shorts as well. So that's why I'm saying that they were very, very defensive and appears to have sensed something is in the offing. They also went ahead and they wrote puts very, very aggressively in Friday's trading session. So put everything together, they added more longs, both on index futures as well as stock futures, and they wrote puts very, very aggressively. So they seem to be coming off a little bit on that defensive stance. The PCR has moved back to around 1. Remember, in Friday's trading session, it had gone a little sub 0.7 as well. And from there, it's popped back up. Because the calls that were written earlier, they started getting unwound very, very aggressively. Case in point being the 25,800 call, 25,600 call as well. Massive unwinding is what we saw at them. And there is writing being seen at around this 25,500 put, which coincides with the support level. Remember, last week, we had, the lows were close to around 25,373. That becomes a reference point on the downside. And the 200 EMA as well is in that vicinity. So that's where the support zone is at. But resistance, 26,000, the bears will want to defend that. Remember, the last few trading sessions, multiple times, the bulls have taken the market to around 25,900, and then we have seen a bit of a come off that. So the 26,000 mark remains an extremely crucial resistance mark. Now, since economic activity is reportedly picking up on the domestic front, earnings are expected to look up, and it appears that peak Trump tariffs seem to be behind. Throw in there as well, the currency volatility has cooled off. The rupee has strengthened a little bit as well. So the broader markets now need to catch up and need to outperform from here on. My sense is that the small cap index as well as the mid cap index could actually outperform from here on. Putting everything together with regard to domestic activity, the sentiment seems to be turning as well, and they've been ranked underperformers. So let's see how that goes. I think in the next 3 to 6 months, we'll know.
Thank you very much for that. But back to tariff talk. And following the U.S. decision on Trump tariffs, President Trump in a media conference confirmed the deals with other countries, including India, stand as is. Listen into what he had to say on the India-U.S. trade deal.
The India deal is on here.
Mr. President.
Thank you so much, Mr. President. All the deals are on it. We're just going to do it a different way.
The framework which is to be signed with India sometime soon, will that stand now? And on the decision,
changes.
Nothing changes?
No, nothing changes. They'll be paying tariffs, and we will not be paying tariffs. Our deal with India is they pay tariffs. This is a reversal from what it used to be, as you know. India, and I think Prime Minister Modi is a great gentleman, a great man, actually. But he was much smarter than the people that he was against in terms of the United States. He was ripping us off in India. So we made a deal with India, and it's a fair deal now. And we are not paying tariffs to them, and they are paying tariffs. We did a little flip.
All right, let's get in some opinion as well. Venugopal Gare of Bernstein says, for countries which have signed the framework for an agreement like India, this puts further negotiations in a state of limbo. For India, he says, the foundation for 18% tariffs is now deemed illegal, and it effectively qualifies for a 15% rate plus 3.5% most favored nation rate tariffs, which are but much higher for specific sectors where the MFN most favored nations rates were in single digits or more. He says, as per their understanding, these tariffs stack on top of the most favored nation tariffs that were in existence before Trump took office for the second term. And hence, he says, for sectors like textiles and finished jewelry, they would end up seeing higher tariffs than they would have had under the trade deal. Hence, he says, this is a negative development instead of a positive one. That's one opinion coming in. Let's also find out from Taimur Beg, Managing Director and Chief Economist at DBS Group Research, on the show now. Taimur, thank you very much for joining in. For now, the GIFT Nifty is suggesting some relief, 180 points higher, but there will be uncertainty as markets navigate the alternate replacement, the new replacement tariffs and the legal uncertainty. But for India in particular, are we better off, worse off than 72 hours ago, and will we have more leverage in further negotiations?
My initial conclusion to this matter is a firm yes. I think that U.S. Supreme Court has drawn a line, which is that you cannot pursue diplomacy with tariffs, and countries that will negotiate with the U.S. would find that the U.S. court system or the process that the Trump administration would have to go through to impose tariff willy-nilly has been constrained substantially. I fully concur with the earlier analysis that was shown on the screen that if indeed there is a 15% across the board tariff and stacked on top of MFN, it would create some complications. But I think countries will find it incumbent on themselves to go back to the Trump administration and say that you probably did not want an across-the-board tariff. You had certain sectoral preferences. That's why you wanted to do bilateral deals. So let's reopen the deals because the Supreme Court has changed the circumstances substantially. So I would say that countries around the world would look at the developments of the last 72 hours as a window to go back to the US, not necessarily just listen to whatever Donald Trump is saying, which is that, oh, the deals stay and nothing changes.
But effectively, by the end of it, the final end state tariff, Taimur, should be around 18%, right? I mean, after everything is said, there may be lead lag, some benefit for some time, some disadvantage for some time, but eventually they'll get around to getting to the number they wanted. I mean, through the 301, these investigations, etc., isn't it?
Right. So, Prashant, I mean, 301 and other things, with respect to pharma and semiconductor, that's like a whole different world that would have taken place independent of whatever happened in the last 72 hours. I think the position from the Indian side or any other country's side going to the US would be, surely you don't want us to be worse off from the deal that we had in place when we signed it with you 1 week, 1 month, 2 months ago. And so therefore, can we find a way to at least not do any further damage to the agreement that we had reached? Because right now, this 15% across the board would actually inflict damage.
Yeah. No, 100%. My only point was that this is, as many are saying, this is a big positive. I'm just saying that, well, it's not a positive, but it's not a negative. But it should be read as a big positive as well. That's all. That was the point that I was making. So finally, by late July, whatever, we will end up to where we were before the Supreme Court rulings, right? I mean, and under this administration, also the point of USTR doing investigations, etc., which takes time. I mean, they can hurry them up, right? This is not a usual administration.
Right. So I guess the only point is that the point that I meant earlier, which is that you can't really do diplomacy and tariffs conflated together over tweet anymore. That is the avenue that the Supreme Court decision has shut, in my view. You can do every single section that's out there. They have avenues for them to be challenged. There's a need for congressional approval after an initial period, 150 days in the case of this particular tariff. All of those would constrain Donald Trump's hands. So to me, I'm not necessarily saying this is a positive, as you correctly said. It's a temperamental administration. They would come up with different ways to harass countries, and Donald Trump would want to wield as much power as possible through tariffs as he can. But the sort of cavalier approach that we saw earlier, I think we have, to some large extent, put that behind us.
All right. Hi, Taimur. Good morning. Good to see you, Ben. Taimur, is it safe to say, from an India market perspective, a lot of, viewers today will be wanting to know, have we seen peak Trump tariffs behind us? It feels like he was in office for many, many years, actually, just around, a little more than a year. And we've got a few more to go. So have we seen peak Trump tariffs behind us? And what does it mean for the currency market? Because the dollar index has been very, very weak. And from an emerging market standpoint like India, that's a positive, actually. Do you expect the dollar to continue to weaken from here on? Or is it basing out now?
First of all, Nigel, really digging the jacket.
Thanks.
But, on the currency market implication and the peak tariff question, yes, I do think that the avenue for the U.S. to impose 30, 50, 60% tariff based on some geopolitical consideration, that is over. So yes, I do believe that we are on peak tariff territory. Sectoral tariff, depending on various investigations that's taking place, they could come up. Countries can then try to find legal avenues to push back against that. All of those things are on the table. The U.S. as a reliable partner with respect to trade and tariff, I don't think that is coming back any soon. But in terms of those willy-nilly approach to tariff diplomacy, that is behind us. FX markets, including as well as the rates markets, are in two minds about what to do with the recent developments. Because if you think about the tariff going away part of the dynamic. That would mean the less impetus for companies to pass on prices. That will lead to some degree of flattening of the curves. But at the same time, if there's less tariff revenue, that's worse for the fiscal. Therefore, the long end should go up, and therefore there should be a steepening dynamic. To put it all together, we basically saw 2 basis points movement in the market on Friday. Not much either way, because the markets themselves can't really make up their mind whether this is highly consequential or not. As far as the currency is concerned, well, now we have a new gambit open, which is based on balance of payments deficit. The U.S. will try to impose tariffs on countries, and the U.S. has a flexible exchange rate regime, so therefore, by definition, the balance of payments balance. There isn't any deficit, the spirit of which was the 1974 underpinning of the law. At that time, the U.S. had a fixed exchange rate regime. Very different world. So again, there would be questions about to what extent that section is also implementable or the U.S. government can pursue to its full extent. I think the currency market is also struggling with that issue, because if indeed the U.S. is making a very big argument that large balance of payment deficits, which itself is a questionable assertion, but if it is indeed the case, large balance of payment deficits are causing loss of resources and putting the U.S. dollar under a huge amount of downside pressure, well, then the market should say that if the U.S. can pursue some remedies under that, then the dollar should appreciate. But I really don't think it's that straightforward, that clear cut, and hence, again, the kind of listless, lackluster market. I think from a rates perspective, from a fiscal issuance perspective, the short dollar narrative still remains alive.
Nice. All right. And dollar is down. So thanks very much, Taimur, for joining us. It's a pleasure and good speaking with you here on CNBC TV 18. Thank you. Always. All right, let me just quickly run you through the interactions which are lined up here on the program. So at 8:35, we have the management of UPL to talk about the company's restructuring plans and more. 9:20, Sanjeev Prasad of Kotak Institutional Equities will be our market master of the day. 9:30, we bring you a discussion on the trade deal opportunities and ordeals and amid Trump's tariff setback. Following that, the management of CleanMax will be speaking with us at 9:45 on their IPO issue, which opens today. And towards the end of the program, Lata in conversation with investing veteran Vetri Subramanian, now CEO of UTI AMC and markets, and the uncertainty surrounding all these tariffs and what they mean for markets. Stay tuned.
Well, time to slip into a short break. We got a lot of stock-specific action to track for you today. We get to that in just a bit in our special Top 10 segment. We're looking at Axis Bank, UPL, RailTel, Ashoka Buildcon, Narayan Hrudayalaya, WeWork India, and exporters. They're going to be reacting possibly to the news flow, while you have Credit Access Grameen, IDFC First Bank, and AU Small Finance Bank that will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. Let's get to the stocks then. This is CNBC TV 18's list of top stocks for the day. And the big one will, of course, be IDFC First Bank. The conference call is underway. You can see the flashes there. But outside of that, Axis Bank and Credit Axis Grameen also will be on our radar. Gaurav is here to tell us why. Gaurav, hi, good morning.
Well, good morning. If you look at Axis Bank and Credit Axis Grameen, there were media reports which suggested that Credit Axis Grameen's promoter is looking to sell its stake, and Axis Bank was one of the names which appeared as a prominent buyer. Now, Axis Bank has clarified on this news. What they're saying is that bank has neither submitted or planning to submit any bid for Credit Axis Grameen. So that is what they have clarified. Remember, earlier around 66% stake is what Credit Axis Grameen's promoter have, and that is what they are trying to sell. And as per media reports, it was valued at around 14,000 crores. And recent media reports also suggest names like HDFC Bank who are evaluating this opportunity. But all in all, for now, Axis Bank has clarified that they are no longer looking, or rather they are not at all looking at Credit Axis Grameen or any acquisition in that company, which is a bit positive for Axis Bank because investors were a bit skeptical about this acquisition. So all in all, positive for Axis Bank, but at the same time, a bit negative for Credit Axis Grameen. Now that, if at all, they are going to sell its stake, one less buyer for them in the market.
Got it. All right, Gaurav, thanks a lot for that. Well, there was a bit of a buzz with regard to UPL announcing something, and that's precisely what happened post 3:30 p.m. on Friday. Ria's here to break it down for us. Morning, Ria.
Well, good morning, Nigel. For UPL, they have decided to demerge their crop protection businesses from the existing listed entity, and subsequently they will be consolidating the global and the Indian crop protection businesses into UPL Global Sustainable Agri Solutions, which will then be listed on the Indian stock exchanges. The share entitlement ratio for this will be 1:1, and the initial merger date will be April 1st, post which the transaction is expected to be completed within 12 to 15 months, and this is also expected to unlock shareholder value.
All right. Thanks very much, Ria, for that. That's UPL, and you'll hear from the management a little later on the program. IDFC First Bank and AU Small Finance Bank, both in focus. News isn't exactly great here. We cut to the IDFC call earlier on. Gaurav is here to fill in us with more details. Gaurav, take it away.
Well, as IDFC Bank's call is still ongoing. So before going to the flashes, let's understand what has happened overnight. First is that they actually hit a roadblock, we could say, because they have now reported a fraud case worth 590 crores in terms of deposits. So what happened is that there was a particular account of Haryana state of government, and there they saw some discrepancies worth 590 crores. Now, what bank has said that 4 suspected officials have been placed under suspension, and at the same time, this was discovered when a particular department of Haryana government asked for closure of their account. Now, going on, if you look at the impact, now this entire amount, which is 590 crores, is 0.2% of its total deposits and 1.2% of its net worth. So, to say this amount is going to hit a bit harder for IDFC Bank, and at the same time, analysts also believe that this amount will also account for more than 20% of its PAT, which is FY26 estimates for PAT, and at the same time, this could also impact the CET1 ratio almost by 18 basis points. Remember, this can also have some impact on its deposit growth. Earlier, we saw IDFC Bank actually cut its deposit rate, and if you look at the CD ratio, that stands at around 93.9%, which they aim to bring down to 80% level. So there may be some impact there as well. Apart from that, another news flow is that now Haryana government has de-empaneled 2 banks, AU Small Finance Bank and IDFC First Bank. Now, IDFC First Bank, there is a clear reason, but for AU Small Finance Bank, there is no reason or fraudulent case. In fact, AU Small Finance Bank has also clarified that there is no indication of any financial implication or fraudulent activity towards the bank, and they have also clarified that the total deposit is 0.4% of their overall deposits if we measure the Haryana government deposit for the bank. So all in all, they do not see any fraudulent case to say, but it may be slight negative for AU Small Finance Bank as well, given that there is a sentimental impact which will be seen on this bank, and definitely a negative impact on IDFC First Bank today itself.
IDFC First Bank perhaps could be the accident of the day on the way down. AU Small Finance Bank hit a 52-week high just last week, and the stock has surged more than 90% in the last 1 year. So some collateral damage perhaps today on AU Small Finance Bank. But let's now go across to Ria for some more stocks in the news. Ria.
Well, let's start off with RailTel as well as Ashoka Buildcon. The consortium has won an order for a contract worth roughly nearly 1,136 crores for the next 5 years. Narayana Hrudayala as well will be in focus. They have acquired a 3.3-acre land parcel along with buildings in Electronic City to set up GCCs and expand their business. And WeWork has also inked a deal to expand its leased capacity in Bangalore. They will be adding around 3,100 desks by the end of September with an investment of 42 crores.
All right. Thank you very much for that, Ria. Now, exporter-related stocks should be in focus today with, of course, this US tariff impact coming through. How to read it? Vinny's here with that. Vinny, morning.
Hi, good morning. So absolutely, US tariff, the Supreme Court had struck down Trump's tariffs on Friday and then came in the new tariff rate. First it was 10%, then moved on to 15%. That is still lower than what India was going to be agreeing on, that 18% tariff deal. So we'll keep an eye out on those exporters. Positive move could be seen here. Textile exporters, keep an eye out on Gokuldas Export, Welspun Living, Indocount Industries, Pearl Global. All of these stocks will be in focus. They account in terms of US exports, account to around 50 to 70% in their books. Other than that, we'll keep an eye out on chemical names as well. SRF, PI, Aarti Industries. Indian chemical exports to the US is 20% of the total exports, which is valued at $6 billion. So big in terms of the number there. Auto stocks, we'll keep an eye out on that. Tata Motors, 33% of JLR volumes actually coming from US. So important there. Sona, BLW, Bharat Forge, as well as Balkrishna Industries, among some of the other players that will also be in focus given they have some exposure to the US markets. Keep an eye out on those seafood stocks. So Avanti Feeds, Apex Frozen, Coastal Corp, Waterbase, IFB, Agro, all of these also could see some bit of a move given that US is India's very important and critical market in terms of frozen shrimp. So 41% of the export volumes and 48% of export value in FY25 came in from the seafood side. Solar players, so Wari Energies, MV Photovoltaic, as well as Vikram Solar are some of the players there who have some exposure to the US market. So that could also be in focus. Given this change, 18% was the previous rate. Now it comes down to 15%, at least for 150 days. So will be key for these exporters.
Thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are Axis Bank, UPL, RailTel Corp, Ashoka Buildcon, Narayana Hrudayala, WeWork India, and all the exporters might see a relief. The GIFT Nifty itself is up 180 points. Stocks with negative news flow are Credit Access Grameen, IDFC First Bank, and AU Small Finance Bank. By the way, Asia is surging in trade, at least the markets which are open. So Hang Seng is up 2.5%, while the Taiwanese market has gained 1.5%, and the Kospi has surged for this third consecutive day and at record high levels. But what's happening in the world of commodities and currencies? Manisha is now joining in for a complete roundup.
Thank you so much for that. Well, it's again in the safe havens. If you look at the gold prices, we are back above $5,100 an ounce. It's a 3-week highs onto this one, with the U.S. president announcing plans to raise global tariffs from 10 to 15% for 150 days under Section 122 is what has led to some risk haven buying, safe haven buying rather, in the markets there. Not just gold. If you look at the silver prices, we are trading 4 to 5% on the higher side onto this one as well. It also has to do with the weak U.S. fourth quarter GDP data. That in turn has also been supportive. But the buying absolutely stops at the safe havens. If you look at copper, well, after 4 weeks of decline, this week has started on a weaker note yet again. Crude oil prices gained 5% in the previous week, but have started 1% lower right now. This is after the U.S. and Iran are headed for a third round of talks on Thursday in Geneva. Markets seem to be taking some kind of a support from that one.
Thank you very much for that. Once again, just get up. Let's get the European rates up for you on your screen. We've got strength coming through in Hang Seng. That's opened up with a gain of 2.5%. The Taiwanese market has advanced 1.5%, while Kospi has been on a tear, surging for the third consecutive day and continues to hit fresh record high. Two markets are shut today. One is Japan, that's on account of Emperor's Day, and the other one is Chinese market celebrating the final day of the Lunar New Year holiday. So they will resume trade tomorrow, but it's been a nice extended 9-day holiday for China. But the markets which are trading today are trading with considerable strength. But let's talk about UPL. That's the first management on the show now. UPL has announced a major restructuring via which it will become the second largest crop protection company in the world. Jay Shroff is now joining in. He's the chairman and group CEO of the company. Thank you very much, Mr. Shroff, for joining in. If we could begin by understanding the rationale behind this restructuring and why now?
Yeah, it's a very exciting time at the UPL Group. We believe that this journey started a while ago. We believe this will unlock a lot of shareholder value, and that is the primary purpose of this. It will create three verticals which are leaders in its own right in each of the sectors. The crop protection business, UPL Global, will be the second largest independent crop protection company in the world. Advanta is probably the most valuable seed company in the world, and the specialty chemical business, Superform, will also be a very strong player and is a leading player in India in specialty chemicals. So basically what will happen is that these will unlock and we will be able to unlock value for shareholders going forward with this restructure.
All right, got that, Mr. Shroff, and thanks a lot for speaking to us here on CNBC TV 18. But I wanted to understand, in sum of parts, how is value created for existing shareholders through this particular scheme?
So UPL One shareholders will continue to have their shareholding, that will be mirrored in the merger with UPL Domestic, and then the global business will merge into that. So there will be no loss. They will just get shares in the pure play crop protection business, which will create value for the shareholders, and they will continue to have the shareholding in the UPL Limited, UPL One company. So this will be incremental shares they get. They will not have any value erosion. When you unlock the value, they will see the value improvement through the ownership in Advanta and Superform, and the residual shareholding in the residual shareholding in UPL Global, which is a crop protection business.
Mr. Shroff, promoters have an 18-month lock-in, but you've spoken about monetization and value creation. Is there a possibility of fresh issuance of shares by UPL in the 18-month period?
No, there is no plan for any of that right now. So UPL, like a normal listed company, the promoters have to follow the guidelines, and so we are just following that, and the promoters have no interest in selling down any shares in the company.
Okay, so any plans to raise fresh capital once the new entity is listed? Are you in conversation with any fund houses for investments?
So as you know that in Advanta, we have filed the DHRP and we are going to, once the SEBI approval comes, that will go to the market and raise some capital. Superform is 100% owned by UPL Limited, and that would also, we'll look at raising capital and unlocking value for shareholders there too. So these will be offered for sale where the UPL Limited will sell some shares.
All right, Mr. Shroff, Nuvama, they have put it in a note. They point out that the leverage concerns remain unresolved. So tell us, how will debt be affected?
So we have already announced in our quarterly earnings also that the debt has gone down from almost 4x in 2024 to almost 1 point. This year we should end up at anywhere 1.6, 1.8x, and going forward the following year we believe it will be more like 1.2 to 1.5x, but that is without considering any fundraise in Advanta, which is going to possibly list in the next few quarters, and any kind of cash generation through the ordinary course of business.
Okay, got that. What will be the constitution of the board of UPL Global?
So like, we will, as it will be an independent listed company, we will follow the guidelines, the listing guidelines, which require adequate strength of independent, proportionate independent shareholders, which we will be listed automatically. And so it will follow the normal course. The directors, we have UPL SAS, the board members, we have UPL Cayman, as we call it, board members, and we will constitute, we will invite the right kind of independent board members to be there. So it should follow the guidelines.
Taking note of that, Mr. Shroff, and thanks a lot for joining in and detailing, that entire scheme of arrangement that you have announced. Looking forward to chatting up with you in the months to come. Well, time to slip into a short break. On the other side, we have Dharmesh Kant of Solar Securities, who's waiting for us with some fundamental talk. Welcome back. As promised, let's get in Dharmesh Kant, Head of Research at Solar Securities, who joins in on the show. Hi, Dharmesh. Good morning. Good to see you in. IDFC First Bank, that's going to be top of mind, right? That fraud has been detected at one of their branches. 580 crores, 590 crores, approximately small percentage of their deposits, small percentage of their net worth as well. But the problem is this sort of incident obviously creates a very, very negative sentiment for the stock. Management is trying to clarify on a call that's ongoing. But what's your view?
Yeah, good morning, Nigel. Thanks for having me for the show. Definitely not good news, and one more private sector bank falling to some sort of fraud by employees. So internal systems and controls have to be looked into more deeply. And the maker and checker kind of a thing, which I think management is, highlighting to that. But there was definitely some gap out there, and that's the reason why collusion by colluding employees, such kind of activities happened. It's a dent, a notable dent on the net worth and the deposit kind of a thing. I think 10-15% kind of a stock price correction will immediately happen on the opening itself. And thereafter, since given the history of IDFC Bank, because it was trying to recover, it was trying to improve its return on assets and trying to improve their deposit base. So this all will come into questions. And small banks, when you are coming up and you face with such kind of a problem, so depositors, faith into the system itself comes under a scanner. So all the more uphill task for IDFC Bank. The only advice would be don't buy the fall, wait for things to stabilize, and maybe later on one can look at it. Not now.
AU Small Finance Bank, if it falls in sympathy, though there are no allegations of fraud, but it has been, it's been removed from the panel from Haryana government. So if there is some collateral damage today, would you look to buy it?
Yeah, definitely. Yes, good morning, Niba. I mean, AU Small Finance Bank stands on a different set of fundamentals. The bank has been coming up quite nicely, and the run rate has been quite good on the growth front. That kind of a super number growth, now since it's become a bank, it's not feasible. It will definitely, taper down quite a bit, around 20-22% is the likely run rate going forward for next 2 years. But having said that, optimization of cost to income ratio to maybe 45% or 43% from the current 57% level will take care of the depleting growth. So our advice here is the one leg of the entire run-up has happened from this becoming a universal bank. And now one has to wait. It's a time call. I mean, 2-3 years it will take for a next leg of a meaningful run to happen. So any 10% kind of a decline, whether it is because of this news fall or because of any other market correction, if there is a correction, then it's a buy on decline kind of a bank. Definitely nice if you are maintaining a mid and small cap portfolio. It merits a buy there, but horizon should be at least 3 years from now.
Okay, all right. Got that. Dharmesh, what about UPL? The stock from the recent close has seen a decent rally. Now they've announced this scheme. Management believes that it's going to unlock value. A lot of brokerages are questioning, but what's the, for the PE it gives liquidity. But for a minority shareholder, what kind of value unlocking is there? They're still a little bit unclear about that. And it's not resolved the leverage question, which is on their books. So the deleveraging hasn't really taken place. Your view on the stock after the recent run that we've seen from the lows?
Yeah, I mean, last quarter things have shaped up well for UPL. My last 2 quarters, otherwise it was a very volatile kind of earnings trajectory which UPL was giving post the merger. Initially, post the acquisition of Adventa. But I think the seed business was the one which was the cash cow for UPL. It was having a consistent margin of 17-18%. And was delivering the numbers on the console basis. Now, since that's out of the business, so the two, I mean, it will be two different set of business and the numbers will be very clearly visible. So the agrochemical part of UPL business will be a challenge going forward, though things are, improving on the global scenario. Be it Europe or US and the input supplies from the Russia and the China region. But it will be a challenge for UPL to carry out there. And they have, several cross-currency kind of exposure, both on the debt side and on the business side. So in past, they have struggled to manage that or very, effectively. And you rightly said, with this kind of a demerger, nothing, comes into the balance. So some equity bumping would be needed in the demerged business, which is non-seed business, the chemical part of the business to bring down the debt. So let's see how it shapes out. But to my mind, shareholder would be better off having the seed business in place.
Yeah, no, absolutely. That's Dharmesh, hi, good morning. 12 minutes to go for the pre-open session to kick off. Have you spent any time looking at these exporting companies, especially on the textile side, etc.? There are kind of slightly differing opinions coming through. But what's your sense?
Good morning, Prasad. I mean, a lot of volatility out there, and every third day, fourth day, something new is coming up on the entire tariff front. So very hard to take a call. I mean, you can take a couple of days kind of a call. If today, definitely all these companies will open up nicely and will give you a trading bump. If you're lucky enough to get it early and enjoy 2-3% kind of upside from there, good for that. But to my mind, I think this 15% kind of a tariff gets settled for some time. And this will be the ballpark number around which the balance of, future 1 year, 2 year kind of projections can be taken. But again, it's a 15% additional tariff, which was not there earlier when these companies were exporting to that. So more or less, the nice rally has already happened in most of the export things, be it textile, gems and jewelry, and the other in the same market, even the feedstock, shrimps and all. So maybe 4-5% more from here, and that should be the end of it. So stay away is the only call from such sectors. Look into domestic facing economy. I think there the real juice lies going forward for next 6 months.
Thank you, Dharmesh. Great chatting with you this Monday morning. Need to get into a break. On the other side, we'll connect with Sudarshan Sukhani, Mitesh Thakkar for some technical trading ideas. Stay tuned.
Okay, welcome back. 7 minutes to go for the pre-open session to kick off. Hormuz is here with the big movers that we saw on Friday. Hormuz, good morning. Take it away.
Morning, Prashant. And some big movers indeed over Friday's trading session. And an important one is Vikram Solar. It remains in news today as well. But on Friday's session, the stock was down 10%, the biggest fall since its listing back in August of last year. Now, the third straight day of losses, the stock has declined in 6 out of the last 7 trading sessions, where it is down 20% during this period. Now, almost 85 lakh shares were traded on Friday, which was the highest volume since the 20th of January of this year. And 35% of the total traded volumes were marked for delivery as well. And the delivery volumes, though, were the highest since September of last year, where almost 30 lakh shares were marked for delivery, the 20-day average of just 3.5 lakh shares. Stock in news today because of the fact that its lock-in period is ending today and is 42% below its IPO price of 332. Now, Newgen Software has seen some very volatile moves over the last couple of weeks. Now, between the 10th to the 16th of February, the stock was down almost 20% in the 5-day losing streak. Then it had a 3-day gaining streak where it recovered all of those losses. Then the stock was down again on Friday. And in the last 4 trading sessions, every single session we have had more than 1 crore shares changing hands. The trading volumes during the 3-day fall was higher actually, 3-day gains compared to the fall that you saw on Friday. But the delivery volumes have been either in mid single digits or in low double digits over the last 4 trading sessions. And even in Friday, 25 lakh shares were marked for delivery, 20-day average of 6.8 lakh shares, and the stock is still down 60% from its 52-week high levels. And one name that highlights on Friday is KRN Heat Exchangers. That stock was up double digits on Friday, the biggest single day gain since July of last year. The Friday's volumes were the highest since October of 2024, and almost 2 crore shares were traded on Friday, 20-day average of 3 lakh shares. Close to 14 lakh shares marked for delivery. Friday's turnover 1600 crore rupees, higher than its free float market cap, which is of around 1590 crore. And investors like White Oak Capital, Mukul Agrawal own stake in the company, and the stock from its IPO price, despite the recent correction, is still up 4x from its IPO price of 220.
All right, Hormuz, and welcome back. I was going to sing that for you. Guess who's back? Back again. Good to have you back, Hormuz. Hope you had a nice, relaxed time. Get back to business, and we're looking forward to plenty from you. Thanks, Hormuz, for joining it. Well, time to slip into a short break. You come back, we'll get you the pre-open rates. We'll also have with us Renu Beth of IIFL Institutional Equities, who will be joining in to put the spotlight on the capital goods sector. Stay tuned. Welcome back. In a few minutes, we'll be getting the pre-opened rates. For the time being, let's welcome our technical experts. We have Sudarshan Sukhani as well as Mitesh Thakur, who join in this morning. Good morning, gentlemen. Good to see you all in. Well, it's expected to be a bright start to the trading session. And bright green is what the call is. Mitesh, how do you trade the index from there if you get a gap off of 150, 160 points as per what the Gift Nifty is suggesting?
Good morning, Nigel. I think I was looking at the charts over the weekend and realized that most of the volatility or directional indicators are turning flat, which means that while we have had some choppiness, we have had some gap ups and gap downs in the last 2 weeks, the net result has been that we have not been moving in either direction with a decisive kind of follow through. So for the time being, the short term range for me is around 25,800 to about 25,400, and the broader range is about 26,000 to about 25,000. Give and take a 1,500 points on the broader range limit. Given that kind of scenario, I think we might open around the 25,800 mark. So one, I won't be in a rush to take long positions immediately. In fact, if I have long positions, I would want to take some profits and see if the gap is sustaining and if there's follow through post the gap of opening. If that happens, then I think 26,000 is on the cards. If that doesn't happen, then I think we are in that 400 point kind of range, and therefore cutting down on some long exposure may not be a bad idea.
Got it. Okay, all right. Cutting down on some long positions at higher levels may not be such a bad idea. Got that, Mitesh? Sudarshan, coming across to you. How are you feeling about the market? 150, 160 points is what we could be bracing ourselves for. The trades are nullified from there, or you need to buy the dip?
Good morning. See, I would be a buyer today. We must remember that the Gift Nifty had actually gone all the way to 25,900 before retreating a little. So that's a level that the markets have seen on Friday evening and could easily revisit. So the idea is not to buy at the open, but to wait for a minor dip, which normally comes somewhere between 25,650 and 25,700. If the Nifty goes into those zones, buy with a stop at 25,600. It's a tight stop and a possible rally to 25,900. So it would be a sort of a sweet spot to buy in that small dip.
So Sudarshan, long on the Nifty. What about stocks? What are the calls?
Well, Tata Steel is a buy with a stop under 205. Bharat Forge is a buy with a stop under 1750. And United Spirits is an intraday short or even a short with a stop over 1400. LTF is a buy with a stop under 290.
Got it. Okay, all right. Mitesh, what about you? Give us your picks.
Yeah, I have all buy calls as well. The first buy call is on ABB, which had very strong price action, but towards the end kind of, saw decline, the market declining, but the overall setup is positive. So keep a stop at 59.40 here, look for targets of 60.70. Also a buy on Larsen and Toubro. It was, I think, a BTST as well. Very clearly the stock closing at fresh highs continues to outperform the Nifty. This is a buy with a stop at 43.54 for targets of around 44.45. Then buy on HDFC Life with a stop at 719, and I would look for targets in the range of about 745 to about 750. And amongst the PSU banks, Bank of Baroda just is breaking above the earlier swing highs, so that's a buy with a stop at 304.5 for a first target of 320.
Hey, gentlemen, thank you very much for joining in. Let's turn our attention now to the capital goods sector. IFL Equities believes Q3 was a stable quarter. We're seeing strong order inflows in T&D, renewables, defense, real estate, and data centers. Renu Bed, Senior Vice President Research at IFL Institutional Equities, is now joining in. Renu, great to have you on the show. Well, last week was all about the AI summit. And the one word which kept coming up is data centers. And there seems to be a race to build data centers in India. Many Indian companies like TCS Jio already have plans. Global companies also have the 21-year tax holiday to build data centers in India. So one stock that you like, which is a play on AI and data centers, is NetWeb Technologies. The stock has already had a run-up. It's a well-documented beneficiary of what's happening. So where does it go from here? And are there any other stories emerging to play this theme?
Well, Network continues to be a quality play on AI DCs, and I think we've just started to see the volume accretion to them. We expect, as in till date, they have received 21 billion rupees worth of orders for AI DCs. And we are penciling in almost 55 billion worth of orders for them over the next 2.5 years. So the volume expected in the next 2 years will be 2x of what we have seen so far. So we expect that leg of the story to continue for NetWeb. On valuations, yes, it was expensive throughout, being a niche play on the IT hardware portions, which get into the heart of DCs. But that is the way things are. And company which was not making as much on the free cash side last 3 years, we will see the number turning positive this year, both on operating cash flow and hopefully on the FCF as well. It's asset-light business model, high ROC. So to that extent, the scarcity premium is playing out in that name. The other stories which we like along the data centers, we think there is strong demand for the electrical equipment part of the portfolio as well. So Cummins has been one name which continues to stand out on the DC because of the proximity to the business volumes and the sheer leadership that they have in this space, more than 60% market share that they hold in DCs, all type of DCs, whether the hyperscalers, co-location, etc. So which is where we think they continue to play on this segment. Other players that we look would be all the civil companies like L&T, KEC, who participate in creating the civil infrastructure for them. The second leg of the companies, which would be the one which are doing the HVAC solutions, the cooling solutions, and the other products which go inside it. On the diversified industrial, we think ABB is a good proxy on DC. They not only give you on the software part of HVAC solution, but also they have a variety of electrical products which go into it, including UPS. Not many companies are doing assembly of UPS, which is required for data centers in India. ABB is one of them. So that gives them a good proxy, especially for hyperscalers, which are willing to invest in higher-end technology product. And the specs are similar to the global level. So ABB tends to be a meaningful beneficiary there. Then we have the whole bunch of other companies in HVAC, Voltas, Blue Star. We have Siemens, which participates, Honeywell Automation, which is there in the space. Electrical products on the switch substation transformers. We have Voltamp, Hitachi, GE, Siemens Energy, which are there. So thereafter, the tail list of the companies is pretty long.
Right. Hi, Renu. Good morning. Good to see you, Ben, as always. Renu, a couple of questions here. One is on Hitachi. You know, the stock forever has been expensive. 10,000, 15,000, 20,000. Now it's almost 25,000. And, you know, when we have Mr. Venu on the channel, he sounds very, very optimistic. And when he details an opportunity, you know, you have to take him seriously. Like when he was talking about HVDC a couple of years ago, when no one was talking about it. And that's exactly the way it played out. What's your call currently on Hitachi at these levels? Because some believe there are still tailwinds and you have to be in for a longer run. And the other one I want to ask you about APAR. You know, I recall speaking to Mr. Desai, and I think he's given the only media interview here on CNBC TV 18 a few years ago. The stock, you know, came up drastically in 18 months. But in the last 1 month, it's up 40%. Your view on the stock post this big run?
So on APAR, yes, the entire re-rating was around the company's proxy play on the cables and wires portfolio domestically and how they are increasingly expanding their exposure on the cables part of the business. Specifically, if you look at international portfolio on renewables and solar, where they have significant niche capabilities. The stock did correct meaningfully, I would say, last 6 months around the uncertainties on US tariffs and exports to US softening out. And clearly over the last month, 1 month, if you see clarity emerging on the US tariff settlement being through for India, stock did re-rate very sharply. So that continues to be a tier proxy on the transmission spend, domestic and global. And on top of that, high voltage cables where they have a strong portfolio and proxy to renewable and other niche segments, in addition to the long tail investment that we see on the telecom side of the BharatNet projects, where the company had just started initiating orders there. So to that extent, that was a revival story for APAR there. When you look at names like Hitachi, they have played the strategy right on the HVDC segment, which is where the core forte has been. They don't play as much on the rest of substations or other projects per se. So from company strategy point of view, they captured lion's share of all HVDC projects, major HVDC projects in India so far, except for the last VSC project, which went to GVT&D. And they've built up growth visibility for the next 4 to 5 years, where they can grow at 30-35% CAGR. Even if EBITDA margins for them are softer than peers, they have bought out growth visibility, leaving the near-term margins on the table. So that's a growth strategy which individual companies adopt. Hitachi has its own strategy. GV has had played a different strategy in playing the global HVDC boom with their global orders for HVDC transformers, while they're making 25% plus margins. In addition to now securing high-tech or I would say the next generation VSC projects, where until now only Siemens Energy was the listed play in that space. So I think different MNCs have played their strategies on different front. At the end, all three of them have benefited hugely from the entire rebound that we have seen in the domestic T&D capex.
Right. Renu, do you have a strong buy in the space? Morning.
Morning. Yeah, overall on the cap goals, if you look at the risk reward, names that we like are CG Power. Bottom up, we like MTAR Technologies. Network, we like valuations now look relatively fair and expensive. Larsen has been a good defensive space in our view, good defensive play in the space. And incrementally, we think as news flows and order momentum improves, sentiment will play positively for ABB, and which is where we think the next round of earnings upgrade as well as the re-rating would be there for ABB India, where both on valuations as well as earnings front, the stock has been at the back foot for the last 4 quarters.
Yeah, yeah. Got that. That's a very nice view. And CG and MTAR right off the bat, the two names that you mentioned there. Thanks very much, Renu, for that. Appreciate it. And we'll speak again soon. 5 minutes to go for the pre-open, for the market opening, beg your pardon, to kick off. Let's just put the pre-open rate and where that is at before we go any further. It's 100 points. So 25,007, almost 700 at this stage on this one. Let's just look at maybe these textile names, right? I mean, and see the clear, I mean, whenever the tariff things comes up, it's these textiles companies which get thrown into focus. So 817 on Gokul is higher, 2-3% up. Wellspun Living is up about 2.33% or so. Well, let's get 9-10 calls out of the way. Sudarshan and Mitesh are back with us. Sudarshan, what do you have?
It's Tata Steel. Buy Tata Steel with a stop under 205.
Tata Steel. And Mitesh, what about you?
I go with the buy on ABB for targets of around 60-40.
Okay, ABB, Tata Steel and ABB from Sudarshan and Mitesh respectively. Thanks very much, both of you, for that. Speak again soon. Well, let's get the brokerage calls out of the way and which are the top ones that you should be focused on. Sudarshan is here with that. Sudarshan, morning.
Good morning, Prashant. So first, on HSBC on telecom, it says that growth drivers for telecom sector remain intact, and ARPU, that is average revenue per user, is going to increase. Home broadband subscribers to expand, and free cash flow dividends will also grow. So reiterate buy on Bharti Airtel with a target price of 2,400. Reiterate buy on Reliance Industries with target price of 1,780 rupees, and reiterate reduce on Vodafone Idea, but raise target price to 7.70 rupees from the earlier target of rupees 5.80. Next one is Torrent Pharma. Macquarie has initiated coverage with the outperform call, and target here is rupees 5,000 per share. Positive note is on the back of the JB Pharma acquisition and the growth prospect because of that. So post-acquisition pro forma EBITDA will almost double by FY29 from the base of FY25. Net debt to EBITDA to decline from 2.6 times in FY26 to 1 times by FY28. And so the major catalysts, regulatory approvals for JB Pharma acquisition, synergy realization, and key product launches. Last one is Dixon Technologies. Morgan Stanley maintains underweight call, and target is 8,157 per share. That is, and it's saying that DRM spot price as on Feb 13 was up 6.8 times YOY, and so far in Q1 CY26 is up 55% to 64% sequentially. And as per TrendForce, mobile DRM prices are expected to rise in the range of 88 to 93% in Q1, and also about 75% of India's smartphone is at less than $30 price point, and increased DRM price could be an incremental headwind for the industry going forward.
Thank you very much for that. JP Morgan, though, has a counter view on it. Overweight, target price 13,700. They're bullish on the potential easing of Chinese equipment restrictions, which could fast-track Dixon's JV with Vivo and HKC. But stock of the day could be IDFC First Bank. Ritu joins in with the conference call takeaways.
Well, Rima, first a clarification on that 590 crore figure. The management said that it had assessed the difference in the balance from when the government asked for their balance statement was only about 490 crores. This 100 crores they've added on top of that for safety as cushion. So the total impact as of now is assessed at about 590 crores for this one particular branch, and they don't expect the final numbers to be very different. That is the first takeaway. Second takeaway is that they expect to be able to absorb the hit, whatever the final figure is, which again they expect to be not very different from the 590 crore rupees. They've already apprised the board of the matter. They've involved the investigative agencies already. They've informed the regulators and have named KPMG as the forensic auditor, and expect that process to start and conclude over the course of the next 4 to 5 weeks, where they get some initial assessment of the kind of hit they may have to take. But apart from that, the management repeatedly clarified on the call that this pertains to one branch and one client account. This is not a widespread issue, and it was a physical fraud that has happened through forgery of checks. And they're going to take steps to, make those who are accountable, be, of course, taken to task. There are 4 employees that have already been suspended, and they are looking into the matter to see whether there were more people that could have been involved. Keep in mind the total, Haryana government deposit accounts is only about 0.5% of the total deposits, and they don't expect the hit to be any larger.
All right, first rates coming up in just a bit. And what do we have, right? I mean, on your screens now, 25,667, about 1/3% higher. You've got the Nifty Bank, which is absolutely flat. The Sensex is starting about 1/3% up, and small cap index is up 0.6. So small caps have got a bit of a lift, a meaningful lift at that. Is it 0.6 or... I think, 0.7 actually, 0.6, 0.7% higher. So that's the part of the market which is right out of the gates jumping up in a meaningful fashion. The mid-cap index will also come up. Look at the market breadth, it's 2:1, more than actually, 2:1 advances to decline ratio. Mid-cap index not very much, right? I mean, it's actually flattish to slightly lower. Nifty's got about 75 points on it. And that's the start. Lots of individual movers with the news flow, which we will get to in just a bit. There is Axis, UPL, IDFC, AU, etc., etc. But that's the Nifty heat map. Quick snapshot view. I think you got about, 11 names in the red, and everything else which is up and about. Axis Bank, Adani Enterprises, HDFC Bank and Titan are higher. On the other side, you've got Cipla, ONGC and Infosys, which start in the red at this point in time. Rima.
Well, it's not a runaway rally. It's positive for the benchmark indices. The Nifty is up about 90 odd points, a gain of about 1/3 of a percentage point. First up, with the spotlight on IDFC First Bank, straight away a 10% gash. Stock is now at 75 following the disclosure of the 590 crore of fraud. IDFC First Bank is taking a hit, and AU Small Finance Bank, which has also been impacted. They've been barred from participating in the Haryana government, or they've been dispaneled from it. AU Small Finance Bank has a gain of 5.5%. And the third one is UPL, and that's taking a hit of 7.5%. The company is undergoing a restructuring, but as Nuvama was pointing out, high leverage remains a major overhang. The demerger alone doesn't fix the balance sheet immediately, and the street is giving it a negative bias to begin with. Let's run through some of these IT names. IT was the big casualty last week. And this morning, we've got Infosys opening up in the red. That's got a cut of about 0.5%. HCLTech, TCS, a mild negative bias. The big drag is ONGC, 1.5% lower. Cipla is another one with a fall of more than 1%. Only 2 Nifty stocks with a cut in excess of 1%. Other stocks in the red include Asian Paints, Coal India, Interglobe Aviation. Crude prices continue to hover around $71 per barrel ahead of the Thursday talks between US and Oman. On the way up, banks are providing support, particularly private sector banks. Axis Bank posts the clarification, not interested, not looking to buy Credit Access Grameen, 1.5%. That's the top Nifty gainer. HDFC Bank, higher. Shriram Finance, Adani Ports, Hindalco, Tata Motors, Passenger Vehicles, some of the stocks in the grey. Now trying to build up 125 points up on the Nifty, though the mid-cap index is absolutely flat.
Well, that's right. But there are a few big winners, Rima. The reason that the mid-cap index is underperforming is because a couple of large names, which are not Nifty constituents, they are under pressure. And that's why, in fact, that index appears to be underperforming. But otherwise, there are plenty of winners. Let me run you through a few of them. I'm talking about big 5-10% gainers. D Development Engineers, they have secured a contract worth around 170 crores. If I'm not mistaken, the stock is up close to around 8%. Let's get D Development Engineers up for you on the screen. Morpin Laboratories, that's the other one that we're looking at. 800 crore order win is what they have announced that's from a global CDMO deal, expanding their manufacturing footprint. That one as well, a big underperformer. That's popped up and trade up close to around 8%. Some of these textile-related plays, since the tariffs could relatively be lower, you have Kotak's Garments. Big up move is out there. Nitin Spinners, another stock that's seen a big bump up in trade. Gokuldas, that as well is up and about. Nitin Spinners is the one I'm talking about. So let's get that stock actually up for you. Yes, Gokuldas is up and Kotak's Garments. Kohance Life, there was a large trade of a few hundred crores. That there was a buzz that could get out of the way. That's precisely what's happened. And Kohance, I think, is up close to around 5% because that large block is out of the way. And I think Sri Lotus Developers as well, one of the recent IPOs that corrected a goodish bit from the listing highs. Well, that one as well comes up for you on the screen. That as well is up close to around 5%. But net, the reason that the mid-cap index is underperforming is because some of these large names like IDFC First Bank, UPL, AU Small Finance Bank, they are down between 5 to around 10%. IDFC First Bank because of the fraud in Haryana. UPL because the street is questioning this cooperative action. They were actually expecting some value unlocking to take place, which isn't clear as of now. So that's why the stock has got sold into. And AU Small Finance Bank as well is down in today's trading session. Prashant.
Absolutely. And the news-related names are all lower. At least the three of them that we mentioned are lower. So 127 points is not bad at all at this stage. We have Sanjeev Prasad now joining in. He's Managing Director and Co-Head Kotak Institutional Equities. Sanjeev, of course, over the last few months has been turning more constructive in terms of the market. He's, of course, joining us from the sidelines of the Chasing Growth 2026 Investor Conference, which kicks off here. So Sanjeev, busy day ahead, busy next few days ahead. And thank you for making time and joining us. And important day as well, because over the weekend, once again, tariffs have been back in the spotlight. And I'm sure you will get that question. How to read this 15%, 18%, and how to, if at all, any change to how you would value and what markets should do because of all of this?
No, honestly, it's all very uncertain as of now, given the fact that the tariffs which have been imposed, they are of a temporary nature, 150 days maximum. And what comes after that, we'll have to wait and see. There are several other acts under which the President and the Congress can impose tariffs, and I assume that will be done over the next few months. So I don't think you have seen the last one of this tariff saga anyway. So I don't know whether it is such a material development in the sense, from India perspective, 18% has gone down to 15%. So yes, on paper it looks positive, but the bigger issue is the level of uncertainty over here. For exporters and importers both. I mean, how do they actually, have a strategy in place for next few months? What tariff should they work with? Which country, that's an importer like an Amazon, should be importing from? You just don't know what is the final, the data point to work with over here. So I guess uncertainty itself is a bigger problem, not so much as the announcements over the weekend.
Yeah. So if you had to take a view in that sense, right? Uncertainty, yes. But if you had to take a view, you'd say eventually there's not very much different. I mean, up positive or negative in that sense, Sanjeev, that's what you would say? Or incrementally, maybe it is a bit more positive, or no? Not really?
Yes, on paper, yes, as I said, 18 going down to 15 from India perspective positive. For many other countries, most of them are in the range of 15 to 20 anyway. So I don't know, for example, Japan, South Korea, both are 15, so it doesn't really change much for them. Most of the Southeast Asian countries are 19 to 20, so for them it's actually a decline. So I don't know whether it is such a material development in that sense. And the bigger issue, as I've been saying, is the uncertainty over here. Because let's say the goods which are on the way to the US. I mean, what import do you apply? Whether it was you built in a certain price based on a certain tariff, and now that's changed midway. When the shipment is en route to the US. So it's it creates a whole amount of uncertainty with respect to the next few weeks, months, till the dust finally settles down on the saga.
Sanjeev, hi, morning. What's the Kotak view on IDFC First Bank that we've seen the fraud of 590 crore rupees? And every now and then, there are these periodic episodes of fraud. Earlier it was IndusInd Bank, now you've got it in IDFC First Bank. So although private banks, I mean banks in general, offer value relative to the market, which is expensive, you keep having these incidents.
I can't make any comments on a general basis, and we don't cover IDFC Bank. So both on the general issue, on the specific issue, IDFC Bank, I really don't have much to say.
Okay, all right. Hi, Sanjeev. Good morning, and good to see you. And as always, Nigel on this side.
Morning.
I wanted to ask you about a couple of aspects, Sanjeev. Economic indicators. If I look at cement offtake, power to some extent, cement, steel, rebar pricing, as well as flats, there is some traction on ground, which is giving you hope that the economy is actually in recovery mode and things could look up from here on. Last quarter earnings as well, in comparison to most estimates, were actually better. Will you start getting more constructive on the broader markets? Because there was plenty of froth. Yes, you've made that point quite a few times and well noted as well. And we've seen a big underperformance. Do you think from here on, broader markets can actually outperform going by the ingredients we have in place?
No, you're absolutely correct, Nigel, in the sense that things have started to look better as far as the economy is concerned. Most of the monthly, high-frequency indicators, if you look at, seem to be looking better. If you look at electricity demand, which is a very good indicator, last 2 months in the range of around 5 to 6% compared to pretty much flattish for most of the current financial year. Cement, steel doing reasonably well. They have been doing well actually for most of this year. Credit growth, most important, that has picked up to almost 15% now. That used to be about 10% in September. And both retail and industry credit growth has picked up, which is definitely a positive sign. And similarly, if you look at other parameters, everything is looking better, I would say, compared to the last few months. So the question now is the sustainability of this. For the simple reason, some of the momentum that you're seeing on the economy is on the back of GST rate cuts. And of course, much looser monetary policy. You have 125 basis points of policy rate cut. So all that has supported some amount of recovery in the economy. How much it sustains, we'll have to wait and see. But at least the next 2-3 quarters are looking better, I would say. Which brings me to the point on earnings. You're right. This quarter earning numbers were better. If you look at Nifty 50 index net profit, that grew about 10%. If you look at the coverage universes, which is more than 300 stocks now, that grew about 15% at the net income level and beat our numbers quite decisively, I would say. About 7% in the case of Nifty 50, even higher, about 6% in the case of the KI coverage universe. So things are looking okay. The only question is how long does the momentum sustain? What we definitely need is private sector investment to start picking up, which on the back of job creation can sustain the recovery. On the market part, the challenge still remains the valuation is still very high. So despite the recovery in the economy and the earnings, keep in mind the fact that we're already building in pretty strong earning numbers for the next financial year. So if you look at our own numbers for the Nifty 50 index, we're about 16% plus in terms of growth in the profits of the Nifty 50 index. That's already captured in the next year's valuation, right? When you look at 1 year forward valuations, next year growth is already there. And remember, the market is still about 21 times on a 1 year forward basis, so not exactly cheap. And if you look at parts of the market, especially the consumption bucket, investment bucket, things are still expensive in terms of valuation. So it is imperative we get the earning numbers going for a change compared to what we have seen the last 2 years, particularly FY 25, 26. We had huge amount of earning downgrades, and that's the reason why the market did not perform. So on an absolute basis, things are looking better, I would say. Earnings outlook is definitely better, which we have been highlighting the last 4-5 months now. The challenge still remains, as I said, valuations. And the second thing is, if you look at earnings growth in the rest of EM, actually that's very, very strong. Most countries are actually delivering far higher earnings growth compared to India. If you look at, for example, South Korea, if I remember the numbers correctly, some 150% earnings growth. Obviously, that's coming on the back of a very strong pricing environment for chips and all that stuff. And the market is at 8p, by the way. So, and you look at across markets, most of them are looking at very, very strong earning numbers this year. Maybe just linked to the AI cycle, but whatever it is, that's what it is. Taiwan is some 40% earning growth this year. So that's what India has to contend with, even though things are looking better on absolute basis. Valuations are high, and the excitement around AI In other markets, valuations are cheaper, earning growth is stronger. So I suspect the foreign interest may still be limited as far as India is concerned.
Sanjeev, what kind of an impact do you expect AI to have on overall markets, not just the IT sector, but in terms of jobs, because that has implications for consumption, real estate, the bottom of the pyramid kind of spending? I mean, at Kotak, have you all done any, or it has positive benefits to productivity coming in through for manufacturing and other sectors. Have you all done any analysis on how the use of AI consumption can actually change India's earnings?
Well, it's early days yet, I would say, and you still need to get your head around a lot of issues over here. But whatever maths we have done, let's start with the immediate impact on the IT services sector and what it means for the broader economy. If you look at the total exports of IT services plus, the software part plus BPO plus GCCs, all put together is somewhere about 6% of GDP. And entire exports is actually value added in a way, barring about 15% of SG&A. Everything else is, in a way, GDP over there. So yes, it is a reasonably large portion of GDP, but do keep in mind the fact that, the impact of AI or the negative impact of AI would play out over a period of time as far as the IT services sector is concerned. Not as if, people are just going to uproot the legacy systems and replace it with some AI-enabled system. I don't think that's going to be the situation over here. So yeah, earnings growth would be, or rather top-line growth would be lower for the IT service compared to whatever people are assuming at one point in time. In terms of impact on the broader economy, if you look at the number of people who are employed in the IT services sector, including the GCs, etc., it's not a very big number, by the way. That's about 7 million, everything put together. That's roughly 1% of India's workforce. And if you look at the average income of a IT worker compared to a non-IT worker, that's about 4x. So that's the impact they're looking on consumption. Some slowdown, I would assume, at the higher end. High-ticket items, discretionary items, I suppose, will see a slowdown. IT services, as a proportion, GDP is about 6% I would say. And as a percentage of consumption, it's about 8-9%. So keep that in mind, but it's not as tomorrow everything going to zero as the market is, getting worried about. The impact of AI, positive, negative, will all play out over a period of time. Having said that, the impact on the market will be a lot more, faster, which we have seen. The correction will take place in terms of multiples, which we've already seen in case of IT service companies. In terms of consumption, you will see maybe negative impact on consumption through the sentiment route. It's not as if salaries of people are going to go down or, jobs are going to get cut. It's just that people will start getting a little bit more cautious in a slightly more cautious environment. So spending may, in pockets, start to slow down. I will emphasize it's in pockets, not as if the entire economy is going to get hurt or something like that. Over a longer period of time, I would assume AI to be extremely beneficial. Clearly there will be massive productivity gains. Whatever you could do over months and weeks, you will probably do it much faster. What it entails for, jobs on the other side, that we will figure out. But yeah, it's a mind-boggling proposition for sure.
Yeah, and it's a larger conversation, right? This one, because...
Absolutely, yeah.
It's... you can go in so many different directions, but I think, yeah, we need to do that as well. And Sanjeev, I hope the conference throws more light on this, and we'll invite you back for just a conversation on how to think about this, right? Because AI and not just IT services, but the overall consumption impact and other things that it may affect. Thank you for joining us, Sanjeev. Really appreciate it, and thanks for being here.
Thank you, my pleasure.
Okay, all right. Let's just go back to the tariff story, right? So the 15% tariffs now by the US after the setback in sort of delivered by the Supreme Court for President Trump. Earlier we were at 18, now it's 15, but we were also in the middle at 10. So it's really all over the place in that sense. Naresh Jalan is Managing Director, Ramakrishna Forgings, and Pallab Banerjee is Managing Director, Group President, Pearl Global. Gentlemen, thanks very much for joining us. Good to have you here. Prashant this side. Pallab, what's the sense? I mean, we are waiting for the executive order, but once the executive order comes and say it is effective as the earlier post said, it will be effective from Monday, right? 3 days. Say whenever it is effective from, for goods which hit US ports, What do you think? I mean, what will the customs, because that is the, in that sense, the proof of the pudding, right? What is the tariff charged when goods hit the US port? What's your sense, Pallab?
Yeah, good morning, Prashant. Yes, as you said, the inconsistency or the unpredictability continues. We have now this ruling due to which they are supposed to get charged only by 15%. We don't know exactly when it starts. We'll get to know tonight as US reopens. So far, Indian goods were tariffed at the rate of 25%, and 18% didn't kick in as yet at the ports. So yes, now it's going to get to 15%.
Yeah. So do you imagine there will be a huge rush of exports? I mean, importers in the US will front load massively. I mean, exports should go through the roof, right? I mean, if, say, for example, from tomorrow, tariffs are 15%, is that something we will see?
No, I don't foresee huge swings, especially in my sector. See, the benefit that the retailers and the brands will get is most of the other countries were at 20%. So the bulk of import that was happening into USA was at the rate of 20% additional or reciprocal tariff on top of the MFN. Now, with this ruling and then Section 122, which has been invoked by President, it will come down to 15%. So that gives an advantage to all these retailers and the brands by about 5%. So that's a relief for them. And that would mean that they would have a little bit better cash flow. If it had stayed in 10%, that would have been a much better news for them. And for us, the manufacturers, exporters, that means the numbers should get easier. That means the order bulk of the volume that we will be getting for the next seasons. As their cash flow eases off, they can freely buy more. Of course, it's not that free as of yet. If it had been zero, then back to MFN, that would have been a huge benefit for all the retailers and the brands. Now it's somewhere in between, maybe 15% more towards the high only. And that's where it is. At the same time, most of these retailers believed that, first of all, the Supreme Court judgment would not come out so soon. It was a little bit of surprise. And at the same time, they believe that the Trump administration would work out something else to compensate for that earning of tariff that the US government was running for.
Yeah. So for textile apparels, what is the tariff rate now if you send from India to the US, according to you?
For garments, we export most of the cotton goods. Average, I would say, for cotton apparels like T-shirts, shirts, polonaise shirts and all, those would be coming around average of 15%. So every HSN code has a different MFN tariff. Average would be around 15 or 16%. And on top of it, this Section 122 tariff, which will be another 15%, will get added.
Okay. So, sorry.
Earlier it was the MFN plus the reciprocal. Now it is MFN plus the Section 122.
I see. And MFN is how much, Pallab?
MFN, the average, I told you, in terms of cotton garments, it comes out to be about 15 or 16%.
I see. So now it is 15 plus 15 in that sense.
Yeah.
So it goes to 30.
Yeah, and that's for all the countries, not only for India, but for Bangladesh, Vietnam, Indonesia, everybody who is exporting into the US.
But Bangladesh was zero, right, Pallab? If they imported US cotton and then sent garments. So from zero, they go to 15, right?
No, they didn't go to zero as of yet.
Correct.
There was one discussion that if they import the cotton fabric, there will be some kind of duty waiver to 0%, whether it was on the component of the cost that is going into the garment or the full garment. We were not still clear as of yet. It's one of the points in that discussion that is going on. So they're still at 19%. So they have been in 20%. They came down to 19%. That's what we were told. Again, the 19 has not been implemented as yet, but that's the discussion.
Right. So they will also be somewhere where we are, around the same level.
Everybody's same. Everybody would be at the same.
Whoever had MFN would be at the same level, basically.
MFN is at the same level. Section 122 at the same level.
I see.
So it's equal playing field for these 150 days for every country.
Right. Mr. Jalan, now let's come to auto, sir. What is the number here as you see it for your exports?
Morning, Prashant. I think right now we fall under auto is falling under Section 232. So I think it's basically 25%. I think the trade deal with India, we were expecting some concession for the auto component parts to move to 0 and 18. I think we will need to wait for fine prints, how it emerges over the week. But right now it is at 25% under Section 232. And non-auto parts, which goes into oil and gas and other engineering parts, they come into 15%.
And you told us that this 25%, which is Section 232, is what percentage of your revenue, sir?
So about 15% of our revenue.
Comes at 25%.
Yes.
And what percentage of your revenues comes under the 15% rate now?
It is around 5%.
Okay, 5% of your total revenues at 15 and 15% at 25 as of now. Yeah. 232, of course, is got that. Just a quick word, Pallab, just to come back to you. That question, right? Why wouldn't would there be any front loading in any sector at all, or no? Nowhere, as you see it, Pallab? Or it would have happened if the tariff had fallen to 10%?
Yeah, if the delta had been higher, because then it made sense for apparel sector. If you look at it, 18 to 15, it's only 3% difference. Because our commerce minister and the ambassador from US both were saying that within this week, this 18% will get affected. So it's not a major difference for us. I think what I'm looking forward to is, yes, there is an uncertainty, but for the retailers and the brands, it's better cash flow at this point of time. Somewhat better, because for them, a 5% on the global import is significant.
Yeah, got that. And of course, I mean, these deals will have now to be sort of renegotiated, I'm assuming, because the basis of the IEPA basis is gone. And it'll have to happen with all countries in that sense. Mr. Jalan, Pallab, I know you have a hard stop, so I'm going to let you go. Thank you for joining us and explaining that. Mr. Jalan, just last word to you, sir. What is anything else, anything additional you're looking forward to in terms of clarity, or it is what it is for now?
No, I think it is as it is I think within next couple of days or weeks, I think the Section 232, how it works out, whether India gets an exemption on auto parts, we will need to look at it. Because of the trade deal said that US auto component exports to US, there will be certain carve-outs for zero duty and to move to 18%. We will need to look at the fine print. But as such, I think that becomes not very significant right now because of the US industry of late in last quarter onwards has started doing extremely well in terms of commercial vehicle market. So I think the pickup is very strong, and I think for this calendar year and the next calendar year, because of the emission norms change which is happening in next year, I think the front loading is going to happen, and I think we are looking at a good market over next couple of quarters.
Yeah. Got that. And Mr. Jalan, on refunds, there's no clarity as such, right? And if the refunds have to happen, it'll go to the importers, right?
No, yes, because the customers have already paid us for the duties.
Correct.
So I think we will need to claim the refunds, and as and when the refunds are made to us, we will need to return it back to the customers.
Okay. So it'll have to go back. But I mean, there's no clarity in terms of how that is going to happen, or if that is going to happen. The courts did not weigh in on that.
I think in a couple of days we will need to file for the refunds. But I think as you saw all over the news, I think still I think that there is going to be a legal cases around that. So we'll need to wait for a couple of months before we have a clarity in terms of refunds.
Okay, got that. Thank you very much for joining us, Mr. Jalan. Appreciate your time here, and thanks once again. So that is basically a view from an auto ancillary exporter and a textile exporter as well. out of the country. The market's, of course, up 170 points, 25,750 is where we're at. We'll take a quick commercial break here. The management of CleanMax will be with us to talk to us about the issue which is opening. They're coming to the market. Kuldeep Jain and CleanMax on the other side.
Welcome back. Well, the market's holding with solid gains. The reason that the mid-cap index is underperforming is because IDFC First Bank, AU Bank, as well as UPL, all three of them are part of the mid-cap index. So that's why it's not actually giving you the kind of momentum or the kind of rhythm that we have seen in the markets today. That said, let's focus on the IPO market. Renewable energy major CleanMax's 3,100 crore rupee IPO opens today. The price band comes up for you in the screen in the vicinity of around $1,000 or around 1,053, comprising of a fresh issue of around 1,200 crores and 1,000 OFS of around 1,900 crores. Mr. Kuldeep Jain, the chairman and managing director of CleanMax, joins us in the studio. Hi, Kuldeep. Welcome to the studio and welcome to the stock markets.
Thank you very much.
Let's get a couple of details out of the way. The money that you're raising, that goes back to the company is around 1,200 crores approximately.
That's right.
Majority of it will be used for debt repayment. So first factor, what is the kind of interest savings that will be there, from this 1,200 crore of repayment? And also, how do you fund your future capex plans? Are you comfortable post this repayment if you have a ratio that you're going with?
So two things there. First, if you repay about 1,200 crores of debt and it's about a 9% interest rate, that's about 100 crores of annual interest cost saving, which sort of goes straight to the bottom line. The second thing is, in our business, all renewable energy companies will have debt because you do have assured income from renewable energy sales contracts over, say, 23 years in our case, and therefore you do have a 15, 17-year debt. Our net debt to EBITDA at about 4.6 times is more conservative, lower than industry average of around 5.5 times. So we were, even prior to the IPO, more conservatively levered than renewable energy peers.
Okay.
But we will repay some of that debt.
Okay, all right.
One question on that, because your borrowing has practically tripled. I think FY23, it was sub 4,000, went up to 8,000 last year. And as of, I think the September quarter, it's more than 10,000. So that's a sharp increase. While I get that your overall leverage is lower than peers at 4.6 times net debt to EBITDA, considering you have expansion plans, what is the leverage going to look like, absolute and even net debt to EBITDA?
We would expect to stay within that conservative, lower than 4.8 or 5x of net debt to EBITDA. But yes, in our business, if our EBITDA has grown in the last 3 years at a CAGR of 58%, year-on-year 58% EBITDA growth, yes, over 23 to now, debt would also increase. Right? As long as your ratios stay the same.
5% is the red line? 5x.
5 times.
5 times
is sort of the red line level.
Okay, all right. A couple of more questions then with regard to your gross margins. Phenomenal improvement. And also on the net profit front, you've turned profitable. Will you continue to maintain these sort of gross margins? I'm not asking you for a forward guidance. I'm just asking you whether or not this band can be maintained. And also the net profit, you continue to remain profitable because as it is, there'll be interest savings. So both those two questions, because at times there's this IPO phenomena that plays out. So, please clarify on that.
Yeah, absolutely. So firstly, net profit, we did make in the first 6 months of this year as much net profit as we had made in all of last year. So of course, that trajectory you can see is continuing. The second thing is from a gross margin perspective, the renewable energy power sales business is incredible. It's like a 94% gross margin. And the reason is, I jokingly say that the sun gods and the wind gods, which is Surya Dev and Vayu Dev, do not charge you money for giving you their input, unlike, say, a coal-based power plant or a diesel power plant. So therefore, gross margins are incredibly high, and we do think that is structural unless the government starts taxing solar and wind, which ain't on the cards. It should continue.
Just for a counter question with regard to the industry on the whole, not just your company, what kind of penetration have you all seen, and how big do you think it can go to for a company like yours, in the industry that you operate?
Thank you. So what we do as CleanMax is we make green power, solar and wind, and sell directly to corporate customers. We sell nothing to power distribution companies, which is what most listed utility peers are doing. So what we do is sell to corporate customers, which is also called CNI. So we are the market leader in the CNI space, and being the market leader, we are the first from that space to come with an IPO. And the penetration, so the question becomes how much of corporate power is consumed through these bilateral green sources. It's only about 7%. And a corporate customer, whether a chemical company, cement company, or data center, saves in excess of 30% at a minimum in any state by going green. So, you save good money for doing the right thing, right? And therefore, the penetration is rapidly increasing.
So Kuldeep, that's the point. The 30% is so it's a no-brainer in that sense.
It's a no-brainer.
I mean, right. And we're taking your word for it. It's a no-brainer. I think, but no other, everything included, all costs considered, everything.
Because in our business model, we make the investment. See, because if you're running a textile company or like our clients are the biggest textile companies like a Wellspun or a UPL or Sona, Comstar, Sansera, and so on. A lot of the listed companies you cover here, they are our clients. We have more than 500 such clients. And this is a new phenomenon. Green power was never cheaper. So 10 years ago, our earlier customers used to be early adopters saying, okay, if it's green, even if it's like, similar costs, I'm happy to shift. But grid power keeps getting more expensive and green power keeps getting cheaper. So as a result, as of today, with no investment made by the consumer, it's 30% cost savings, plus, it's a good thing.
You would say, for example, you set this up on-premise and
it's
off-site as well?
off-premise. It's off-premise.
All of it is off-premise, or there is some in the...
So we have about 14-15% of our business is on-premise, so which is, you could loosely call it rooftop solar for large industrial companies, but it's only about 15% of our aggregate volumes.
So the way it works is you will put in the investment, and then you will maintain it as well.
It's our investment, it's our plant. Okay. We have, on average, a 23-year contract. We have 1,600 contracts, so different tenures. Average is about 23 years. And we sell the energy so produced. So to a corporate customer, they don't have to make an investment. They've got an assured rate, which they know is cheaper.
Is negotiated, or that is usually, it comes up for renegotiation, the tariff rate is...
No, it's fixed for 23 years. So it's not open to renegotiation. So we have 0% of our sales on merchant basis. So we don't do anything on merchant. We do only long-term contracts. Okay. Very diversified portfolio because it's 500 plus clients and 1,600 plus contracts.
Okay. Just a quick question. I remember you telling me that 43% of your contracted capacity is for data centers and AI. And I was just Googling. There is a partnership between CleanMax and, say, a company like Google as well. Right? So tell us a bit about your AI data center pipeline. What does this 43% move up to?
So a big personal thanks from me to Sundar Pichai, who was in India last week, and in his interview mentioned about Google's partnership with CleanMax for energy. Great timing, Alec. Thank you. But 43% of our volumes is with data and AI, and this has exploded in growth. As of March 24, we were doing about our contracted volumes with data and AI was 250 megawatt. It has risen nearly 10x to about 2,400 megawatt by October 25. So 1.5 years, 10x growth. And what we are seeing is that data and AI energy consumption requirements, both in India and all over the world, are just from a different planet almost.
How does it work? I'm assuming these data centers have to run non-stop with backups, etc., right? Yeah. Whereas solar, etc., will be dependent on...
So the way we work is we do not impact the reliability of the power consumer because we are not providing the wire into them. The wire into any consumer is provided by the power distribution company. We upload our electricity. Suppose for a plant in Maharashtra, we are uploading ours in, say, Nagpur or Sholapur, and the consumer may be in Pune or Mumbai. Right? So we upload in a grid somewhere and the consumer downloads from his existing grid connection. So we do not affect the reliability. But yes, for data centers, it is always a mix of wind and solar power. Solar gives you more daytime, wind gives you more evening and late night power output. And therefore, about 25% of our capacity is wind and 75% is solar.
What about data centers? I'm assuming they would have sort of arrangements for baseload power, thermal, etc. And this is additional in that sense, or?
Every consumer is a consumer of the power distribution company, right? And they do pay fixed charges to be a consumer, and that's what you pay for having the ability to take power.
Okay.
So we affect on the variable charges front. So we are 30% cheaper on the variable charges on a fully landed like-to-like comparable basis. And for data center, typically we would be meeting 60 to 75% of their energy requirements.
Okay, and very quickly, BESS, battery energy storage system, you all would have that as well?
We're beginning to integrate those into our power plants because as technologies evolve and storage becomes cheaper, it's becoming cost effective, for instance, to make solar power, store it in the day, and give it to people at peak when their pricing is also more. So in a nutshell, guys, the share of green in direct corporate procurement in 2019 was 4%. It's risen to 7.5% in 23, and continues to grow because the value proposition to the customers is great. It's 30% plus cost savings, no investment for doing the right thing.
All right. Thanks a lot, Kuldeep, for coming down. Wishing you, the team, all the very best with regard to the IPO. And on listing, we'll push you a little bit more for future guidance. But thanks a lot for joining in.
Thank you, everyone. Cheers.
All right, let's just quickly take stock of the IT stocks. Last week, we had a big fall in IT names. And this morning, despite the green on the screen, the Nifty IT index is still down about 1/3 of a percentage point. So quick word what Jefferies has to say. They say despite the 16% fall in Nifty IT on a year-to-date basis, stocks still offer more downside than upside. They've downgraded Infosys, HCLTech, Infosys to a hold. They've downgraded an LTI Mindtree, Hexaware, and a TCS to an underperform. So some of the target price and the way it's come down will come up for you on your screen. On TCS, the target price has been cut by 32%. On Infosys, the target price has been cut by 31%. On HCLTech, it's cut by 26%. And despite that, Jefferies says that the target price is lower than the current market price by 13% for TCS, 5% for Infosys, about a 14 and 19% respectively for TCS and Tech Mahindra. So even after cutting the target price by 25-30%, there is still some downside that Jefferies sees. Sagility, Coforge, IKS remain their top picks because of higher earnings growth expectations. Only 3 buy ideas, and these are some of those BPO names in the healthcare space. And the key reason is they're saying that the IT stocks continue to trade at a premium to Nifty despite delivering slower earnings growth than the Nifty since FY17. And that chart will come up for you. They're saying from FY17 to FY28, the Nifty grew at 12%. IT index grew only, IT earnings was only up 9%. From FY22 to FY26, Nifty went up 10%, but the IT growth was only 6%. And yet the IT index trades at a premium, and that premium needs to get corrected. And plus they say that it trades at a 32% premium to Accenture, which perhaps makes no sense to Jefferies. So they see valuation derating and further downside from here on. Nagraj Shetty is now joining in from HDFC Securities on the show. Nagraj, thank you very much for joining in. Well, good start to the week. The Nifty is above 25,700. Do you think for the near term, the trade on the upside has played out, or do you see more momentum?
I think Nifty is stuck within a range of around 26,000 at the higher levels and 25,400 at the lower levels. Market rising geopolitical tensions, highly volatile market is showing some kind of a range moment. I think having bounced back from the lower range of around 25,400 levels, the market is expected to reach towards the upper range of around 25,900, 26,000 in the near term.
Stocks?
Yeah, I have two stocks from the long side. Even broader markets are showing some signs of upside momentum. First one is from PSU banking front. PSU banking as a sector has been in a tremendous move. And even the stock like a PNB has witnessed a sharp breakout recently after a consolidation movement. And overall chart pattern is indicating there is a possibility of certain more upside in the near term. Currently trading around 132.3. One can look to buy at this point of time. Immediate upside target would be around 140. One can place a stop loss at 128. Second one is from a realty front, that is Hemisphere Properties. This stock has been showing a larger consolidation pattern over the last couple of months. Currently faced the resistance around 200-day EMA, moved up above that level, sustaining above that level. Overall chart pattern is looking positive. Currently trading around 143.60, 144 levels. One can look to buy at this point of time. The immediate target would be around 152. One can place a stop loss at 138.
Okay, all right. We'll leave it there. Thank you very much for joining us and running us through those trading ideas. 150 odd points on the Nifty is what you have. So it's a decent looking screen all told. Manisha is here with commodities in focus. What's top of mind in just a bit. Stay tuned.
Fly Emirates, fly better.
Welcome back. Let's talk commodities now. Manisha is joining in as always. Manisha, hi. What are you looking at?
Well, I'm looking at the safe haven buying that the precious metals seem to be indulging into. So you have the gold prices, which have gained up 1.5% in the Asian markets right now. We are trading at around $51.50 an ounce. This is a 3-week highs coming back in case of the gold prices. The profit taking or correction clearly has been quite short-lived. In any case, $5,000 an ounce is where the gold prices have been meandering, and we've seen gains come back into this one. If you look at on-week basis, then we are seeing 4% of gains for gold, and on the yearly basis, 20% of gains is what gold has given you till time. Silver clearly surging in right now, 3.5% up in the markets therein. And we're looking at nearly 15% of gains in case of silver prices. And silver has outperformed gold yet again in this year with 22% of gains YTD till time there. Well, it has to do with the weak US data, whether it was the GDP numbers, inflation, jobs data. All of that has been quite supportive for the gold and silver prices. And then it all has been about the US president's statements over the weekend announcing raise in global tariffs from 10 to 15%. This is for the next 150 days. And this is under Section 122 of the US trade law, which allows just about that much. And that is exactly what the US president has done. Well, apart from that, it also is about those tariff agreements. There are reports on how Europe has halted confirmation of trade deal with US. The India-US negotiation at finalizing interim deal also seems to have been postponed. So some buying coming in because of that as well. And then it is about US and Iran. That is the major area where you have seen various asset classes continue to take cues from. So from where we stand right now, well, there are fears of potential US military strike on Iran. Both countries, even as they are headed for a negotiation, seem to be building their military presence on ground therein. US and Iran, in the meanwhile, are headed for a third round of negotiation in Geneva, and this is on 26th of Feb, which is a Thursday. Iran has said that it is ready to make concessions in nuclear program, but what Iran seems to be getting stuck on right now is it's asking for lifting of sanctions and understanding on its right to enrich uranium. So that is going to be the conversation when both the countries meet on 26th of Feb there. Having said that, it also is an interesting report that has come in from UBS. They have hiked 2026 price target for gold to $6,200 an ounce. We are just about $1,000 lower from where that target seems to be coming in from. But UBS says that they are expecting record demand for 2026. Remember, in 2025, the global demand for gold was a record 5,000 tons. Expectation is that you could be looking at that number exceeding. There is strong central bank buying. There is strong investment buying as well. The safe haven buying. All of that continues to support gold.
All right. Thanks very much, Manisha, for that. So, yeah, gold back above 5,100. Silver seeing a jump, and that's at about $87 or so. So, precious metals back in focus once again. Markets, by the way, not doing all that badly. 160 points up, 25,730. Advanced decline was one way in the morning as we started, but it's now closer. About 1,700 up and about 1,200 lower is the NSE overall advanced decline ratio. Still positive, but the gap's closed. IDFC is down 18% now, so at about, 68 odd rupees on IDFC, and 18% lower, yeah? 18% lower. AU Bank is down 6.5%. Low here was about 950. And that's the other one. UPL is down 12%. So these are the three news-related names all down and out. HAL is down 2.75%. Had a bit of a bump up lift from the lows recently. The low was about 3,900 and went up all the way to about 4,300 3 days back, but back around 4,000. Godfrey Phillips had a massive move last week. It's giving back some of it. It's down about 7%, Godfrey Phillips. There is Avanti Feed, which I think had a very good week, the last one, which it's giving back some. Coforge is down about 2.5%. It's kind of sinking to new lows. There is Gokuldas Exports, which is down 2%. So, the textile thing is now playing out. Textile 772 on Gokuldas. And I think Pearl Global, the management we spoke to, maybe we'll be able to put that stock up as well to see where Pearl Global is at right now. In the morning, it was flat to slightly higher. All right, time for a quick commercial break here. On the other side, Lata speaks with investing veteran Vetri Subramaniam, now CEO of UTR AMC, and of course, markets, tariffs, uncertainty, all of it. So that's a special conversation coming up.
You want to talk business? Meet me in the onboard.
Welcome back. We are sticking with markets because they're so compellingly important now. Most Asian markets, including Indian markets, have almost in a celebratory mode because of the attack on Trump's tariffs and the Supreme Court even questioning his authority to levy them. More broadly, I mean, not just the over the weekend impact, even more broadly, if you looked at 2025, both global growth and global equities have actually done well, despite the geopolitical challenges. Of course, India underperformed. But where does all this leave us here on? I'm joined by a veteran of the markets, Vetri Subramaniam. Now, in the last 25 days, he's Managing Director and CEO of UTI AMC. Good morning, Vetri. Many congratulations on the new appointment. Though I will have to say that I will make you wear your older hat of CIO every now and then because the markets are so compelling.
Good morning, Lata. Delighted to be here in this new avatar. But in some senses, yes, you can't take the fund manager out of me. But I'm not involved in fund management directly. That's the prerogative of the FMs now.
Okay. No, I take your point, but we will still want your thoughts. Actually, now, how are you looking at the Indian markets now? We did underperform a year of 2025 when actually many global markets and especially global economy has actually been doing well. Now, do you think we are on the cusp of something better? How did you read the Q3 earnings, etc.?
Right. So I would, sort of submit that actually after 3 very strong years of earnings growth, both 2025 and 26 in terms of earnings growth have been disappointing, just relative to our own past trajectory, as well as relative to the kind of expectations, investors had from the Indian economy in terms of the earnings growth that could be delivered. 2026 looks like it will end up with single-digit earnings growth at this point of time. The good news, Lata, going into 27 is that fiscal policy, as we all know, has turned extremely supportive, whether it was the GST cut, whether it was the income tax cut a year ago almost. And then on top of that, you also have a monetary policy which has turned quite supportive over the last year. Now, what does this imply for earnings growth? It's a very simple correlation. I think the likelihood of nominal GDP growth being in the double digits is much better this year. And that in general should make the environment much healthier for companies in terms of earnings growth. So I do think, growth will be better in 2027. But having said that, the market is not particularly cheap. So we'll still have to sort of navigate what I believe are the crosswinds, both from valuations as well as some of these other factors that dominate the news flow, and I'm sure we'll talk more about that during our conversation.
Absolutely, I'm coming to that as well. See, I agree with you that on the earnings front, this double-digit nominal GDP, and we will know more about it on Feb 27th when the new series of GDP is announced. But that is, of course, a tailwind. How are you looking at tariffs? All Asian markets are up today, including ours. Would you say that there is a general relief that the tariff syndrome, the ability to levy tariffs itself has been weakened by the US Supreme Court? So the worst is behind us on that front at least?
I'm not sure we have that kind of clarity at this point of time. I think it's a chess game which is still deep in the midsection, so it's very hard to figure out what the next few moves will be. Obviously, it has been a signature policy of the current US administration, and they've been able to use this power under the IPA to great effect in terms of getting to, push countries around, being able to enter into, fast track negotiations with them. Now, this being struck down obviously makes it a little bit more difficult. But I would just say that, there are other routes available to them. I think they've already talked about this. So we are sort of stuck in the mid game over here. And I think the larger point, Lata, is that it's very easy for markets to sort of, either get excited or get disappointed in the very short term. But the larger element here is that for businessmen, you are completely out here in limbo because you don't have an agreement that gives you the visibility of taking large investment decisions about where and how you would like to manufacture and how you would like to serve global markets, including, of course, the US market. Now, this is not particularly unique to India. I think this is a challenge which entrepreneurs and businessmen across the world are facing right now, that they don't have a sense of what does the playing field look like because all of it is continuously being renegotiated. And it's not good when entrepreneurs have so much, lack of clarity. They tend to hold back on their investment decisions.
Vetri, I heard this, paraphrasing your statement, argument, exactly like this a year ago. I mean, there was Chetana here. There were so many people telling us that, the way in which everything we believed in terms of WTO has been uprooted and thrown. Remember last February, Liberation Day and all that. But actually, 25 turned out to be a very good growth year. So I'm just wondering whether this equation we made between uncertainty and investment didn't work out at least last year. So, I mean, we may be proved wrong and it could get worse, but it hasn't hurt so far. In fact, we have seen very good, GDP growth as well as earnings growth. Okay, let me come to...
I can just parse that in two ways, Lata. One is you didn't see the impact in the US because of the AI-related boom. So the fact that the old economy stopped doing stuff didn't show up in their data. And as far as India is concerned, anyway, exports is not the main lever of our growth. So it's only the marginal case that we are talking about. We are not talking about it halting the whole economy. I mean, this kind of thing would have a more dramatic impact, let's say in a Vietnam or a Malaysia or those kind of countries which have much higher trade, goods trade, and much higher trade dependency on the US. For India, it's a very limited factor.
I take your point entirely. In fact, there were some noises in the morning saying positively that because we know for 150 days it's going to be 15%, maybe there will be even, advance booking. And we may actually see a very good trade number for whatever it is. But the rupee is stronger this morning.
And Lata, but just to clarify, equities don't price themselves based on 150 days of earnings. They price themselves based on, 5, 10, 15 years of earnings. So, market being up 0.5% to me has nothing to do with the tariff.
Doesn't
it could
prove
be
anything.
up 0.5% irrespective of whether this whole tariff decision happened on Friday by the US Supreme Court or not.
I agree with you. I agree with you.
In the range of normal daily volatility.
Take your point. Okay, Vetri, let me therefore get back to earnings and valuations, which are more longer term. Where do the two meet for you? Where are earnings looking good and where the sectors are not yet priced to perfection?
Sure. So let me just parse that two ways, because we also talk to a lot of the global investors. We manage $3 billion of assets for global investors, predominantly in equity. And I think for them, the challenge remains that India's valuations relative to other markets, both EM and developed, is still at a premium, whereas the earnings growth numbers are still not showing the kind of momentum which they would expect to see in a market which is priced where India is. Now, having said that, the relative gap that Indian valuations had to other EMs has come off quite dramatically. So I must say, incrementally, people are, willing to at least sort of start engaging in discussions regarding India, but I'm yet to see it converting into flows. If you break that down into an Indian context, Lata, to me, one of the key things at this point of time is that if you really want the economy to start to fire a little bit more in terms of earnings, it comes back to animal spirits, and it comes back to what are the trends we are seeing in terms of credit growth. So when I see credit growth numbers coming into the low teens, I think that's a great thing, because look, in the short term, credit is fuel for the economy. And if you've got credit growth which can hold up in the low teens, relative to where nominal GDP growth might be, that to my mind is the most powerful fuel. And for that very reason, I still continue to believe that, banking and financial services is the direct play on a sector which will benefit, where your starting valuations remain reasonable, not as cheap as maybe they were a year and a half ago, but still very, very reasonable relative to their double-digit growth prospects and, reasonably healthy ROEs across the board.
You've handed me a question on a platter. Now, in banking itself, one of the themes that has played out over the last 6 months, maybe even 1 year, is public sector banks have done much better than private sector banks, both in terms of P&L and in terms of performance in the stock market. Valuation gap has narrowed. Does that continue?
I prefer to treat that as stock specific. And, again, as I said, I don't do fund management anymore. But my own recommendation to anybody would be is select the stock on its merits. We have seen some of the public sector banks demonstrate very strong metrics over the last few years. So I wouldn't use the ownership lens to determine where to position portfolios. You could do that based on the individual characteristics of those institutions, both in terms of the strength of the balance sheet, the extent to which their non-performing loans have been sorted out, and their ability to grow on a self-sustained basis without requiring equity infusion. So I think you see those characteristics both in the private and public sector space, and there's no reason to distinguish just based on ownership.
No, I can take this battle for long, but we are out of time. Can you just, give us the best top three in terms of the within the BFSI space itself? Private banks, I won't give you ownership. Banks, NBFCs, insurance companies, and other market infrastructure companies. How would you grade them? Which would be your best?
Sure. The way I look at this is again from a valuation template. If you look at it from that point of view, I think banks and NBFCs pretty much come over there on top. And maybe after that, you would also get some of the insurers, which remember have done nothing for a while. Capital markets is actually a slightly trickier place because I think all of them are trading on the back of very strong tailwinds, including the market intermediary businesses. So I think over there, growth has been good. Many of them are annuity type businesses. Some of them are monopoly type businesses. But at the same time, starting valuations are not particularly exciting.
Okay, yeah, and then there's a big one which will also list, so there'll be competition for that as well. Final question, since we are talking about market intermediaries, you yourself now are the CEO of one such institution. The issue was in the Q3 numbers with that big one-off payment, 109 crore payout. Is that overhang over? Or will that persist? Because pensioners everywhere are up in arms for a whole host of reasons.
Yeah, whatever was related to our VRS and some of the other, one-time changes that we had to do have all been accounted for in the past 2 quarters. So there is no more, one-offs that will pass through the accounts. Remember, we also had to provision for the labor codes, which, almost everybody in the corporate sector had to do. So I think all of that is behind us. And, we think the business is in a good place. It's a strong team, technology, processes. And we are quite excited about being able to tap into the growth opportunity as more and more Indians look to sort of plan for their financial future. As we say, our role as an institution for 60 plus years has to be to enable Indians to have a better financial life. And that's the path down which we will continue to move.
Okay. There's so much I haven't asked you in special investment vehicles, funds that are being launched, AIF, challenges from people like Grow. There's too much more to discuss with you. I'll take a rain check from you for another interview very soon. Thank you very much for joining us, Vitri.
Thank you so much, Lata.
Okay, that's the word coming in from one market veteran, somewhat positive that the earnings cycle is looking better. Wrap up on Bazaar on that note. Chartbusters coming.
IDFC First Bank uncovers an employee fraud to the tune of around 590 crore rupees, constituting of 25% of its estimated profit for FY26. The stock slumps nearly 20%, even as the management says that the issue is localized and the bank will be comfortable to absorb the hit. Shares of AU Small Finance Bank slump as Haryana government seeks information on suspected unauthorized transactions in accounts. The company maintains that there is no indication of fraudulent activity yet, but continues an internal review. AU Small Finance Bank as well has been deep impaneled by the Haryana government.
UPL will consolidate its global and Indian crop protection businesses into a single entity, which will be listed on the exchanges. The stock slumps even as the management tells CNBC TV18 that this restructuring will unlock value for shareholders.
And Axis Bank clarifies on rumours of it looking to pick up stake in Credit Axis Grameen, says it has neither submitted nor plans to submit any such offer. The stock is one of the top gainers on the Nifty. Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And the markets are green today. A couple of one-off incidents in the broader markets is causing the mid-cap index to trade in the red. But otherwise, pretty good-looking screen with the Nifty at around 25,700 odd. Hey, Mangalam.
Hi, Nigel. It's a good-looking screen. The question is whether we go past the initial resistance of that 25,750 to 25,800 mark or not, and whether that happens towards the second half of trade and where the market goes from there itself. All of that will be the key monitorables along with what takes place in the AI world as well. And we have, the uncertainty around tariffs. So let's see where that goes. Speaking about AI, the L&T and NVIDIA have entered into a partnership to build a gigawatt-scale AI factory. Seema Ambastha, who's the CEO at L&T Vyoma, joins us now to discuss this venture. Thanks a lot, Seema, for joining in. Congratulations. And if you could give us a sense on, a little more on what is the kind of partnership that you've announced, what is the investment that this will entail, and in terms of production timelines and revenue that would be recognized, what would it be?
So the partnership, you're aware, as per the press release.
Yes.
So it's a gigawatt. We are building capacity for the country. We are building capacity for India and for the globe. So that's what it's all about right now. It's too early to talk about other things, but yeah, I can in general give you more information on how this whole thing is going to shape as far as the India capacity is concerned, which is currently pretty low. And the idea is definitely there's a lot of strategic leverage from a compute standpoint.
Yes.
So it makes sense to build some real good capacity for the country.
Okay, all right. Hi, ma'am. Good morning. Good to see you in. This is Nigel on this side. From an India standpoint first, how do you see our data center capacity move up? Point number one. Point number two is, what proportion of that would you like to be a part of? Currently, what is the game plan? Say in the next 5 years, where do you see your role in this data center capacity building here in India?
So that's a good question. So currently we are at 1.3. Expect this to be 10x. So nothing less than 10 gigawatt in the next few years, next 4-5 years. So that's a very, very critical, crucial, tremendous amount of investment. And for L&T Vyoma, it means a lot. Actually, we are looking at least 10% market share immediately. So you can imagine 10 to 10% market share is pretty big. That's how the gigawatt factory announcement also is relevant. So the immediate would be about 250 megawatt to roll out, specifically on the AI and ultra high density data center space. So this is the plan, and this is across the cities, across markets within India, which is Chennai, Hyderabad, Bangalore, Bombay, and these are the major markets.
What is the kind of investment that you will have to make on this?
Yeah. It's interesting. So see, the investments are to the tune of 7 to 10 million per megawatt. So you can actually make an intelligent guess what it means to invest and what would it mean, in terms of revenues, right?
What are the typical asset turnover ratios of these factories?
As asset turnover per se is like, so 7 million is what I expect it to be, like per megawatt of data center capacity. So it'll be like multiples of that for the infrastructure. So it'll be at least like a 10 times multiple for infrastructure.
All right. And what is the timeline for, you putting those capacities on stream? And by when does this get recognized in your reported numbers as revenue?
So let me tell you, the first 28 megawatt of capacity is already live, and the infrastructure for that will go live as soon as we can, get the rest of the contract in place, right? So we are targeting something like end of this year to have the B300 go live about 12,000 to 14,000, which by December, so that we can recognize at least 4 months for this year.
Seema, if I got that number correct, 250 megawatt is the initial rollout, right? And going by the capex that you're giving us, that should entail around $2 billion approximately, 16,000 crores, very, very roughly.
So a couple of things, right? The first 28 megawatt will go live in this year, and subsequently the rest of the 250 will go live, because those you still need the data centers to be ready.
Right. So then the peak capex for this 250 will be around 16,000 crores.
Yes, it will be. You're right. Your calculation is more than right. Yeah.
Got it. All right. No, you told us to do the math, so we said let's oblige. All right. Seema, let's get to a couple of other aspects then. There's another listed company, E2E Networks. If I'm not mistaken, L&T has close to around 19% in that company. What role that one needs to play in this entire scheme of things? And is there a plan to go ahead and acquire an additional stake in the company?
So additional stake in the company is the board's decision, but let me tell you, what does it have? They have a strategic role to play, right? Two things. They continue to sell the capacity that they already have in the Chennai data center of L&T, so that they do it. That's about 3,000 GPU capacity, which is already available. And post that, we have an MOU. We have already signed an MOU between the two of us. So they will also take some capacity from us, what we are, the B300 that we'll bring online. So that's another thing. So whatever capacity they need, they will start leasing from us.
All right. This is one agreement that you've signed.
Like really quick time to value for market.
Understand that. Seema, just a final question. This is one partnership that you've tied up with NVIDIA. Is this exclusive? Are there any other more similar agreements underway which you could do with some other players as well?
So that's a good question. As of now, we have looked at NVIDIA, but yes, anything else relevant like the other players, which is for inference or any other, we will explore it. It depends on what the market needs, right? We are building a complete sovereign AI capacity for the country. So we'll continue to respond to the market. One of the most important things now is to look at building capacity for the training workload, and then, of course, for the inference workload. So we will first leverage whatever is, in demand, and then explore the others.
Okay, all right, Ms. Seema, we appreciate you joining in. Wishing you and the team all the very best. It's going to be a big role to play. Y'all have a big role to play in this data center capacity, and India is on its way to, increase capacity by 10 times. So it's going to be rather interesting times. Thanks a lot for joining in. We'll keep touching base. We keep re-inviting you on the show, and you give us a sense in terms of the progress that y'all are making. For the time being, let's shift focus to our special segment. We get you a few ideas for profit, right, every day from Money Control Pro. So let's go across to Anubhav Sahu, who's joining in to talk about a stock that he's tracking closely. Anubhav?
So we are talking about Galaxy Surfactants, which is the leading oleochemical company. Now, in last few quarters, stock has been impacted by a number of headwinds like US tariffs, slowdown in urban consumption, and high cost of key raw material, that is fatty alcohol. Now, few of these challenges are getting rectified. Firstly, trade settlement of India and the US, followed by the US Supreme Court pronouncement on tariffs, help Galaxy re-access the US market competitively. Now, this positions Galaxy well to scale back its US business. Secondly, urban consumption appears to be holding up post GST rate cuts and other fiscal and monetary measures. Companies also getting ready for the reformulation demand by some customers for their value portfolio. Now, reformulation refers to clients' preference for surfactants based out of crude oil derivative feedstock, which are enjoying significant price differential versus the fatty alcohol route. Now, in this regard, companies are waiting approval from the key client, which can help it regain market share. That said, company continues to face competitive intensity in the Egypt business, which makes them look for alternate markets like that of Africa. However, valuation is enticing with the free cash flow yield of 5%. Given long-standing relation with the MNC customers and strong balance sheet, a stock provides interesting opportunity to accumulate, in our opinion.
All right, that is Galaxy Surfactants. We had the management join us last week as well. The stock did well post the management commentary. We'll take a short break, come back on the other side. Vidya Sankar Krishnan, who is the leader at M&M Forgings, joins in to discuss the company's future growth outlook.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. You're watching us here on Chartbusters. Let's get chatting with the management of Forgings. Vidya Shankar Krishnan, who's the chairman and MD, joins us now on the show. Remember, we will focus on the volatility in US tariffs, their domestic business, what they plan to do with Europe, and the kind of capacity utilization that the company would be doing going forward. Thanks a lot for joining in. It's been a long time since we spoke, so a lot to catch up on and perhaps a lot to extract out of you for the future as well. Always a pleasure speaking with you. Let's start with the current capacity that you have, the current capacity utilization. What kind of volumes do you intend to do in FY26 and FY27?
First of all, thank you for having me on your show, and hi to you, Mangalam, and Nigel as well. Yeah, so we are looking at about 76,000 tons of capacity in this year, which is almost the same as what we did last year, maybe a couple of thousand tons extra relative to the previous year.
So that's the volume. 76,000 tons is the volume that you're doing. This against your capacity of over 130,000, if I remember correctly.
On a capacity of 120,000 tons as we speak, which would go up to about 150,000 tons by end of H1 of next year. So against this means H1 of FY27, which is about 9 months from now. So we are expecting our capacity utilization to easily get into the 6 digits. To get into the 6 digits next year, and that's what we're targeting. But we're very sure that we'll cross 85 to 90,000 tons.
Okay, all right. Hi, Mr. Vidya Shankar. Good to see you in. It's been a long while since we chatted, sir. I just want to caution you with regard to this guidance because you run a very good business, but sometimes you're a little too optimistic. But we're going to hold you this number, 85 to 90,000 tons for the next year, with the probability of going to around the 6-figure mark, which is 1 lakh tons. We'll keep an eye out on that. Few basic questions. First, with regard to the exports, what proportion of your exports go to the United States? And post this tweaking of tariffs, what tariff are you going to pay, as of now?
Okay. We are currently exporting about 9% to the US.
Okay.
And our run rate prior to this was about 16%, 17% last year. So exports to the US have almost come down by half, almost. Right. So we're at about 60% levels compared to the previous year. The main reason for that has been inventory at customer end and their markets tanking, and therefore they have cut down their offtake from us. They've started coming in from November, December onwards, albeit at lower levels, and we expect them to come in full from March 2026 and onwards.
Got it.
So we expect a resumption of the US market.
All right, that happens next year.
What about, sir, the tariffs, sir? What are you paying right now? There's been plenty of tweaks here and there, one section or the other, what is exempt, what is not. So for your 9% that you're exporting, what kind of tariffs are you paying? And is there any change post what we heard over the weekend?
First, we aren't paying any tariffs. Our customers are bearing the tariffs.
Right. What is that, sir? How much are they paying?
I'm coming to that. All our contracts are presently FOB or CIF. So customers are bearing the tariff. First. Second, we understand that they were paying close to 50%. And the 50% is on top of about 2.7% of tariff that existed prior to all this tariff additions. Now, the 50% tariff got revised to somewhere between 18 and 25% based on the India-US deal. Now, we still do not know where we stand as far as that deal is concerned. But however, we do know that we come under Section 232. Under 232, the tax, the duty on export of forgings from India is expected to be 25%. Now, we do not have a clue on how much the trade deal would affect 232 or not. That is something that the fine print will come. And still now, we and our customers are keeping our fingers crossed. So I would say that we would swerve to around 25% plus the earlier 2.7%, or it could be as favorable as 18 plus 2.7% or something in that range, subject to final print.
All right. This is a conversation that merits a longer discussion, but that we'll keep aside for now, because when you say the customers pay that 50%, typically you may have to also reduce your prices to some extent to make it comfortable for them to pay that 50% as well. And now that's coming down to 25%. You will have probably the wherewithal to increase your prices a little bit as well. All these factors are fairly nuanced, but what can you tell us about your margins? And secondly, the Europe business as well. Europe, if I remember correctly, almost accounted to 15-16% of your sales as well. Now with the India-EU FTA being signed, will that see a jump too?
Yes, we are seeing strong offtake from Europe. Plus, with the addition of our 16,000 ton press, we are in discussions with customers to add bigger parts over there. So Europe business looks stable for now with an upward bias. US very clearly starts off with an upward bias because of the resumption of business from customers there, owing to their demand appearing in their radar. And not just small, they expect 2026 and at least up to Q3 of 27 to be very strong years for the Class 8 markets.
Okay.
So both are considerable export markets look pretty strong as we speak.
Got it, sir. Machine forgings as a percentage of a mix is how much?
Right now is about 51%. Has slid slightly. So that's basically product mix, and also offtake from the US dropped. So it's a mixed bag. Has dropped about 50-51%. We are looking at that going up over time. And next year, we don't have our projections yet on what we are targeting. But I would say it should go back to the previous year of 54% and start to move up to a targeted level of 65%.
Got it.
Presently, most orders that come in are machined. Very few orders are for raw forgings.
Got it, sir. Very simple question before we let you go. This year is going to be flat in comparison to last year, but you are sounding optimistic about FY27. You can take a pause and then answer me. For the coming year, can you look at revenue, say, closer to 2,000 crores? And what should the margin band look like, sir?
The pause is like, kaun banega crorepati, is it?
Sir, crorepati to your shareholders will become, sir, if you perform. You're running a good business, as we know, good pedigree of promoter, but numbers are not coming by. So leave us with those two numbers.
Sure. I'll take a little bit of time to answer your question. See, we reached 1,500 crores levels about 2 years back. 1 year, I could say, was a pause year. That usually happens. But this year, I mean, FY25 was also a dull year. FY26, we should have definitely seen much better. Few factors went against us. One was some customer programs which are large, got postponed by more than a year. And a couple of programs that we were launching also got postponed by about 7 to 8 months due to internal reasons. So the good thing is that all these programs are live more than anything else. So all these are coming. We have invested close to 1,000 crores in the last 5-6 years. All that is coming good now. And therefore, we are pretty strong. And we would, on our outlook, we are expecting at least something in the region of 1,800 plus for the coming year. And definitely, I've taken a bit of input from you, Nigel, from the previous cycle. So we are very cautious about this number and very certain.
1,800 crores with margins around the 17-18%. Fair?
Margins would be upward biased. I would say 17-18% should be a reasonable.
Appreciate you joining in, sir. Wishing you all the best.
I have a couple of other points to make. Nigel, 1 minute.
Yes.
Nigel?
Go ahead.
Yeah. See, we have seen some upticks in power and labor costs, and we are working hard to claw back on both. On the power side and on our interest costs, we made some headway, and we are expected to save something in the region of around 40-45 crores in the coming year, at least, with regard to power and interest. So those are likely to be appearing in the full year from April onwards.
Beautiful.
That would be pretty positive for the organization in FY27 and beyond.
Taking that point, sir, on board, and that's why you're sounding optimistic about FY27. All the best for the remainder of this year, and hopefully the tariff situation plays in your company's favor as well.
Thank you, Nigel.
Well, time to slip into a short break. Come back, continue to focus on markets. Don't go anywhere.
Welcome back. The Nifty is holding up with a 100-point gain, but we're still off the highs, and that's courtesy the tech indices. The tech stocks, all of them lower at the low point of trade, as our ticker team is telling you as well. But we'll wrap up on this edition of Chartbusters with a promise to carry the market action forward on trading hour. Stay tuned. The mid-cap index lower. We have the advanced decline as well. Now the lines have kissed each other at 1400 odd, and Nifty as well, while sitting with a gain of 100 points, is off the highs. Good morning, you're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me, joining after a long break, is Hormaz Fatakia. And then we have Ritu Singh as well. Let's see if Hormaz's presence brings good news to the market. For now, it is a 120-point uptick that we're seeing on the frontline index. But mind you, it's a 100-point decline from the highs as well. The crisscross lines will tell you the story of the day. The mid-cap index, which was actually lowered by a couple of individual stocks, which we'll talk about in just a bit at length, is now being worsened by a lot of the other stocks joining the declining list as well. So the crisscross lines have actually crissed and crossed. Let's see whether the red one goes above the green one for the latter part of trade or not. Ritu, good morning.
Good morning, Manglam, and welcome back, Hormaz. It's good to have you. And like Manglam said, we hope, you bring the magic back. We see more of an up move and those crisscross lines actually show more stocks advancing. But for now, yeah, it's the IT pack that is a bit of a drag. But apart from that, you have the Bank Nifty that is, holding up. It's trading with gains of about 72 points. Keep in mind, there's individual stocks that are reacting to some news that's come in, which we will address very shortly. But Hormaz, stocks that are making the news today.
Thank you guys for the welcome, and of course fingers crossed. You'd always hope that the markets continue to do well. They're off the highs of the day but still holding on to gains of around about 100 points. But then there are stock specific accidents, and there are big ones at that UPL being one of them, and the ex Nifty constituent now down 14%. It's the biggest single day fall since March of 2020, and this move has already seen shares worth over 500 crores already being changed hands in the first couple of hours of today's trading session. Now, why this is a significant number is because this is not the kind of turnover you see every day. In fact, even on the 3rd of February, the full day turnover was just 550 crore. So this is just 500 crore plus and counting. The stock so far has seen 35% of the shares traded so far marked for delivery, and courtesy of today's fall, it has extended its losses for the year already in the first 2 months to 18%, and the last time it fell such a quantum was 20% when it declined in 2020. But the bigger casualty of the day today has been IDFC First Bank, and no taking away from the fact that the stock has seen a marginal recovery from the lows of the day, if you could call it that. One point was down 20%, now down 15.5%, still the biggest single day fall since 2020. There are multiple block deals that took place after the fall, and it is after these block deals that the stock has seen a bit of a move up from the lows of the day. And even including these block deals, the shares have, today's volumes have already crossed 3,000 crore for IDFC First Bank, and out of the total number of shares that have been traded, close to 43% have been marked for delivery. And before today's session, that is before today's fall, the stock was trading near its 52-week high, which is at around 87 rupees. On the flip side, though, the one stock that is doing well is Indeed EE Development Engineers. There's a 15% up move in today's session as well. The stock was up 10% last Friday, and now it has also won an order today. It had won an order last Friday, and the sum total of those two orders is almost 30% of its market cap. And today's trading volumes have already crossed 350 crore in just the first 2 hours of the trading session, and these volumes so far are 65% of its free float market cap, which is around 550 crore. And the stock before the up move on Friday and today had retested its IPO price, continuing to rebound from those levels.
Take that point, Hormaz. Thanks a lot for that. A bunch of these stocks which are buzzing, but none bigger than IDFC First Bank, and that is our big story of the day. The sharp fall in IDFC First Bank, and the question now remains on the impact of the same, what it spells for other banks as well. Well, Ritu, first the news flow and the impact.
Well, Manglam, this is a suspected fraud of 590 crore rupees at IDFC First Bank's Chandigarh branch, and that involves accounts linked to the Haryana state government. So a very specific branch and a very specific client that is involved. Now, this issue came to light on the 18th of February when one of the government entities sought to close their bank account with IDFC First Bank and transfer the funds to another bank, and that's when the discrepancies were discovered between the reported balance and the actual fund that was available with the bank. Now, since then, IDFC First Bank has suspended 4 officials. It has informed regulators and auditors, filed police complaints, initiated lien marking on the beneficiary accounts so no more money can be taken out, and KPMG has been appointed to conduct an independent forensic audit. Importantly, the bank says the fraud is very confined. It is not a systemic issue and does not impact other customers even in the same branch. In terms of the financial impact on the bank itself, now 590 crore is the reconciliation under consideration. That amounts to about 28% of the bank's FY26 estimated profit. For context, their third quarter profit was about 503 crores for the month of December, for the quarter of December, and that alone, this number is far larger than that. In capital terms, though, the amount is only about 19 basis points of the Tier 1 ratio, which is at a healthy 14.23%. Now, on the earnings call earlier today, the management did clarify that the core discrepancy was only 490 crores, but this additional 100 crore rupees has been added as a buffer to arrive at that 590 crore rupee figure. Also, the Haryana government deposits, they account for just 0.5% of the bank's total deposits. But since the news has come, 200 crores has already flown out. Now, the issue is limited to one client, but overall, all the state and central government deposits combined is roughly 8 to 10% of deposits for IDFC First Bank. Now, here is the concern, if other state governments also pull out, but right now, the bank is confident that the fraud will not have an impact on their relationships with other governments. The bank has also not yet decided on the provisioning amount. It says the final impact is going to depend on recoveries, insurance claims, legal outcomes, and they termed it as a localized case of an employee fraud that potentially involved third parties. The stock on the back of this has seen the biggest single-day fall in the last 6 years. Jefferies maintains a buy with a target price of 100 rupees, while Investec, which also has a buy, has trimmed its target to 92 rupees from 105 earlier. For now, we'll need clarity on provisioning and what the forensic audit has to say. But for now, listen in to what the management had to say about the whole matter.
Through the reconciliation, we observed that there is a discrepancy of 490 crores. We have additionally estimated rupees 100 crores. That's how it comes to a 590 crores of impact, which we have put out in the press release. We have put out this number as we could best assess at this point of time, but we feel that the number is broadly appropriate to the situation, current situation. We don't anticipate this to broadly move from here on to a great extent. We expect credit costs to keep coming down, and we also expect improvement in net interest margin during the fourth quarter. And hence, whatever is the outcome of this exercise, we should be in a comfortable position to subsume that.
Well, some optimism expressed by the management with regards to the business. The stock still down 15%, but as we mentioned earlier, off the lows of the day. But this could still potentially spell some inflows going into other banks, particularly from the Haryana government, which is in the center stage in all of this. Gaurav is here and he'll help us understand more on this regard. Gaurav.
Well, yes, if you look at the series of events, it's not just IDFC First Bank who is suffering, it is also EU Small Finance Bank. So first, let's understand what has happened overnight. On 18th of February, both IDFC Bank and EU Small Finance Bank received communication from Haryana government regarding their respective accounts with the bank. In fact, EU Small Finance Bank also said that they received a separate communication from department seeking information with suspected unauthorized transactions. Although EU Small Finance Bank has made it very clear that there are no cases of fraudulent activities in the bank, we saw IDFC First Bank actually reporting a discrepancy of around 590 crores. As a result, if you look at the actions taken by state of Haryana, they have actually de-empaneled both the banks, EU Small Finance Bank and IDFC First Bank. Now, what is the quantum of impact if you ask? First is EU Small Finance Bank. They say that the total deposits from the state of Haryana, they stand for 0.4% of their total deposits, specifically the government account. And for IDFC First Bank, the government account, which is from the Haryana, stands for around 0.5% of the deposits. But given that they have been de-empaneled, now analysts believe that these funds will be flown out of the banks and they will be diverted to other banks. Now, there comes a first impact. First is that they believe that it will hurt the agency commission for the bank. But second is that there are some beneficiaries, and specifically in the PSUs in the likes of Punjab National Bank. Why specifically Punjab National Bank? Because Punjab National Bank is SLBC conveyor of Haryana. Now, SLBC is the state level bankers committee, and this is actually the convener is a leading bank which represents each of the states, and that is the reason why they believe that the benefits of the deposits flowing out of these banks can be there in Punjab National Bank first. Second is, again, some PSUs can also gain in the likes of SBI, Canara and Union Bank, and we may also look at some benefits coming up to big private sector banks like HDFC, ICICI and Axis Bank. So definitely we are seeing some impact, and the stock is also reacting in the same way for IDFC First Bank and EU Small Finance Bank, but other banks like Punjab National Bank and SBI may see some benefits, given that some of these deposits will be flown out of these banks and can be flown into these Punjab National Bank or State Bank of India and other banks as well.
Well, yes, Gaurav, thanks very much for taking us through that. You know, everyone from PNB to IOB, Central Bank, they're all up between 3 to, 1% Now, staying with the banking space, though, you have Axis Bank that has clarified to exchanges that it has neither submitted nor is planning to submit any bid for any stake in Credit Axis Grameen. Remember, these clarifications are coming after reports said that Axis Bank was evaluating submitting a bid to acquire promoter stake in Credit Axis Grameen. But keep in mind, speaking to CNBC TV 18 earlier, the bank's MD and CEO Amitabh Chaudhry did clarify that they evaluate every opportunity that comes their way, but they had not shown any interest in Credit Axis Grameen, at least up until that point. Take a look at what he had to say.
These are unsubstantiated comments and baseless rumors. We are, it is incumbent upon us to, definitely evaluate every opportunity that comes our way. We will obviously evaluate this opportunity also, but we are in very, very early stages of that evaluation. We have not even decided whether we'll take the next step. And for media to speculate that something is going to happen tomorrow, day after, 1 month, 2 months, is too early. Our mind we have not been even applied in the early stages of this transaction. So it's all baseless, is all I'll say.
Right, that's a clarification that came in from the management to us here on CNBC TV 18 and thereafter on the exchanges as well. We'll take a short break, come back, focus on the bond markets. Manisha Gupta joins in on Bond Street.
Fly Emirates, fly better.
CNBC TV 18 and India Bonds presents Bond Street.
Welcome back. As promised, shifting focus to the bond markets. Manisha is here with more on this. Manisha.
Thank you for that. Well, yes, we're looking at the government bonds where yields are continuing to stay firm. That was pretty much the case in the previous week as well. Well, it also has to do with the late year borrowing surge from the government. The RBI bond purchases continue, and that perhaps are putting a bit of a lid into the markets there. Having said that, the states plan to raise 445.5 billion rupees in this week. There is central government auctions at 320 billion rupees as well of the 10-year 2035 bond. Therein, the crude oil prices remain near 6-month highs. The US, Iran, potential military strike concerns are still bothering the overall markets. The positive, of course, comes in from the Indian rupee, where we saw nearly 20 paisa of a gain as the Indian rupee opened therein. Well, take a look at the urban infrastructure and the overall municipal bonds. I mean, that really seems to be doing quite well. This is after a long time that we seem to be talking about this one. It started way back in 1967, 97 perhaps, but it has been very shallow, very illiquid, and a market that the institutional buyers perhaps have not looked into. But with the budget now announcing nearly 100 crores in sense of incentives for large-scale issuances, municipal bonds is something that almost everybody seems to be talking about. If you look at the overall numbers then, as of December 2025 for Muni bonds, it is total outstanding issuances at 3,800 crores, and the money raised has been to the tune of 1,000 crores in overall calendar year 2025, with an expectation that 26 perhaps, with all the kind of push that we're talking about, could be doing better numbers.
All right, Manisha, thanks very much for joining in with that. We have to slip into another short break, but don't go anywhere. We're back in just a moment with more on the markets.
CNBC TV 18 and India Bonds presents Bond Street.
Welcome back. You're watching us here on Trading Hours. The perfect time to get you all the updates coming in from the F&O desk. And here's what we have right now. The Nifty is lower off the highs, and that's dragged lower by the IT index, which is again fallen about 1.5%, a little more than that as we speak. And that's put a lid on the gains that we're seeing on the frontline index. The Nifty Bank, which is marginally in the green, also is fairly off the highs, and that reflects why the Nifty is off about 100 points from today's high. And today's high also coincides with both the 50 and the 100-day moving average, which were supposed to be technical resistances, and those are levels that the Nifty has failed to cross and sustain above itself. Even the mid-cap index at an index level is a lot lower, and that's largely because of the big drags that are coming in from IDFC First, UPL and AUSFB. But as the day progressed so far, even the market breadth is split right down the middle. 1450 stocks which are in the red for about 1425 stocks which are in the green. And this is what option writers are playing for as well. Consolidation, inability to cross past important resistance levels, and that has given 25,700 call writers a fair amount of confidence to go ahead and write that one, and the 25,750 call writers as well, equally active. Remember, these options expire tomorrow, so around 25,750 to around 25,800, closer to today's high, we may see some supply emanate once again. But at lower levels, at 25,700 put, there is still a fair amount of writing, and that coincides with the 20-day moving average on the Nifty, which is 25,565. So a rough range, 25,550 to around 25,750 is what the option writers are positioned for. In terms of individual stocks, the PSU banking pack continues to see long build-up. So there are longs added on Indian Bank, PNB, Canara Bank. But one stock which is seeing a fair amount of long positions being unwound is AUSFB. So we'll monitor that as well as we move along today's trading session.
Boy, PSU banks are in a league of their own as of now, and all of these names, be it SBI, be it Indian Bank, all of them have seen at least a double-digit gain in the month of February so far. So 90 points higher on the index, but the PSU Bank index, though, still up 1.5%. Good time to get a chart check from Rajesh Palvia, the technical and derivative research at Axis Securities. Rajesh, good morning. Thank you for joining in. The Nifty has been stuck in this 500-point range, right, between 25,500 and 26,000. Do you see any strength or directional move on either side of this range? Your call on the index and on specific stocks as well.
Yeah, hi, good morning. Yeah, you rightly pointed out. Yeah, throughout the month of Feb, we have seen Nifty stuck in the range itself, and a lot of volatility was there throughout the series. Still, despite of gap up opening, Nifty not able to surpass 50-day moving average, which is attracting major supply zone. Even if you look at the call concentration area, the major call writing activity has been witnessed for 25,700, 25,800 strikes. So these range are likely to act as a major supply zone for next couple of days. Once we able to take out 25,800, then yes, there could be some substantial short covering action could trigger in market, which can take Nifty further higher. But till the time, I think we may remain in the range only. On the downside, the put-based concentration is placed at 25,500, 25,600 zone. So these levels are likely to act as a support for near-term perspective. But Bank Nifty is holding the strength as it's trading above 61,000 mark. So I think if it continues to trade here only for next couple of days, I think we may see further more traction in the Bank Nifty, and once we able to take out about 61,400, 500 zone, there is a potential to extend gain towards 62,000 level also. So stock specific action is there in the market. Nifty and Bank Nifty may remain in sideways trend for next couple of days till this expiry. But a lot of opportunity on the stocks front. PSU banking basket, yes, it looks good. So I think from that basket, SBI, Canara Bank, these two banks are looking promising. Moving to the stocks where we are focusing at this juncture is Lupin is looking quite interesting. Stock is almost trading near to its series high level only. And looking at the data setup, a strong buying action in last couple of days. Stock is moving in up sloping channel. So one can focus on Lupin at this juncture to go long for upside target of 2,300 to 2,340. On the downside, 2,200 needs to keep as a stop loss. And another stock is Polycap. Stock is now negotiating with its multiple supply zone on weekly chart, and looking at the overall structure, we believe that stock has potential to again regain its all-time high trajectory and possible target towards 8,050, 8,100 we may see in the near-term perspective. So Polycab is also buy with stop loss of 78.30.
All right, Rajesh, we'll leave it at that. Thanks very much for joining in with those calls. Now we'll move on to another stock that's been in focus all of today, and that is UPL. The company's announced a restructuring where it's going to merge its global and Indian crop protection business, and the street doesn't seem to like what it's heard. The stock is now down more than 14%. Ria joins in for the key takeaways from what the company's announced and the concerns that the street has had. Ria.
Well, yes, UPL has tanked roughly 14% in today's trade, and this is after they announced that they are going to be consolidating their global and Indian crop protection businesses. They will be, after this, they will be they will be demerging the crop protection business from the existing listed entity, and that will subsequently be listed on the Indian stock exchanges. They have announced the share entitlement ratio in the ratio of 1:1, and the initial merger date will be the 1st of April, and after that the transaction will be completed within the next 12 to 15 months. Now, coming to the brokerage views on this, Nuvama has downgraded the stock to a hold rating with their target price at 816, saying that there will be no material impact on the current leverage overhang. Investec has maintained their buy rating on the stock, and they have said that they see limited immediate increase in the overall valuation versus the current structure of the company. Equirus, however, they have maintained their long rating on the company with a target price of rupees 850, but they have said that the proposed structure provides a day one liquidity opportunity for PE investors upon the listing of UPL Global, but the value creation for minority shareholders remains unclear, and post this restructuring, minorities are expected to hold only roughly 12% directly in UPL Global, and post the Advanta listing, they have also highlighted that UPL will only be left with the specialty chemical business, which has structurally lower margins, so that will be a negative for UPL Limited, and any post restructuring increase in the holding company discount could also lead to further value leakage for minority shareholders.
All right, Ria, thank you for sparing and for that. UPL, of course, the other major casualty of the day following IDFC First Bank, 14.5% lower now on the stock at the lowest point of the day at 645. Take a short break. More on the markets on the other side with Devang Mehta of Spark Private Wealth Management. Stay tuned.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. The extent of decline in the IT stocks actually increases as we speak, and that has resulted in the Nifty actually having fallen below that 100-point mark as well. So right now it's sitting with a gain of just around 85 points, which is a good 120 points off today's high. Nifty, for all practical purposes, at the lower end of today's trading range, and now the advanced decline lines as well. We've seen a firmer movement towards the declining stocks as against the advancing stocks, with 1,500 stocks in the red as against 1,385, which are in the green right now. Devang Mehta, who's the Deputy MD and CIO, Equity NDPMS from Spark Private Wealth, joins us to discuss the market fundamentals and his top sectoral picks. Devang, always a pleasure speaking with you. The last time we spoke, you did like, the discretionary names, you did like the capex names, and you did like, some of the auto names along with financials too. Now, as we speak, in financials, if you could tell us what is it that you specifically like? Is it PSU banks? Is it, large private sector banks? Some of the smaller private sector banks which are now seeing a big correction because of one-off issues? Or do you look at NBFCs, gold financiers, and the capital marketplace?
Morning, Mangalam. Always a pleasure to be on CNBC TV 18. Thanks for having me. I think, yes, very clearly what we are seeing across the markets right now, right? 2025, I'll just start off by saying that and come to the financial market question or to the questions on financials. Very importantly, the entire 2025, the last half of 2024 and the start of 2026 has been a stealth bear market. And why I call this a bear market? Because as I always say, index is just a kissing distance away from lifetime highs. But your market breadth, your stocks above 1,000 crore in market cap, around 1,525 stocks. The median fall there is around 25%. So what it presents itself at this point is a plethora of opportunities across the market cap spectrum, be it large caps, be it mid caps, be it small caps, and there has been correction all around. There has been time correction, valuation correction, and also, of course, the severe price correction. Now, coming to the questions on which sectors do we like? Yes, we don't change that very often. We like a combination of financials, we like a combination of capex, capital goods type of companies, and also discretionary consumption amongst financials. Most importantly, Mangalam, the part is that yes, certain PSU banks look interesting. The private banks also, if you just leave out the last 1.5 year, I think the last 5 years, if you compare it to the valuations that it used to trade previously, I think these are all at valuations which are lesser, and there is enough margin of safety. But most importantly, rather than margin of safety, there is a capital appreciation which people are thinking for the next 3-5 years. I think yes, with all the volatility around the decisions that are taken for capital marketplace, I still sense that the companies like depositories, exchanges, wealth management companies, even certain brokers, there may be volatility. As I say, yes, probably don't hold me for the next 3 months, but if somebody has horizon for the next 2-3 years, this look very interesting. Why it looks interesting? Typically, yes, the financialization wave, and I can't expand more than this, that around 12 crore unique investors, around 21 crore demat accounts, around 19,400 zip codes, where there are only 32 zip codes which don't invest. I think this typically is expanding big time. And my sense that the concept of savings converting to investments and from physical to financial assets, which everybody has talked about, I know it's a crowded trade, but my sense that these companies have the wherewithal to grow at 18, 20, 25% also, some of them. So my sense that capital marketplace followed by certain PSU banks, and of course then certain NBFCs should be your pecking order.
But Devang, the events that have transpired recently with regards to certain private sector banks, does that result in sort of a benefit to PSU banks, especially considering the fact that while most of the private banks are trading at or near their record high levels and also are slightly expensive on the valuation front, PSU banks have had a fairly strong run up as well at the start of the year, but despite that, they still continue to enjoy that valuation comfort.
I think, Thomas, what has happened to this market, to this sector, is that probably I think they have a very clean balance sheet now. They have lean balance sheets. They probably have now all the wherewithal to lend. I think the last quarter, if I'm right, SBI talked about 14% type of credit growth, which they saw last quarter. And my sense that yes, we already reached that mid double digit type of credit growth with whatever RBI is doing. And I think if the word called private capex that also comes back with what type of earnings and what type of management commentaries we heard about, and also government doing its bit again to spur infrastructure in the budget and talking about railways, defense, roadways, railways, ports, airways. I think all these things, if it transpire, then my sense that yes, there will be a new lending cycle which can start, and PSU banks along with certain private banks can also be beneficiary of this. So my sense, yes, the financial aspects would be beneficiaries because of capex, as well as if the rising consumption, both discretionary and non-discretionary, do well, there will be manufacturing, engineering, all this would spur the credit growth as well. So I think yes, PSU banks tend to benefit. They are at valuations which are cheaper than private. That's always the case. But yes, this time I think probably the numbers also support that.
Devang, apart from financials, do you think overall this overhang of tariffs, we'd gone from 50% to 18% in the markets cheered that. Now over the weekend, we've gone from 10% to 15%. But, this uncertainty remains because, this is only valid for the next 150 days or so. Do you think, markets are going to trade with caution? We're seeing some pain in mid-caps already today. But how do you expect this to play out? Or, will we move forward with the base case scenario of 15% staying in?
I think a very difficult question to answer, as we know that every single evening things change, and on the weekend the things change drastically. But of course, if I probably have to take a sort of a guess on this, it's an evolving situation. I think markets are a bit prepared about what's happening right now on the export front. Most of these companies who are into exports, maybe a bit of textiles or leather, and of course IT does not get impacted much by this, but the overall slowdown. My sense that there are so many companies which are more domestic centric, as I talked about discretionary consumption, where aspirational Indian is coming up the curve. That's one sector to play. There is a lot of capex, manufacturing, engineering opportunities where probably yes, it is more of make in India type of companies, and a lot of new age companies. By new age I don't mean companies who are burning cash, but by new age companies my meaning is companies into engineering, semiconductor, manufacturing, cloud, storage. I think there are a lot of such proxy plays in mid and small caps. But as you rightly said, you need to digest the volatility if you are going to be in these companies. But yes, coming back to the question, I think typically we would be more domestic centric in our approach rather than exports, because there are a lot of uncertainties regarding tariffs, and that comes to hamper the companies whenever you are probably taking exposure over there.
Devang, just a final question before we let you go. What are your thoughts on the IT pack? At what point does it become a value buy? Or will you avoid it at any cost?
Mangalam, I think honestly we have gone generally right on this sector, and in most of the client portfolios when I talk about, I might have a company which is into ER&D or a little bit of AI, but we have generally avoided this large cap typical IT services space, and we continue to do so. Having said that, yes, of course the valuations now maybe at around 17, 18, 20 times for most of these companies may look attractive, but whether the 1-3% type of constant currency growth that comes, does that sort of justify the valuation at this point? My sense that, as I said, there are so many good domestic centric sectors where you can still compound your money at 15, 18, 20% and even more in certain cases. Then why probably be into companies where you probably have a I think vision of 10-12% type of growth? Can these companies give you 10-12% type of CAGR returns over the next 5 years? Very well possible. If they go into digitization, they go into a little bit of AI diversification. But as I said, I'll not probably be bold enough to put money here. I want certain evidence that these companies are showing that path. Otherwise, probably we would avoid.
That's perhaps the path down which, a lot of these consumer staple companies are going to as well. 50, 60 times valuations and growing in, at best, mid-single digits for a lot of the larger players. With that, we'll take a short break. Thank you, Devang, for joining in. We'll get you more on the markets on the other side.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. The broader markets, in the red. You also have the frontline index that's still in the green, but it has lost, a few points in the last few minutes of trade. In fact, the bank Nifty slipped into the red. Now it's down by about 22 points as we speak. And the advanced decline ratio as well. You now have more stocks declining, about 1,500 declining versus 1,300 that are advancing. But let's focus on Motherson, the Motherson Group, which has set itself an ambitious target to cross $108 billion in revenue by 2030. Shireen Bhan spoke to the chairman, Vivek Chand Sehgal, and vice chairman, Laksh Varman Sehgal at the foundation day of the All India Management Association. And here's a slice of that conversation with a father-son duo.
$108 billion, that's the roadmap that you've held out for growth by 2030. Why $108 billion specifically? Why not 100 or 110?
Great question. You'll have to ask about 200 executives of Motherson globally as to why they chose 108. I think the sequence is more that total nine is lucky for Motherson. So they didn't want it 105 or 110 or 110. They wanted 108. So I said, why not? So it was also fitting into my belief. So we said, yes, 108, so be it.
So that's how decisions are made, is it?
Yeah, why not? Because it's imagination. You see, the ability just to come up with a number is, you can do it very logically and this thing and all that. But luck always helps, you know. So we've been 18 billion, 36 billion. So everything is a combination of 9. So then they chose 108. So I said, okay, why not? Let's go for it.
Okay, so that's the 108 billion. That is the target that you've set for yourself by 2030. But Laksh, it's a very different company. 1975, it was an entirely different entity, and today in 2026 is an entirely different entity. Again, I don't know how many people recognize the change that's happened at Motherson. From automotive, today you are building and operating India's largest consumer electronic company, is that correct?
Yes, in the component space.
In the component space,
That's right.
as well as pivoting towards aerospace, and a significant amount of your revenue is now likely to come in from the aerospace business. Take me through the pivot that you're now orchestrating.
Sure. I think this was, again, a vision of my father, that in the last 10 years, because we were targeting very big numbers on the automotive side, that we would become quite large for the wallet shares of our customers, because we never want to compete with the customers. So we will never come up with a Motherson car. So if we are hitting those kind of numbers, then the automotive will not be allowed to give us more business, because we have a huge chunk of each car that's there in the market. So Dad said, let's introspect and let's look at what are the other stuff that we can really do, go after. And we did that. We spent a lot of time, and we said that our expertise is what we say DEMO: design, engineering, manufacturing, assembly, and logistics.
Okay, DEMO.
That's right. And that's the platform that we have built. And we said, well, automotive is not our core competence. DEMO is our core competence. Can we take it to other industries? And when we showcased to aerospace majors, the world's best, Airbus and Boeing and consumer electronics companies, which are the largest in the world, they were really quite excited to see the level of capability that Motherson has been able to form through partnerships, through acquisitions, through organic expansion. And we're probably one of the very few companies in India who are listed on the exchange, but only less than 10% of our business actually comes from India. The rest of it is sourced outside, produced outside, supplied outside. So our strength in being able to build resilient supply chains is something which is very, very interesting, and something they're supporting us. And together with their help, that's what the journey we're on. We're on fastest growing aerospace component company. We're one of the fastest growing consumer electronics company. Health and medical devices is going to come next. So
how soon do you get into the health and medical devices business?
It's already started. The first factory is already up, and we're forging a lot of partnerships there as well. So hopefully, more news to come on that front.
We started with the 108 billion aspirational number. Do you believe you're on track to be able to get to that by 2030? Because 2025, you missed the estimate that you would put out for your growth target, but that was also on account of COVID and so on and so forth. But on track to meet 108 billion by 2030?
Definitely. I think the options, the opportunities are there. We have to be the guys who are going to convert it.
While the Nifty is looking to hold on to that 25,650 mark, the broader markets are the ones that are feeling a bit of a heat. The mid-cap index is now down 0.7%. The Nifty Bank has now slipped into the red. So all eyes as we move into what is promising to be an action-packed second half of today's trading session. Take your leave on this edition of Trading Hour from Mangalam, Ritu and me. Thank you for watching. Halftime report on the other side.
Frontline stocks inch up even as mid-cap sulk amid tariff uncertainties and Middle East tensions. PSU banks, autos and healthcare stock gains even as IT and metals drag.
Haryana government bans IDFC First Bank and EU Small Finance Bank over irregularities in its accounts. IDFC First Bank labels its fraud and estimates the variance at 590 crores, even as the EU claims it followed all protocols. The stock slide.
UPL slides after it scripts a split and listing of its crop protection business. that does little to deleverage its balance sheet or enhance shareholder value. The scheme will, however, allow private investors an exit.
The US Supreme Court ruling against Trump's reciprocal tariffs and the consequent imposition of 15% tariff for 150 days puts exporters in a fix. While the reduction in tariff is seen as a positive, it isn't a big shift from the expected 18%. The matter of refunds for tariffs paid also remains a grey area. Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me is Vinny Motiwala. Well, it's turning out to be a day where we are not seeing that much respite for the markets. We're 100 points off from the day's high for the Nifty at this point in time, which is holding up with a gain of around 0.3%. Separately, we have the mid-cap index, which is down around 0.6% at this point, and the Bank Nifty, which is absolutely flattened out. The advanced decline ratio on the declining side, so around 1,900 odd stocks advancing to over 2,100 stocks declining. So overall, you'd have to say it's a little bit of a dull day, at least for the broader markets. And the Nifty has not been able to sustain its earlier gains. Hi, Vinny.
Hi, good afternoon, Ekta. So absolutely right. Nifty is not being able to sustain those gains that we saw coming up in the morning part of the trading session. Given the tariffs, we did see a bit of a jump up in terms of the announcements that came in over there from the US, but then it's given up those gains. Right now, 89-point uptick for the Nifty. But PSU banks, that continues to shine, up almost 1.6%. We have seen autos, that's another one, which is holding on to gains at the trading session, while IT continues to be the top sectoral loser in the trading session. But moving on to the what we have on the show for y'all, we'll put the spotlight on our What's Trending segment. We'll talk about UPL. This is on the back of companies restructuring its crop protection business, and we will also be joined by Elara Securities Prashant Biani for more on this. Then moving on, we'll go across and bring you some discussions with the management of Quality Power on their growth outlook going forward, their Q3 numbers, and what is the trajectory for the company overall in Q4 as well. And in our Movers and Shakers segment, we'll be putting the spotlight and center stage on Cipla, Narayana Health and IT stocks, as well as other buzzers in the trading session.
Okay, all right. So that's what we have lined up in the next 60 odd minutes on Halftime Report today. But let's get to Gaurav, who's going to take us through all of the stocks that are moving around in trade. Gaurav, over to you.
Well, yes, today, if you look at the market, first let's talk about some of the big gainers. And first, we have Morpin Labs. If you look at the company has now bagged a new deal worth 820 crores. And with this deal, they will be also entering into high growth CDMO segment, which is something that the market is appreciating. Other than that, let's also talk about developments. Here also, we are seeing the company received an order worth 170 crores. And that's the reason why the stock is also up high in trade. If you look at some of the volume lead gainers, we have got companies like Indotech, AG's Wopac, BLS International, CIE Automotives and Kitex Garments. All of these companies are not only seeing some gains, but they are also seeing strong volumes. Apart from that, let's also keep our focus on Nifty PSU banks, because if you look at this index, for the last few sessions, we have seen the index actually gaining in trade, and the companies like Indian Bank, Union Bank, Punjab National Bank, all of these are actually leading the pack. In fact, we also have Punjab National Bank in focus on the back of the Haryana government, and I'll come to that. Apart from that, let's also not forget about Axis Bank, because they have made it clear now they will be not bidding for Credit Access Grameen, which is actually taken in a positive way. On the losing side, first let's talk about financials. IDFC First Bank and AU Small Finance Bank. Both of these banks are actually struggling in trade. In fact, IDFC First Bank reported 590 crores of discrepancies, and AU Small Finance Bank, now there is a news flow from Government of Haryana on 18th of February. They have actually de-empaneled both of these banks from the business, and that is the reason why these banks are hurting in trade. UPL is another casualty on the market, and the reason being that they are going to merge global and Indian entities. Now, what is actually hurting the stock is that analysts believe the value creation for minority shareholders, that is actually unclear. If you look at some of the stocks like Godfrey Philip and E2E Network, in the last 5 days, we saw some rally in these stocks, but today it seems that for the last 2 days, we are seeing some kind of profit booking. And lastly, let's also not forget about Nifty IT. Now, the index is not only down almost more than 1%, but we are also seeing fresh shorts actually building up in Emphasis, Infosys, Persistent, TechM and HCLTech. So all of these stocks will be on our radar. For today, we are seeing some pressure again building up in Nifty IT.
Okay, thank you so much for that, Gaurav. Those are some of the stocks that are moving around, but we have a lot of stocks which are particularly moving on the back of some announcements that have come in. And in our movers and shakers segment, we're going to track the stocks as well. First up, Ekta, Cipla is also in focus today. We're seeing a bit of a decline here. What's happening?
Well, yes, Cipla is down around 1.5%. That is because the US FDA has classified the Pharmathane, which is basically the Greek CDMO, their Greek manufacturing facility, as an official action indicated status, which means that there could be a possible escalation of that from a regulatory standpoint. Remember that they are the supplier of lanreotide injection, which is one of Cipla's biggest drugs in the US. It's a cancer drug. And the plant is situated in Rhodope, Greece. Now, remember that we had already spoken about this a couple of weeks ago because, the US FDA had inspected the site and they had issued them 9 observations. So the street was worried that it could possibly escalate. So now, as expected, they've received an official action indicated status. Remember that Cipla had around 22% share in lanreotide in Q2, post the Q3 numbers where their numbers were impacted because of the supply challenges on lanreotide. They said that their partner is remediating their site and for some time there will be no production which will be taking place, and they are hopeful that the production will possibly resume Q4 onwards. So Q4 is likely to be tougher according to them because there is no Revlimid generic sales, there's no lanreotide sales, and the margin guidance is now cut to 21% versus 22.5% earlier. It's been reduced twice this year already. Now the stock is already down around 12% this year and it's down around 20% from its 52-week high. But let's go across to Rima. She joins in to talk about IT. Jefferies believes that IT stocks still offer higher downside than upside despite their 16% fall in 2026. Rima's here with more.
Indeed. So Jefferies sees more downside in Indian IT names, and this is even after the underperformance of the cut that we've seen. 16% gone for the Nifty IT since the start of the year. And according to Jefferies, there is more downside. They've downgraded Infosys, HCLTech, Infosys to a hold, LTIMindtree, TCS, Hexaware to an underperform. And the target price has been slashed quite a bit. In fact, it's more than a 30% cut in the target price for TCS and Infosys, about a 26% reduction in the target price for HCLTech. And even after that, they see a double-digit decline from here on for a TCS, for a Wipro, for a Kotak Mahindra and LTIMindtree. The only buy recommendations that Jefferies has is Coforge, Sagility and IKS. Now, the key reason for that is given what the growth is going to be for the Indian IT companies, Jefferies says valuations are still high. So they're saying the Nifty IT has been delivering lower earnings growth compared to the Nifty now for several years. Yet it continues to trade at a premium. And secondly, even compared to, say, a company like Accenture, the Nifty IT index, so the large cap IT names are trading at a 32% premium, which perhaps cannot be justified. Back to you.
Okay, thank you so much for that, Rima. That's the update on the IT sector. But Ekta, we have Narayana Health also, which is in focus, and the company is diversified into GCCs. That's keeping the stock abuzz.
Yes, absolutely. It's very interesting that they are looking to diversify into global capability centers. So on 20th Feb of 2026, the company has said that they purchased 3.3 acres of land in Bengaluru. This includes buildings and structures. It's located in the southern part of Bengaluru and it's intended for software development operations, and they will house a GCC in that center. But it's a part of the company's broader business expansion plans. Now, the company's diversified strategies earlier as well, for example, which has, however, been, linked to healthcare. For example, insurance. The company launched their first product, Aditi, on 18th June of 2024. It's their first insurance product, which is really tailored for the missing middle, as they call it, at a monthly premium of less than 1,000 odd rupees, and they offer coverage up to 1 crore. So that was their insurance foray that they did in 2024. Plus, they also diversified geographically in terms of healthcare by acquiring that UK-based hospital chain for around 2,200 odd crores. So they have been looking to sort of expand their business beyond Indian healthcare or Indian hospitals, but this would be completely diversifying beyond healthcare, and we'll try and get more details from the management themselves, but that's what they're looking to do. A GCC center is what they're looking to set up in Bengaluru. We'll take a short break, but up next we'll connect with the management of Quality Power to discuss their business. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. As of now, we have some flashes coming at the bottom of the screens for IDFC First Bank. This is from the RBI governor who's saying that there is no systemic risk at IDFC First Bank as of now. So that's just the latest update that we have. Keep an eye out on IDFC First Bank as of now, still down 15.5%. But let's now put the spotlight on Quality Power. We do have the company that reported its numbers, good numbers that came in from the company. We have Mr. Pandian, who is the joint managing director of the company, to talk to us about the outlook of the company, order book, what are they expecting to see going forward. Mr. Pandian, good afternoon. Thank you so much for joining us on the show. Surely a good set of numbers that's coming from the company in Q3. The Mehru acquisition, that has also supported the growth this time. So I want to understand, you've given a guidance of 700 to 800 crores for FY26. You're already at 666 crores. Aren't you being conservative? What is it that you are expecting in terms of Q4 for your numbers?
Very good afternoon, ma'am. Thank you for having me on the show. At the outset, I would like to thank you and our investors and the stakeholders. We're almost close to a year. I think tomorrow is 1 year anniversary of our IPO bell raising ceremony. And we have delivered over 100%. I think this is primarily because we have delivered upon the guidance, and I believe we would like to be conservative on the guidance. We have already upgraded our guidance. I think we should be expecting 900 crore plus for this year. At the margins already indicated. 900
crore plus is what you are expecting for FY26. And margin guidance also is what now? You're 22% plus, right?
I think the floor that has been given right now is 22% plus.
Okay, 22% plus. And Mehru acquisition, the margins are a bit lower, right? So how do the margins move for that? Have they also moved up in Q3, and are you expecting that to continue?
We believe we got them from about 5% to about 16% this quarter in about 9 months' time. Going forward, I believe there will be some improvements in Mehru, but there has been slight copper price and metal price hikes. So at this moment, we are holding good at Mehru's guidance. However, the primary businesses on high voltage power equipments and power electronics have been delivering excellent margins. I believe we are close to 30% on that. And that is how, in spite of all the averages happening, we are still at plus more than 22%.
Okay, and you are taking that 2-3% price hike anytime in this quarter, or when is that coming? Or because of the raw material price increase?
I believe we have factored in most of the bad things that happen because metal prices like copper and aluminium do follow copper, do follow gold. And once the gold prices start increasing, we had already seen metals start inching up, and that's one of the reasons why in Q2 we had held on to our guidance. But I believe the worst is behind us, especially on the metal side. So we do not expect any further surprises, either this quarter or the next one.
Also, you said that the new factory that you all are setting up has a revenue potential of 1,500 crores. What is the timeline of the factory being completed or coming in for the company in terms of revenue potential?
We are about 4-5 months earlier already. We are expecting the trial production to start in June of this year. It will take about 6 months for us to, stabilize the factory with all the approvals, consents, HVDC audits, because this is a global HVDC facility. So there will be eventually global audits. We have already had some global HVDC orders. So that would take some time, but I believe by the end of the year, it will be fully running.
By the end of the year of FY26, it will be fully running.
December would be a good time where we would start seeing revenue spikes from the facility.
Okay. And so in FY27, what would be that revenue that will come in from this one?
I believe a little bit because only 1 quarter would see the full production output. The rest of it would be mostly in audits and approvals because this is a large facility. But I believe for the next year, we should be seeing at least 15-20% growth from our traditional businesses at least.
What is the sustainable growth rate that we could see for the company now with the acquisitions coming in all in, settled in?
We will have more. We have a lot of hunger. We are sitting on a lot of cash. So I would sit with my fingers crossed that we eat a couple of business next year. So at this moment, our guidance would be about 20% for the next year and look forward to see how the year turns out.
Okay, so 20% growth in next year. You're expecting some acquisitions also, given the cash on the books that you're keeping an eye out on. Lastly, there was some concerns, and you had mentioned that there's a supply chain constraint for insulators in Q3. Is that easing out, or that will continue in the next couple of quarters as well?
It's been there for the year. We have stocked up a lot of insulators. We are stocking up on all critical items wherever we see them. one of the reasons why our working capital is getting stretched. But I believe next year or so, we see the supply chain to be a kind of a problem. But fortunately, most manufacturers across the world are expanding in the electrical ecosystem. And once capacity stabilize, I believe things should start easing out by FY28.
Okay. Thank you so much, for joining us this afternoon, giving us an outlook about the company. Hope to speak with you more often as well. Thanks so much for joining in, Mr. Pandyan. But on that note, we're going to step into a very short break. But here's some good news for our viewers. India's business news leader is now a click away, introducing CNBC TV 18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV 18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screens.
Fly Emirates, fly better.
Welcome back. Well, for the mid-cap index down around 0.6%, so good time then to get a technical check in the markets. We have Sudeep Shah joining in to discuss what he's strategizing today. Sudeep, hi, welcome to the show. Well, it's definitely a dull day. We haven't been able to sustain the highs today. How would you strategize?
Post the weekend news of the tariff things launched.
I think there's a little disturbance in terms of your audio, Sudeep, so we're just going to come back to you. Well, overall for the markets, like we mentioned, it is the bank Nifty which is under pressure, but it's really about the broader markets, the Nifty IT index, which is down around 1.2%. And now if you look at it on a year-to-date basis, the losses have extended to around 16.5% currently for the IT index. The Nifty metals also not doing too well today, so down around 0.8% currently for the metals index at this point in time. The top losers, Hindalco and Wipro on the Nifty. We'll do one thing, we'll take a short break, but we'll come back with more. Stay tuned.
Welcome back. Joining us on the show now is Sumit Gupta, who's co-founder at CoinDCX. Sumit, I thank you for joining in. A difficult start to 2026, would you say? Because we've constantly seen all cryptos continue to decline. Bitcoin just about testing that 65,000 right now, all the way down from that all-time high of 126,000 that we saw in the month of October. Well, yes, most asset classes are jittery, but it really seems to be impacting crypto more, would you say?
Yeah, I mean, first of all, thanks, Manisha. Yes, because of the tariff situation, I think all the risk-on assets like crypto has been seeing a decline. But I would say that the volatility in crypto market is lesser than what it used to be before. And I think for an investor who is believing in this for the long term, I think these are opportunities for someone to hold or enter. But yeah, the volatility continues, and because of the global uncertainty. Over time, I do believe that the crypto markets will sort of, once this is all stabilized, if it happens soon, then we'll see a reversal in the market prices as well.
All right. Sumit, a few things that have been good also have happened. A lot of froth has gone down. Meme coins, gaming coins, perhaps is something that nobody is talking about. Instead, it has been institutional buying, stable coins. Clarity Act is what the markets are looking forward to. What is it that you're looking forward to and the changes 2026 can bring in when it comes to this ecosystem?
Yeah, I think excellent question, Manisha. And I think, like you rightly mentioned, this is more signs of matured ecosystem. I think we will see over time the maturity increasing when it comes to either investor profile, like we already seeing from our internal data that the average age of our investors is increasing. So that means that more and more mature investors are entering. It's the asset class is getting institutionalized. That means that more and more institutions globally are increasing their exposure to Bitcoin, Ethereum, and some of the other top quality crypto assets. So I think as any industry matures, I think these are some of the things that happens. And I do see that there are a lot of altcoins or meme coins and some of the coins that does not hold a fundamental value. They will sort of be weeded out from the market, and which in the long term is a great thing.
One thing that the street is looking at is the Clarity Act coming in from US. I mean, that really has been delayed quite a bit, would you say, with all this tariff and trade conversations or narratives that we see from the country?
So yeah, I think clarity was supposed to be passed sometime last year, Q4 of calendar year 25. But I think we're expecting sometime around March, April, May, like over the next 3 months for it to show some momentum. There has been some different opinions between few companies and from the traditional companies, and hopefully they'll get an alignment and we'll see positive news coming from the US in terms of clarity and market legislation coming out pretty soon. So I think all of that will also are good long-term healthy signs of a matured ecosystem. And I think overall we have come a long way from where the industry was 2 years back versus today. And this is just going to be one more big milestone for the industry to see.
Even as the street does watch out for what the US does in sense of Clarity Act, it has to be about the Indian markets as well, where we do hear that the policy framework discussions are again in works. High time, would you say this calendar year could see something come in light?
Hopefully, like I think the right time was yesterday. We are already late in the game. We are already very, very late. The world continues to make progress when it comes to regulations. It's not just US, but many, many other countries, including emerging economies, are looking at regulating the sector and bringing it under the regulatory purview. I think a lot of those things are happening. India should also sort of be active. Of course, there is work happening, but I'm sure that the pace of execution here can be increased, including, I think there was some sort of discussion paper that has not been passed. And a lot of those things are something which I'm sure are works, work happening in the background, but hopefully we'll see some more momentum in the 2026.
Sumit, the big news that came in as the gold prices are making high was from Tether, that's emerging as a big buyer of gold with what USDT is doing. How are you looking at cryptos and real world assets kind of coming together? Would you say, as you mentioned, utility being the next big game?
Oh, yeah, absolutely. I think the world is very much open to tokenizing digital assets. Like, I mean, any asset, financial asset which exists as of today needs to come on blockchain, and tokenization is a big theme emerging. In fact, Tether, which is the company that you just spoke about, is holding large amounts of gold, and they also have a Tether equivalent token, which is what they are bullish on So yeah, and it's not limited to just like commodities, but it's also like any stocks. A lot of those assets are sort of getting tokenized and are coming on chain. So this is something that I'm also seeing a lot of momentum on.
A final question then, and what's your sense on what trends, patterns is India showing and what really needs to be done?
Yeah, in terms of trends and patterns, I think India needs to first align internally and work with companies operating in this sector to align on a broad principle-based framework, include the private sector, and just like how it has done with other sectors, I think that is the first step. Second is to lay down certain set of guidelines which ensures that customers are protected, which ensures that bad actors are not a part of the ecosystem. Number two, number three, it needs to align itself with global regulations because it's a global asset class. We cannot operate in silo. A lot of these global frameworks, whether it is CARF framework, are anyway going to be followed by India in 2027 and in this year as well. So that preparation we need to do, and more importantly, build the capacity internally in the country so that we are able to take full advantage of the technology and various applications coming out of it. Of course, AI is something that India is bullish on, but I think this is also one sector which has very close convergence with AI as well, right? And a lot of companies are innovating in the sector, whether it is in terms of payments or agents handling payments to do certain kind of transactions. So there are big opportunities that are in front of us, but if we don't solve for it proactively and build the capability for it, I think we'll not be able to get the best out of this trend.
Okay. Sumit as well as Manisha, thank you so much for joining us. And Sumit, thank you so much for giving us your insights in the world of crypto as well. Thanks so much for that. But on that note, we're going to step into a very short break. After the break, we'll connect with the management of Narayana Health as the company plans to diversify to global capability centers. Stay tuned in. Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty continues to be around the 25,670 levels. Not much of a move that we've seen since the last 40 minutes when we started the show. IT continues to be under pressure. Now, what's interesting in the last 40 odd minutes, we've seen Ola Electric, that's seen a bit of a spike up coming in. It's up 3% almost in just the last 40 odd minutes. So look at it. Now it's moved to the green. We have Newland Labs, pull that up as well. That's buzzing in trade in the last 40 minutes. It's up almost 2-3% over there as well. So that is seeing some bit of a strong momentum there in terms of a move. Apart from that, some of these other names that you see in the CDMO side are also moving. Cohance Life Sciences, that's buzzing in trade. Like I mentioned, Newland Labs, that's another one that you should keep an eye out on as well as Blue Jet, that's holding on to very strong gains in the trading session, almost 10% gain for Blue Jet today. And this was a stock that had been seeing a fall in the last few trading sessions as well. PSU Banks continues to shine as well. Indian Bank, Union Bank, PNB, all of them among the top movers for the PSU banks. But yes, that's the update there in terms of the market. Broader end of the market continues to be under pressure in today's trading session. On that note, we're going to slip into a very short break and we're going to bring you that conversation with the management of Narayana Health. So stay tuned in.
Welcome back. A tad bit of a recovery for the markets at this point in time. So the Nifty scaled up around 100 odd points now, and we have the mid-cap index, which was down around 0.7% when we started the show. So now it's down around 0.6%. So there's a little bit of a recovery which is taking place on an intraday basis. But the stock in focus is Narayana Health. This is in focus after the company acquired a 3.3-acre land parcel along with its infrastructure in Bangalore. And this basically is to diversify or to set up a GCC or a Global Capability Center. Viren Shetty, who is the Executive Vice Chairman of Narayana Health, joins in now. Viren, welcome to the show. Very interesting pivot. GCC is what you're looking to set up. Just take us through the rationale. Why exactly are you making this move?
Sure. Just to clarify, this is for our internal capabilities. Okay. We run 18 hospitals in India, 15 clinics. We run 20 hospitals in the UK and 2 hospitals in the Cayman Islands, an insurance company, pharmacies, and a software development center. We need a place to house all of this. And the building that we took over in Electronic City was equipped for such a facility. It had data center, it had wiring, it had all the things that we need. And this was built entirely for creating our internal strengths.
You know, I know from past experience that you've always had this technical background to you and this interest in terms of digitizing operations as well. In terms of your interest when it comes to GCC, will it just be linked to only your internal operations, or is it possibly going to be something that you're going to possibly look at in terms of expansion?
No, obviously, these are capabilities that once we perfect it and are able to do it for ourselves, the most logical thing to do would be then to offer it to other hospital groups across the world. There are such capability centers that exist. There are very large US health systems that run GCCs in Hyderabad and Bangalore. There are a lot of institutions in India that cater to them. But for us, we've always taken a Narayana first approach. So our system is not just one that is about moving people from one geography to the other. For us, we get really deep into the operations, really deep into the technology that can improve efficiencies on the ground level. And once we do that, then be able to centralize it from one location.
Okay, so that is a part of the plan possibly, but any timeline in terms of execution of this plan? What is the potential revenue that you might possibly generate from such an idea?
At this point, nothing to state on the revenue that would be generating from this. We generate small amounts of revenue from software sales and providing analytics capabilities to other hospital groups. But for right now, we're entirely focused on centralizing a lot of our core functions across the 3 geographies we operate and being able to drive much more efficiencies for our hospital group. And that's why even though, as according to peers, we may have the lowest realization, we have as much margin as anyone else, purely because we're a lot more efficient at running our hospital, and we want to continue to do so to achieve Dr. Shetty's vision, which is of making healthcare much more affordable than it currently is.
All right. Talking about that vision, Viren, you also have this insurance arm which you set up in 2024. Just tell us about the offtake with regards to Aditi, the first product that you rolled out. And how exactly is the insurance business doing at this point?
Yep. There's been a lot of very interesting learnings about the insurance space. There's been a lot that we've had to reconfigure internally. And we came in with an assumption that this is a system that we could design the best possible product and it would sell really well. But insurance does require a lot more muscle in sales, which we aren't quite good at. And these are capabilities we are developing going forward. But we're very happy with the progress that Aditi's made so far. And we've seen a lot of interest from small, medium enterprises to take over our system of health insurance, which is not just health insurance, but healthcare integrated with that. And so we've pivoted, we've learned a lot, and going forward, we should start to see a lot more uptake. But as of now, we're offering this in our core geographies, Bangalore, Calcutta, Raipur. And over the next 2-3 years, we'll be able to expand it to all the cities where we operate.
Okay. Viren, how much cash do you have on your books now post the UK acquisition that you made recently?
How much debt?
Yeah. What does the balance sheet look like?
As of now, the net debt figures would be about 3,500 crores as far as I last recall.
Okay. You've made this UK acquisition. You've diversified into insurance as well. You've also now looked at, GCC, and maybe that could be a plan for the future. But nonetheless, you're setting it up for your internal capabilities. Just give us a sense in terms of what investors should think of in terms of Narayana when it comes to, say, a 3-year vision of the company. Since you are looking at this geographical diversification, you're looking at healthcare ancillary businesses as well.
I think you used the right word there, diversification. We don't want to be known as just a place for getting surgeries done. We don't want a business that's purely dependent on tertiary level healthcare. There is a tremendous need for that, no doubt. But that is the most amount of money any single person will spend, and a lot of the time that is unnecessary. A large part of our diversification into primary care, into insurance, and to other markets is to build a diversified business that goes after healthcare, starting from prevention all the way to cure. So over the next 3 years, a lot of the steps we're putting into place should play out, and our UK acquisition should be able to show that we're able to turn around the operation successfully. And the new hospital that we set up will be able to break even much faster than we've been able to break even before. And we'll continue to do so at a price that few others can match.
Are you looking at the international businesses possibly being more lucrative as compared to what you're seeing in India? Because your Cayman business is doing well. You're now looking at UK. Are you looking at further acquisitions that we can expect, and maybe a size or geography that you've possibly circled down on?
Nothing as of now. The UK acquisition is pretty sizable for us. And for us, it's not so much about the size of the acquisition or the opportunity set in the market. It is more about what we add to the hospital. With Practice Plus Group that we took over, we realized that we can do a lot of change in their back-end operation, in their clinical excellence, and being able to invest in the business to help them grow. So with the vehicle that we have, we believe it is sufficient for us to meet the needs of proving that we add value.
Okay. All right. Virenu, we're going to let you go on that note. Thanks very much for joining in and speaking with us and talking to us about your new foray into GCC, which is at this point for internal capabilities, but something that they would possibly think about in the future as a healthcare business that they would possibly provide to other hospitals. On that note, it's also a wrap on Halftime Report. Business Lunch will take all of the action forward. Stay tuned.
Frontline stocks inch up even as mid-cap sulk amidst the tariff uncertainties and the Middle East tensions. PSU banks, auto and healthcare stocks gain even as IT and metals remain the big drags.
Haryana government bank bans IDFC First Bank and AU Small Finance Bank over irregularities in its accounts. IDFC First Bank labels it a fraud and estimates the variance at 590 crore rupees, even as AU claims it followed all protocols. The stocks slide.
UPL is down 15% after it scripts a split and listing of its crop protection business that does little to deleverage its balance sheet or enhance shareholder value. The scheme will, however, allow private investors an exit.
The U.S. Supreme Court ruling against Trump's reciprocal tariffs and the consequent imposition of 15% tariff for 150 days puts exporters in a fix. While the reduction in tariff is seen as a positive, it isn't a big shift from the expected 18%. The matter of refunds for tariffs paid also remains a grey area.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Patakia. With me, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormuz. It's great to have you back in the studio after 2 long weeks. But, if you take a look at the markets, right, we've got the blue chips that are still managing to hold in the green, but not so much luck for the broader markets.
Indeed. Thank you for that. First up, the Nifty 2, actually, as a matter of fact, you can call it presumably the lowest point of the day now for the index. 25,640 is where the index stands. So from gains of around about 180, 200 odd points, the index is now down to gains of only 70, and that is showing up mostly because of the Nifty Bank that was earlier holding the index higher but has now cooled off from the highs of the day. And of course the IT stocks as well. A lot of the broader market names though are the ones. The mid-cap index is down around 0.6%. It continues to hold on to those losses. There are stock-specific accidents that have taken place all through the morning, be it IDFC First Bank still down 16, UPL down 15, AU Small Finance Bank down 7, HAL down 4. A lot of these news flow driven names are the ones that are actually the highlight if you take the index out of the picture.
Absolutely, as you call them, stock accidents, right? But if you take a look at the sectors that are doing well, leading the gains are PSU stocks. That index is the top sectoral gainer. We've got Indian Bank, Union Bank, and Bank of Baroda, all of them gaining over between 1 and 2% in the green. We've got those auto stocks that are also doing well. We've got Bharat Forge, Eicher Motors, M&M, all of them gaining between 1 and 2% as well. But those IT stocks, they're extending their losses. No respite there. We've got Coforge, Infosys, Emphasis, if we can pull up those stocks for you, all of them in the red between 3 and 2% lower. But like Hormaz mentioned, I'm not going to go over it again, but in stock-specific action, we've got UPL that tanked, we've got IDFC First Bank, AU Small Finance Bank, all of them down in trade today by a large margin.
Indeed, and that is, of course, our big story of the day, right? IDFC First Bank. And the question now remains on the impact of the fraud that was detected and what it spells for other PSU banks, for that matter. Let first decode the news flow and the impact and listen in to what the management had to say from the conference call today.
First Bank has disclosed a suspected fraud of 590 crore rupees at its Chandigarh branch that involves accounts that are linked to the Haryana state government. Now, this issue came to light on the 18th of February when a government entity sought to close its accounts and transfer the funds to another bank. And that's when the discrepancies were discovered between the reported balance and the actual funds that were available. Now, since then, IDFC First Bank has suspended 4 officials. It has informed regulators and auditors, filed police complaints, and also initiated lien marking on the accounts to prevent any further outflow. KPMG has also been appointed to conduct an independent forensic audit into the matter. But importantly, the bank believes this is an isolated issue and the fraud has happened with the connivance of some of the bank employees, but that this is very much confined to one branch and one client account. In terms of the financial impact on the bank, 590 crores under reconciliation is a significant amount. It amounts to about 28% of the bank's FY26 estimated profit. In capital terms, the amount is just about 19 basis points of the Tier 1 ratio, which stood at a healthy 14.23% as of December. Now, on the earnings call, the management has clarified that the core discrepancy was only about 490 crores, and this additional 100 crores has been added as an estimated buffer to arrive at the final 590 crore rupee figure. Also, the Haryana government deposits account for 0.5% of the bank's total deposits, and since then about 200 crores has already seen outflows. But the overall state and central government deposits combined form roughly around 8 to 10% of IDFC First Bank's deposits, and that's where some of the street's worry is, whether we will see more such flows out of the bank towards perhaps PSBs. But IDFC First Bank is confident that the fraud will not have an impact on their relationships with other state governments. Now, the bank has not yet decided on provisioning and says the final impact is going to depend on the recoveries, insurance claims, and the legal outcomes. But on the back of this, the stock has seen its biggest single-day fall in the last 6 years. Jefferies maintains a buy on IDFC First Bank with a target price of 100 rupees, while Investec, which also retains a buy, has trimmed its target to 92 rupees from 105. But for now, the investors are going to watch for provisioning clarity and the findings of this forensic audit.
Through the reconciliation, we observed that there is a discrepancy of 490 crores. We have additionally estimated rupees 100 crores. That's how it comes to a 590 crores of impact, which we have put out in the press release. We have put out this number as we could best assess at this point of time, but we feel that the number is broadly appropriate to the situation, current situation. We don't anticipate this to broadly move from here on to a great extent. We expect credit costs to keep coming down, and we also expect improvement in net interest margin during the fourth quarter. And hence, whatever is the outcome of this exercise, we should be in a comfortable position to subsume that.
Let's also hear out what the RBI governor had to say on the fraud at IDFC First Bank. Take a look.
As a policy, we do not comment on any individual bank or regulated entity. We are watching the developments. There is no systemic kind of an issue over here.
The other stock on our radar is UPL. That stock has fallen over 14% and is under pressure after it announced a restructuring. It has announced the merger of its global and Indian crop protections businesses. Ria is here to tell us more and tell us why that stock is falling.
Well, yes, on Friday, UPL had announced that they are going to be merging their global and Indian crop protection businesses into UPL Global, and that will then be demerged from the existing listed entity and then subsequently be listed on the Indian stock exchanges. The share entitlement ratio for this is 1:1, and the initial merger date has been set for April 1st, 2026, and the transaction after that will be completed within 12 to 15 months. And UPL Limited, which is the existing listed entity, will continue to operate in the seeds and specialty chemicals business. Now, on the back of this, a lot of brokerages have come out with notes on the company. Nuvama has downgraded the company to a hold rating with a target price of rupees 816, and they have said that there will be no material impact on the current operating overhang of the company. Investec has maintained their buy rating with a target price of rupees 925, and they have highlighted that they see limited immediate increase on the overall valuation of the company versus the current structure. Equirus, however, they have maintained their long rating on the company with a target price of 850, but they have said that the proposed capital structure provides a day one liquidity opportunity for private equity investors upon the listing of UPL Global. And however, they have said that value creation for minority shareholders remains unclear at the moment, and post this restructuring, minorities are expected to only hold roughly about 12% directly in UPL Global, and a bulk of their exposure will be continuing via UPL Limited, where a holding company discount may apply. And after the listing of Advanta, which is the seeds business of the company, UPL Limited will remain with the specialty chemical business of the company, that is Superform, which holds structurally lower margins. So that will be negative for UPL Limited. And after any post restructuring increase in the holding company discount may also lead to some value leakage for minority shareholders. And on the back of this, the stock has tanked by roughly 15% today.
15% lower now on UPL. Ria, thank you for that. Earlier we spoke to the management. Listen into what they had to say.
So UPL One shareholders will continue to have their shareholding. That will be mirrored in the merger with UPL Domestic. and then the global business will merge into that. So there will be no loss. They will just get shares in the pure play crop protection business, which will create value for the shareholders, and they will continue to have the shareholding in the UPL Limited, UPL One company. So this will be incremental shares they get. They will not have any value erosion. When you unlock the value, they will see the value improvement through the ownership in Advanta and Superform, and the residual shareholding in the residual shareholding in UPL Global, which is a crop protection business. No, there is no plan for any of that right now. So UPL, like a normal listed company, the promoters have to follow the guidelines, and so we are just following that, and the promoters have no interest in selling down any shares in the company.
Another stock under pressure is HAL after news reports suggested that the Indian Air Force has decided to ground the Tejas fleet. Let's go back to Ria for more on this. Ria?
Well, yes, HCL is now at the day's low, down nearly 4%, and this is after a PTI report that suggested that the Indian Air Force has grounded the entire fleet of around 30 single-seat Tejas LCA jets after a crash that occurred earlier this month, and the IAF is reportedly going to carry out an intensive technical probe into the matter. Now, remember, the incident occurred earlier in February during landing after a routine training sortie, and the preliminary probe that has been conducted, that points to a suspected onboard technical glitch. Now, keep in mind that this is the third Tejas aircraft lost since the induction into the IAF. The first one was in March of 2024, and the second occurred in November 2025 during the Dubai Air Show. As of now, there has been no confirmation from IAF regarding the grounding of the fleet, and HCL has also declined to comment on the matter, but the stock nonetheless is taking a hit in today's trading session.
4.5% lower now on HAL, hurtling down towards the lows of the day. Ria, thank you for that update as well. Take a short break and get you more on the chaos and uncertainty surrounding US President Donald Trump and his tariff agenda on the other side. Stay tuned.
Welcome back. You're still with us on Business Lunch. The U.S. Supreme Court on Friday struck down the global tariffs imposed by U.S. President Donald Trump. President Trump lashed out at the Supreme Court, calling the 6 judges who ruled against tariffs as a disgrace to the nation and Trump after initially announcing a 10% global tariff post the Supreme Court decision. He raised the global tariffs to 15% on Saturday. Let's take a look at this report.
U.S. President Donald Trump on Saturday said he will raise a temporary tariff from 10% to 15% on U.S. imports from all countries, the maximum level allowed under the law. The move is in response to the U.S. Supreme Court's decision to invalidate his previous tariff program that it said exceeded his authority as president.
The Supreme Court's ruling on tariffs is deeply disappointing.
The new levies are grounded in a separate law known as Section 122 that allows tariffs up to 15%, but requires congressional approval to extend them after 150 days. Trump, in a social media post, said he would use that period to work on issuing other legally permissible tariffs. French President Emmanuel Macron on Saturday weighed in on the U.S. Supreme Court's ruling.
First, I think this invites everyone to reflect. It doesn't seem bad to have Supreme Courts and therefore a rule of law. For those who think Supreme Courts create problems in political life, a Supreme Court looked at the Constitution and said, this is not in line with the Constitution. Now everyone says this is great. There you go. It's good to have checks and balances in democracies.
Trump has shown little sign of backing off his global trade war. In the hours since the court's 6-3 decision, he has attacked individual justices in personal terms and insisted he retained the power to impose tariffs as he sees fit.
Let's now also hear out what U.S. Treasury Secretary Scott Bessent had to say on the Supreme Court decision and the way forward for the tariff policy.
This administration will invoke alternative legal authorities to replace the IEEPA tariffs. We will be leveraging Section 232 and Section 301 tariff authorities that have been validated through thousands of legal challenges. Treasury's estimates show that the use of Section 122 authority, combined with potentially enhanced Section 232 and Section 301 tariffs, will result in virtually unchanged tariff revenue in 2026.
So what happens to all the trade deals signed so far? Here's what U.S. Trade Representative Jameson Greer had to tell CBS News.
I've been telling them for a year, whether this case, whether we won or lost, we were going to have tariffs. The president's policy was going to continue. That's why they signed these deals, even while the litigation was pending. So we're having active conversations with them. We want them to understand that these deals are going to be good deals. We expect to stand by them. We expect our partners to stand by them. And I haven't heard anyone yet come to me and say the deal's off. They want to see how this plays out. I'm in active conversation with them on it.
And following the U.S. decision on the Trump tariffs, President Trump in a media conference confirmed that deals with other countries, including India, stand as is. Listen in to what he had to say on the India-U.S. deal.
The India deal is on here.
Thank you so much, Mr. President.
All the deals are on. It's just we're just going to do it a different way.
The framework which is to be signed with India sometime soon, will that stand now? And on the decision,
changes.
Nothing changes?
No, nothing changes. They'll be paying tariffs, and we will not be paying tariffs. Our deal with India is they pay tariffs. This is a reversal from what it used to be, as you know. India, and I think Prime Minister Modi is a great gentleman, a great man, actually. But he was much smarter than the people that he was against in terms of the United States. He was ripping us off in India. So we made a deal with India, and it's a fair deal now. And we are not paying tariffs to them, and they are paying tariffs. We did a little flip.
After the Supreme Court struck down Trump's tariffs under IEEPA, the Indian delegation's visit to the U.S. for talks over the India-U.S. deal has been cancelled. On that note, it is time for us to head into a short break. For more news and stay tuned for more news and updates on the other side.
Fly Emirates, fly better.
Welcome back. Now, the United States and Iran are scheduled for another round of talks to be held in Geneva on Thursday. The development was confirmed by Oman's foreign minister via a post on X. Now, Oman hosted the previous round of talks on its soil and has also helped coordinate the latest round of talks between the two countries. Now, this comes even as US President Donald Trump continues with the military buildup in West Asia and threatens action on Iran over signing the nuclear deal.
Absolutely. And if you take a look at the market, the Sensex and the Nifty about 0.3% in the green, managing to hold its levels over there, about 25,659 on the Nifty. But the broader market's feeling the pain. The mid-cap index is down over 0.5%, while the Nifty Bank is holding absolutely flat, but with a slight negative bias. And it's the PSU banks leading from the front. But with that, it is a wrap on this edition of Business Lunch. Mid-cap radar takes all the market action forward.
Hello and welcome to Mid-Cap Radar on CNBC TV 18. I'm Ekta Batra and with me is Mangalam Malu. Well, it's turning out to be a day where we've stabilized our losses, it seems, at this point in time. So the mid-cap index is currently down around 0.5%. The Nifty, however, is off the day's high but is not building on any of its strength at this point in time. So just about at around 25,668. The day's high was around 25,771. So we've not managed to recoup back at those levels. But overall, advanced decline ratio also a little bit on the declining side at this point in time. Overall, you'd say there's a recovery from the day's low, but nonetheless, we could do more.
We could do more. There's always room for more. So let's kickstart the show with all the top stories that we're tracking this afternoon. Sensex and Nifty inch up even as the mid-caps sulk amid tariff uncertainty and West Asia tensions. PSU banks, auto stocks gain even as IT, metals and realty drag.
The Haryana government bans IDFC First Bank and AU Small Finance Bank over irregularities in its accounts. IDFC First Bank labels it a fraud and estimates the variance at 590 crores, even as AU claims it followed all protocols. The stock slide.
Shares of Narayana Health trade with gains after the company acquired Bengaluru land for GCC expansion. Management tells CNBC TV 18 that GCC expansion is for internal capability and the company are entirely focusing on centralizing core functions.
Morpen Labs surges on trade on the back of 825 crore multi-year global CDMO deal. The supplies for agreement is expected to commence over the next 4 to 5 months with execution scheduled through Q1 FY27.
And shares of UPL trade with steep cuts as the company's restructuring plans fail to cheer the street. And Nuvama downgrades its stock to a hold rating, citing recent run-up and unresolved leverage concerns.
Okay, so those were all of the top stories that we're tracking at this hour. But let's get to our segment mid-cap movers, where we have Gaurav to take us through all of the mid-caps which are moving around in trade today. Gaurav, over to you.
Well, as if you look at the broader market, it seems that Nifty is not able to hold on to the gains that we have seen in the morning. But from the mid-cap, we have seen certain stocks who are not only gaining, but we are also seeing strong volume. So first, let's talk about Morpen Labs. The company actually bagged a deal worth 800 crores. And with this, they are also entering into CDMO space. And that is something which is exciting the market. And at the same time, development. There also we saw order worth 170 crores which was received by the company, and that's the reason why the stock is up. But other than that, we've got companies like Bluejet Healthcare. Currently the stock is locked in its upper circuit and it was led by high volumes. Let's also not forget about stocks like AG's Vopak Limited, BLS International, CIE Automotive, Skytex Garments. All of these stocks are currently actually having gains and also having higher volumes. On the losing side, let's talk about IDFC First Bank and AU Small Finance Bank first. Now, for IDFC First Bank, they have already reported the discrepancies of 590 crores in its deposits. But at the same time, let's not forget that both of these banks have been de-panelled by the state of Haryana for any businesses. And that is something which is actually taking a toll on the stock price. Let's also not forget about UPL. Now, Street is a bit concerned about the value creation for minority shareholders, and that is something which is hurting the stock. And let's also not forget about Godfrey Philip and E2E Network. Now, these stocks, we have seen in the last 5 days, a large trading activity was happening and people actually gained also, but we are seeing some kind of fall in these stocks. On the 52-week losing side, if you look at the companies like HCLTech, Tata Elxsi, Suzlon Energy and Mankind Pharma, all of these companies actually hit its 52-week low. But on the winning side, let's not forget about Nifty PSU banks. This index have been gaining and we are seeing stocks like Indian Bank, Union Bank and Bank of India. All of these companies actually hit its 52-week high. So all in all, it is looking like a mixed picture for now, but Nifty PSU banks definitely taking the gains that we have been seeing for the last few days.
Take that point, Gaurav. Thank you so much for that. Nifty PSU Bank is the one which is raking in all the moolah. We do see some sort of selling coming in a couple of the names, which is actually keeping the Nifty Bank lower as well. But let's speak about the banking and the financial space itself. Rishi Anand, who's the Managing Director and Chief Executive Officer at Aadhar Housing Finance, joins in. Obviously, the three key focus points of this conversation would be whether the cost of funds will improve going ahead for the company. What is it that they're doing in their non-housing portfolio for growth, increasing their contribution, and disbursement growth by and large? Will that pick up as well or not? Thanks a lot, Rishi, for joining in. Let's start with your non-housing business itself. You said that from its 27%, your target is to take it to about 30% in the medium term. If you could give us a sense on what categories are you tracking and what would the ratios in terms of your margins, yields, and credit cost be in your non-housing portfolio going forward, and what that would do to your overall numbers?
Great. Thank you, Mangalam. Thank you for having me. Yes, you're right. We've indicated a 27% is what we are today on our non-housing portfolio. The breach point, given that we are a listed housing finance company, the breach point is kind of 70-30. Actually, as per regulation, it is 60% on the balance sheet. But if you were to convert that into pure home loan, non-home loan, it becomes 70-30. So we are very close to the breach point, and at no given point in time, we would want to breach this 30%, which effectively means that over the medium term, which is 1 to 3 years, we will inch up 1% each and take it to about closer to 30%. Now, which is the portfolio which comes in non-housing finance for us or loan against property for us is the similar segment that we cater to. It is the lowest strata of the society, average ticket size hovering around 8-9 lakhs. So that's the consumer we cater to. In terms of credit cost, it will be today on the overall book, we are about 23-24 bips. And if you look at standalone loan against property or non-housing loan, it will be around 27 bips. So that's the segment we are talking about.
Okay. Mr. Anand, hi, welcome to the show. If you could just give us more details in terms of the risk profile that you have and what exactly the asset quality might be looking like, both for your housing as well as your non-housing portfolio, and the trends that you can guide on.
Okay, hi Ekta. Yes, I will. When I talk about the consumer profile, it is, as I indicated, it is the lowest strata of the society. We're talking about salaried and self-employed consumers. And if I can indicate with some examples, I would cater to, I will give salaried consumers can be drivers, kirana stores, you would have police constables, you would have government school teachers. So that's the segment I cater to. On the self-employed side, it will be the lowest level of self-employed individuals in the society, which can be vegetable vendors, saloon shops, kirana stores. So that's what I lend to. Now, if you were to split this between home loan and non-home loan, risk-adjusted spread, if I can use that word, risk-adjusted spread will be anywhere between 300 to 350 bips. Indicatively, on an GNPA basis, my home loan will give me a 0.9 to 1% GNPAs. And if I look at non-housing loan, it will be anywhere between 1.1 to 1.2%. So while there is a differential about 20 to 30 bips on NPA, risk-adjusted spreads will be upward of 300 bips.
Right. What would you, speak about the cost of funds? There have been rate cuts which have been announced by the RBI. The outlook is fairly contained when it comes to inflation as well, with a mild upward bias, but nothing to suggest that there could be a big jump in cost of funds. Where do you foresee this going forward, and how do you see that as impacting your cost?
So, Mangalam, it's a combination of multiple aspects. How much of my borrowing is MCLR linked, how much of borrowing is repo linked. If you talk about what has happened over the last few quarters, a total of 125 bips repo reduction has happened. Has that actually translated into getting me a cost of fund benefit? I would say close to about 47 bips is the benefit that I have got, because most of my loans, about 60% of my borrowings is linked to MCLR, and the pass on is yet to happen. If I look at the cost of fund, as I indicated, 47 bips benefit has come, and we've already announced that 15 bips out of which is going to be passed to the consumers. The way we look at the cost of funds as we go ahead, I think another 15 to 20 bips pass on the MCLR is due and should happen over the next 6 to 9 months.
And will all of that be directed towards passing it on to consumers, increasing your disbursement AUM, or you would keep some for yourself and increase the NIMs as well? If you could give us an outlook on both.
Yes, so the way it operates, Mangalam, is 75% of my asset side is floating in nature. So whatever comes in eventually is passed on to the consumer, keeping OPEX in mind. The transition time is close to about a quarter. That's how the transition happens. I don't think for floating customers the intent is to keep anything for my NIMs. Today I have healthy NIMs of about 9.4%. We will continue to maintain that even as we go ahead. So whatever comes in on the floating book will be passed on to the consumers.
Okay, all right. So you're expecting your net interest margins to be at that 9.4%.
Yes, and I have always indicated on your show also that any upward of 9% is always what we will maintain as NIMs.
Okay. All right. Mr. Anand, just leave us with some guidance for credit growth going into FY27. The reason I ask is that, we had quite a push in terms of affordable housing when it comes to the budget. So overall, based on what you're seeing, what is your estimate in terms of credit growth going into FY27?
Okay, so the way we look at our business is, an AUM growth of anywhere between 20 to 22% is what we had guided for this year, and we are right on track. Even as we go into the next financial year, that is the kind of growth, 20 to 22% growth on AUM, and close to 20% growth on profits is what we are looking at. And if I were to look at these numbers on a medium term, we are saying we will double our book from here on, at least cross the 50,000 crore mark in the next 3 years.
All right, we take that point, Rishi. All the best for all your targets that you have. May you achieve them before time, and then we connect once again for you to give us fresher targets and continue to grow on your company itself. So that was the management of Aadhar Housing Finance. What we'll do is take a short break on that note and come back. On the other side, we will have Abhijit Akela, who is the analyst at Kotak Institutional Equities. He'll focus on, obviously, the specialty chemical sector and the important demerger that was announced on Friday, UPL, whether that will have an impact on the stock price or the kind of sell-off that we're seeing on UPL, is that justified or not?
Welcome back. Well, for the markets, a couple of stocks stand out, and Morpen is one of them. Remember that they've received an order worth over 800 odd crores from a global pharma company. And that's the reason why you're seeing the stock spike up so much, up around 18 or 19% at this point in time. Remember, the street was possibly sensing to something, considering that the stock has already rallied around 35% this month itself. So very good going for Morpen Labs, where they have said it's one of the most significant orders that the company has ever received when it comes to the API CDMO space. And as you can see, the stock is being handsomely rewarded for that. But nonetheless, let's talk about UPL. That's not the case for UPL this afternoon. To talk more about this as well as the entire chemical space, we have Abhijit Akela, who's the analyst at Kotak Institutional Equities. He joins in from the sidelines of the Chasing Growth 2026 conference. Abhijit, thanks very much for taking the time out. Well, what is worrying the street when it comes to UPL, which is planning this restructuring of, merging its global and Indian crop protection business?
Yeah, hi, Ekta. Good afternoon. So I think the main source of disappointment with regard to UPL has probably stemmed from the fact that there is this, holding company structure creation. In other words, the stake in the crop protection business that is being spun out and demerged and going to be listed separately over the next 12 or 15 months. That stake does not entirely come directly to the, public shareholders, but there's actually a significant component, about 2/3 of that stake, that is going to be held through UPL Limited. And then that gives rise to the usual, holding company structure, which in turn entails some kind of holding company discount and all of that. So I think in the context of, the expectations that had been built in with regard to value unlocking and the fact that the stock had already done pretty well over the last year or so, the structuring of this demerger perhaps has come as an incremental disappointment to the street.
So do you think that with this 15% sort of downtick that we're seeing on the stock, a lot of the disappointment has been priced in, it's been reset already, or do you think there's more to go?
That question is very difficult to answer because unfortunately, as we all know, holding company discounts can vary very widely between companies, and we've seen, these range anywhere in the region of, say, 20-25% at the low end to, in some cases, they can go as high as 80% or even higher, depending on, obviously case to case, whether the company has, how much of a stake it has, how much of an operating business it has, and various other criteria. So I think, that question is a little bit difficult to answer at this point in time. We'll have to see how it goes. My own sense is we may not yet be, fully factoring in the impact of that. But a lot depends on, maybe any next actions from management with regard to the structure and those sorts of things.
Has the management been communicated to that, the street is possibly a little uncomfortable with it? There are concerns with regards to this particular restructuring?
I think, management themselves are very cognizant of, the possible drawbacks that arise with such a scheme. I'm sure they've already been engaged in discussions with the analyst and the investor community over the last several months. Ultimately, they had to make a choice between the various options they had on the table. And I think what is very important for the company at this point in time is to provide an exit to the private equity investors that have been invested in the company pretty much all the way going back to 2019. That was the first time when a couple of the leading PE firms came in to help UPL with its acquisition of Arista Life Sciences. So it has been a long journey. There's obviously some inclination on their part to require an exit. And I think that perhaps is, the main consideration at the forefront of the company's mind at this point in time. As regards, the possible drawback, which is the creation of this structure, I'm sure they've evaluated various options, but in summary, they seem to have concluded that this is perhaps the best that they can do, at least at this point in time. Of course, we'll have to see if, there is any change in thought process that arises as time goes by.
Right. Abhijit, have you reviewed your call on the stock? Have you had a chance to? And what is your rating right now?
So we've actually, we haven't changed our rating or our fair value at this point in time. We've had a sell on the stock for quite a long while. And actually, I felt that the right time to do that would be perhaps once further disclosures are made available in terms of the valuation reports, which are expected in the next few days, I believe, once regulatory approvals are received. And then, some further other statutory disclosures. Once those come in, I think people will be able to take a more informed view regarding the valuation and what to do.
All right. And beyond UPL, if you could give us a sense on, some of the companies that may benefit from the US-India trade deal agreement that has happened at 18%, notwithstanding the current uncertainty around that 10 to 15% sort of mark. A lot of chemical companies which are underperforming earlier on fears of much higher tariff. Do you see any of the beneficiaries from that? And irrespective, your top picks in the space?
Right. So first of all, on the beneficiaries, there should be a number of companies that should benefit. I mean, obviously, this was an overhang for the broader sector overall. So, I mean, names like, say, Clean Science is, for example, one that would come to mind. Just the fact that their customers in leading products such as 4-MAP had actually been impacted by the tariffs in the US. So perhaps that overhang lifts. Aarti Industries is one that has vocally articulated the fact that this development is very positive for them. In addition to, of course, the fact that there is also an FTA with the EU that has just happened, and then the fact that China has actually been cracking down on overcapacity. So that really helps pricing in some of Aarti's key products as well. And I could go on, Deepak Nitrite, for example, Atul Limited, for example. So these are companies that not only maybe not have a very large direct exposure to the US, but then they in turn sell to, sectors such as, say, textiles or maybe polymers, which in turn do have a dependency on the US and were actually impacted by the tariffs. So it would be a broad-based positive for the sector overall, is where I would leave it. Of course, we'll have to see the fine print, gradually observe further moves from China after their New Year holidays end at the end of next month. See if they continue along the path of trying to rationalize capacity and bring down pricing competition, and then also look at what happens with the tariffs in the US. To your second question about top picks in the sector, so we've had half a dozen buys now, and one of our top picks has been Acutaas Chemicals. Stock has done really well, but remains a pretty strong growth story. So we continue to stay positive on that. Other names that we do continue to like, Jubilant Ingrevia is one where we think a promising CDMO story might be developing. Clean Science we just spoke about. Neogen Chemicals could be an interesting theme on the battery chemicals play. And a couple of other relatively undervalued stocks that we favor. One is SH Kelkar and the other is Godrej Agrovet.
Okay, all right. It's a pleasure talking to you, Abhijit. Thanks very much for joining in and bringing us so much of perspective on UPL as well as the other stocks that you did discuss. We'll take a short break. Lots more lined up. Stay tuned.
Welcome back. You're watching us here on Midcap Radar. The Nifty is still holding with gains of about 73 points, fairly off the highs. The Midcap Index has deepened its decline down about 0.2%, and the Nifty Bank now firmly in the red by about 65 points. We'll take your leave, but you stay tuned to CNBC TV 18 as Finding Alpha, a special offering, returns when we take a break.
The Nifty IT index is down 15% in 2026 amid growing fears that the rapid AI advances could disrupt both Indian IT services and global software companies. Bears warn that AI could erode SaaS demand and shrink the addressable opportunity for IT services, potentially pressurizing revenues. The bulls, however, believe that valuations have turned attractive and argue that the sector has navigated multiple technology shifts before and can do so again. Well, to break the debate down, we are joined by Abhishek Bhandari, the Executive Director, Technology and Internet Equity Research at Nomura India. Well, Abhishek, thanks a lot for joining in. Hello and welcome to Finding Alpha. I'm Nigel D'Souza. We're coming to you live from the Mumbai News Center. Well, Abhishek, you've been writing off late. It's been a very, very busy time for you. So we thank you for coming down to the Mumbai News Center, and we're looking forward to having a good chat.
Pleasure is mine, Nigel.
All right, Abhishek, let's get straight to the point then. Before we get to this entire AI disruption story, give us a broad sense about the size of the Indian IT services, as an industry, and if you could break it down for us, services, products, as well as platforms.
Got it. So NASSCOM pegs the size of the IT industry at around $280 billion.
Okay.
And the rough breakdown is 50% of that is IT services, 20% is ER&D, 20% is business process management, or BPO as we call it, and the remaining 10% is the hardware and the platform business.
Okay, all right. And if we had to put a point, which is the sector or the segment that is most under threat, the BPO part of it would be under threat. Everyone would be in different forms. But if you have to, say AI is going to be the biggest threat to which part of it?
Actually, entire IT services and BPO, because the fear is more on the deflation because of AI.
Okay, all right. Let's talk a little bit about that then. A large chunk of Indian IT revenues, they are linked to the SaaS players. Salesforce, ServiceNow, as well as Oracle, which many believe those companies itself are under threat. Does this create a dual risk for our IT companies, both on volumes as well as on pricing?
That's a good question, Nigel. What has been happening in the US market of late is, the people have written off the SaaS industry, saying that in the AI world, SaaS companies can be wipe-coded away by some startup.
Yes.
And that puts a lot of pressure on their high gross margins, which is around 70 to 80%. The per-seat pricing, which is on the subscription side, which could come under threat because of SaaS. In some extreme cases, people believe SaaS companies can become obsolete altogether.
Okay.
As you would know, IT services companies derive a lot of value by implementing the SaaS products into the client's, IT landscape.
Correct.
That's a fear. Having said that, I think it's too simplistic an assumption. The SaaS players actually have built quite a big moat around the data, the regulatory aspects. They give a lot of comfort to the enterprises who are buying their products. And the real moat, what they have is the data, what they have created over the last 15, 20, 25 years of existence. In fact, they are also pivoting toward the AI world by creating AI bots and AI agents. And who will be the guys who will be implementing the AI agents into the IT landscape? It will be the system integrators like the IT services.
IT companies.
So I'm not as bearish, on the premise that SaaS companies going away or SaaS companies shrinking will be a bad news for IT. In fact, the scope of work will increase because the work will now shift from just implementing SaaS towards managing the bots, what the SaaS companies are creating.
And that's when our Indian IT companies as well come into play. The software is created and then implementation is upon our Indian IT companies. Okay, all right. Let's talk a little bit more into this now. Since you spoke about the annual deflation, if you could give us an example with regard to these IT contracts. How long or what's the time duration of these IT contracts?
Yeah.
And if you could tell us a little bit about this annual deflation. I understand that over a lifespan of a contract, there is some kind of deflation that takes place. So what has it been in the past? And in the time to come, will that deflation of, say, a couple of percent go up by another couple of percent? Give us an example.
I think this is the most pertinent question, what investors are grappling with in the, wake of the AI disruption. Historically, if you look at it, the book of business for IT services companies typically has a duration of 5 years.
Okay.
So let's call it every year, 20% of the business comes from renewal. Pre-AI world, the typical discounts what IT companies used to give to the clients in a renewal used to range in the range of 15 to 20%. Okay. So the annual impact of deflation was 3 to 4% on your revenue per year in the pre-AI world. Now, what is happening because of AI is there is a lot of automation happening. A lot of automation means lesser effort needed for the same amount of IT work. So the deflation has now increased, from giving a 15-20% discount to now giving 20 to 30% discount to the clients. And what is happening is, since the clients are seeing more savings upfront, they're also shrinking the renewal cycle from 5 years to a lesser amount.
Right.
So in total, we estimate rather, would be the deflation because of AI is now ranging in the range of 6 to 7% for the IT services company. That's almost 300 to 400 basis points higher compared to the pre-AI world.
So annual deflation could move from 3 to 4% to around the 6 to 7% mark, which will in turn put pressure on price. And not just that, the renewal time frame as well could come down. So it could be a double whammy out there. Got that. Let's focus on a couple of commentary, that we've got in the last 1 year or so. Nandan Nilekani, he said that around 60 to around 80% of IT budgets, they're locked in maintenance. But now he says that there's going to be a big shift from maintenance towards innovation. Can innovation, spending offset this potential pressure on maintenance? So as of now, when an enterprise or a client gives a particular contract, what is the mix between maintenance and innovation? And how do you see that changing? And do you agree with Nandan?
I think Nandan has made a very valid point that IT spends are more towards maintaining the estate rather than innovating.
Yes.
And the general psyche of any IT spender, an enterprise IT spender, would be to keep the tech spending flat, if not improving. Nobody wants to shrink the tech spending because it is very hard, once you drop the tech budget, to get a budget approval again for an increase.
Right.
So what happens is typically the budgets are kept flat. Now, what it means is if you're saving some money because of cost savings, because of AI-led, automation, you'd rather reuse it somewhere else.
Yes.
So that's the, general thinking process of the IT, officers, the CISOs, and all those things. Now, since most of the spending is being hawked away right now by the maintenance, very little is left for innovation.
Yes.
Right. So if the maintenance cost comes down, definitely, even with the same tech budget being flat, you can actually spend more on the innovation side.
Right.
Do remember, tech is one of the few things in the humanity where people feel always dissatisfied or, unsatiated because of buying. You always want to buy more and more because the tech is improving constantly. The cycles are becoming shorter.
Yes.
So the spending, shifts away from maintaining. I think a lot of it will go away into the innovation part.
Right.
So actually, I agree with him. I think the way to think about it is, AI is also making innovation simpler and easier and less risky. As an example, many of the banks are still running legacy mainframe, which may have been written in 60s, 70s. The coders who have written those codes probably do not exist anymore. Or the risk of migrating them, from legacy to modern apps is very high.
Right.
And a typical enterprise buyer is a risk-averse person. He always optimizes his career to reduce risk, focusing less on cost and innovation. With AI, this can actually change. A lot of the mainframe or migration or upgradation may happen at a significantly lower price and at a risk which is significantly lower compared to the pre-AI world. So I think AI definitely opens up a lot of opportunities. And I think the investments will definitely shift away from maintenance towards more on innovation.
So as of now, ballpark for the industry will be 70-30, 70 towards maintenance and 30 towards innovation. And in the time to come, innovation could move from around that 30% to 40, 45% or thereabouts.
It should go up. The pace of going up depends on the enterprise's willingness to adopt the new tech.
Indeed. And that's going to be quite interesting because as a customer, as a consumer, you're far okay to adapt to AI, but otherwise on the enterprise side it's going to be quite interesting to see how adaptation takes place. Since we spoke about Nandan, I also want to talk about Salil Parekh. He has pegged that AI first services opportunity could be $300 to $400 billion or thereabouts by 2030. How realistic is this? Because data sanitization or even cloud migration opportunity could be large, even in this sort of an AI world. Would you agree with this estimate, 300 to around 400 billion?
I wouldn't comment on the number, but the way to think about it is the typical IT landscape of any enterprise is very messy. They have been built over multiple enterprise solutions over a period of time. Data are often siloed; they don't talk to each other.
Right.
And the key raw material, as I say, to make your AI strategy successful is cleansed data. The data has to be cleansed, the data has to be sanitized, and data has to be harmonized across your enterprise.
Correct.
Who will do that work for you? A person who understands the context of your IT, none other than your IT vendor, who has been working with you for a long time, who's also a system integrator, by the way, who has implemented multiple solutions over a period of time, and he knows which is sitting where. So I think definitely the data migration and the cloud migration being the preparatory work for AI, for IT, for the enterprises to become AI ready will be a big opportunity. An IT services company will definitely play a role in that.
So data sanitization as well as cloud migration, there will be a role for Indian IT companies to play even in that.
Yes.
Got that. All right. But the counter view is that, enterprise tech is far more complex than, say, a consumer-led AI. So adoption and deployment will take time. Where do you stand on the pace of disruption? That's going to be quite interesting. Because there is a bit of a gap right now, between, an AI tool coming about, and it's getting implemented. And at the enterprise level, it'll be a little bit more elongated. So what do you think about that?
Sure. I think, AI in that way is slightly different from the previous tech. In the previous tech, we have seen first the B2B or the enterprise adoption being faster and higher compared to the consumer side.
Right.
It's just flipped, because in the AI world. And you and I, keep getting better models, in our GPT subscriptions or Gemini subscriptions every week. So the pace of innovation definitely is, moving very fast. Every model maker, every large, infrastructure developer on the AI wants to become top of the podium, and that's the innovation which is driving the models becoming better and better every day. The reality on the, the enterprise side is that enterprises customers are very skeptical yet. They see multiple unanswered questions. What is the, the legal sanctity of these models? What are the guardrails around compliances? Copyrights issues, etc. So they're quite cautious and slow in terms of adopting AI.
Yes.
So what they're doing right now is, they're starting off with POCs. Give me a small proof of concept with a small project. If it makes sense, then I'll probably roll out a bigger project for my entire IT landscape. So enterprise companies are going slower, but nowadays we have started hearing comments regularly from the IT companies, not only from Indian, but the global companies, that the projects have started becoming a little larger.
Yes.
From POCs, now they're moving to enterprise-wide adoption. Still, from a number perspective, if revenue numbers of Infosys, TCS, or Accenture is any indicator, AI is still just mid-single digit, between 5 and 6%.
Right.
So still small, but rising. I think the real wave of AI adoption will come once the macro becomes a little stabler, because that, I think, is a necessary requirement for any big invention and a big investment to be made into the AI from an enterprise side. And also, once it's clear that AI can move just not from cost saving, which is the automation-led benefit, towards the revenue side,
Yes.
That's when enterprises will start coming through. So I think it's a matter of time. Even before AI becoming mainstream, the preparatory work of that will start. Again, going back to your previous point, in the previous discussion we had, the data migration and the cloud will be a prerequisite for any larger AI project to happen for any enterprise.
All right. The sense that I'm getting is, don't just throw in the towel with regard to these IT companies.
Yeah.
There still could be plenty of work for them to do, even in an AI-led world. So that's quite interesting. But the question is revenue growth, growth, growth. That's what the street looks at very, very closely. And you have outlined multiple growth scenarios. So if you could walk us through the key bull, bear, as well as the base scenarios. Depending on growth, what kind of multiple will you give our IT companies? They have come down a large deal, from the top. So highlight those three big scenarios.
Sure. If you look at the bear case, which is the topical theme in the market right now, the bear case is this company's business models becomes obsolete. They're not able to replace the deflation in revenue with a new stream of revenue on AI, and they struggle on growth. They may possibly have a negative growth, or in the best case, very early single-digit 2 to 3% growth. They keep margins stable, by optimizing on the workforce. You work in a scenario where the EPS growth becomes zero or close to -1, -2%. Now, those kind of companies, X growth, in our view, could trade at 10 to 12 times.
Okay.
That's the extreme bear, assuming these business models will become extreme. The base case is, the IT companies I would say adapt themselves, which they have done in the past tech cycles. Right now, we are going through the valley, as I call it, where the deflation of revenue is hitting first. The ascent into the mountain, which is the AI-led revenue, is taking longer than expected. But it will come. Ultimately, the AI models have to get monetized. If somebody has to monetize the model, somebody has to implement the model. And the implementers are nothing but the system integrators, which are the IT services companies.
Right.
In that case, I think the growth will come back towards mid to high single digit, in the range of 5 to 7, 5 to 8%, as you call it. In that case, I think the large cap IT may still go back towards early 20s in terms of multiple.
All right. That's the base case.
That's the base case. The bull case, is the IT companies pivot completely from just being, service providers to become value creators. What I mean by that is, the service model changes from labor, intensive work towards more like a platform.
Yes.
Where the company starts selling services as a software. This is, I would say, a low probability event right now, because we don't see too much of evidence of it right now. But if this were to turn out to be true, you could see a lot of non-linearity in revenue and the margins, and the multiples, in that case, could range even up to 30 times, for the good large cap IT companies. So I would say we are more of the base camp. We think IT companies in the past have demonstrated their ability to navigate tech cycles. Of course, tech cycle always has a deflationary curve followed by a volume increase curve.
Yes.
We are currently more in the deflationary side, and the volume is yet to come. But we think volume will come because the AI has to be monetized and AI has to be implemented in the IT landscapes.
Well put, Abhishek. You're helping us out with that. With regard, if things really go bad and there is no growth, there could be a marginal degrowth, then 10 to 12 times. If they get back to their growing base, 5 to around 7-8% odd, then maybe they get back to the early 20s. Yeah. And if it's all bombastic and things look very, very good, then maybe high 20s or maybe a 30 multiple as well. So we have got those three scenarios out of the way. Bear, base as well as bull. But my argument is, Cognizant. That's the large name, right, globally. That trades at what? 10.5, 11 times or thereabouts its forward earnings. But Indian IT companies, historically, we know they have traded at a bit of a premium. Do you think in this sort of a scenario, does this valuation gap actually narrow between, say, an IT company in India that trades between, 16 to around 24 times, very, very approximately, and a Cognizant that's trading at around 10 to around 11 times? Will that gap narrow, or do you expect India to continue to trade at that premium?
See, traditionally, the US market is more software and innovation market, where the multiples for software stocks have been higher and the services multiples have been lower.
Yeah.
And Cognizant is no different. Cognizant actually has gone through a patchy period of growth. We cover the stock. We have seen periods of low growth, and now coming back on growth under Ravi as the CEO. Having said that, the other services stock in US is Accenture, which trades at around 15 times Bloomberg consensus earnings. So definitely the gap between the Indian IT companies and the large IT companies in the US has fallen quite a bit. We have seen the gap almost being 30 to 40%. Now the gap is hardly 15 to 20%. Having said that, I think we have to look at the multiples of Indian IT companies in the context of Indian markets, because there are certain nuances of the Indian market which give a premium to the IT stocks in India.
Correct.
Mainly the high dividend yields they have, which is higher than the market average rate, extremely strong corporate governance, free cash flow yields, etc. And for the first time, in the last 4 or 5 years, we have seen the gap between the broader market and the IT stocks now falling down to zero.
Right.
And even IT on their own standalone basis, they have fallen below their long-term average growth multiples. So I think right now the market is more, tilting toward the pessimism, which is why the multiples are under stress. I think the global multiples on services, especially in US, always have a local nuance. So, I don't think it's right to compare the two.
Not right to compare.
Having said that, the valuation gap between Indian and US stocks have converged.
Right. And just to, since you mentioned, one of the factors that investors are holding on to is the dividend yield as well as the cash flow yield. What is it at currently?
5%.
5%. All right.
Roughly.
Got that. Abhishek, request you to hold on to that thought. We got a couple of queries as well coming in there, and we want to discuss your top picks. For the time being, we take a short break. Come back, we continue our discussion with Abhishek. You'll get a lot of your answers to your queries. Stay tuned. Welcome back. You're tuned into Finding Alpha, and we have Abhishek of Nomura who's helping us out with everything tech. And as you all would want to know, there are a couple of queries as well that have come in there because you all want to know which stocks are best placed. So let's get straight to the first query that's come in. We have a query coming in from Rakesh Arora, who writes to us from New Delhi. He wants to know the top IT stocks to invest in. And he's broken it up into 3 buckets: large, mid, as well as small cap stocks. Abhishek, what's on your radar?
Sure. So I think in the large caps, we like Infosys and Cognizant the most. We think they will continue to gain market share. They'll grow at a rate which will be higher than the peer average.
Okay.
In the mid cap, Coforge is the preferred pick. We think the company's ability to deliver mid-teens growth exists. And some of the large recent acquisitions, will help it become bigger in size and get access to more number of clients, the relevant ones. On the small cap, we like eClerx the most. It's a BPO company, but I would just like to clarify here the perception that BPO companies will all get disrupted, which is true partly on the BPO, voice side. The voice component for eClerx is quite low, is below 10%. So I think they will be a beneficiary on the platform side of the BPO, and we see them sustaining close to 15% revenue growth in the medium to long term.
Okay, all right. So that's the top picks there: Infosys, Coforge, as well as eClerx, as you mentioned. All right, got that. We got another query that's come in there, so let's take that out of the way. Priya Datta writes to us from Kolkata. She wants to know the outlook on the Indian IT sectors over the next 2 years. Now, this is an interesting one. Will the sector emerge as an AI beneficiary, or is it going to be an AI casualty? Tell us, Abhishek, what do you think?
I think, the IT companies are going to be AI beneficiaries in the medium to long term. Taking a step back, the IT companies are system integrators. They integrate your different types of software tools, or they innovate on top of it. And the need of system integrators even become more and more important in the AI world, where the pace of innovation will increase. That's one. And also, remember, IT companies have worked with their vendors, with their clients for a very long period of time. They understand the context of every enterprise, in a much deeper way compared to maybe a software company. And AI is all about context. AI for a bank is different for AI for a services company, or AI for a consumer company. And even in the same vertical, the need and usage may be different. So I think the context understanding of IT companies is a very big, positive asset they carry. And that's the reason I think, they will be beneficiary in the medium to long term.
Okay.
Just to, recap, I think we are going through a revenue deflation first, where people have written off, the potential revenue gains, only thinking about the near-term revenue deflation because of AI. But the reality is, tech brings down prices. Eventually, it gets compensated by volumes.
Yes.
The ones who will be able to pivot by changing their business models, their operating models, those will be the winners in the AI world.
All right, very quickly, Abhishek, before we let you go, there's so much of talk about GCC setting up shop in India. Now, if this AI adoption is going to gain momentum, do you think that's at risk? Because the entire cheaper labor argument goes out of the window. What's your take?
I think it's a myth that all the GCCs in India are built only because of labor, cost reasons. Many of them actually are kind of internal IT department, not in the US, but in India. They're often created for innovation reasons.
Yes.
So I don't, completely agree that, AI will, swing the, mass away from GCC into something else. In fact, the GCC's role will become even more critical. Many of them will become a very important, strategy implementer of the AI side of their respective organizations. The numbers may change, the number of hiring may change, but the strategy to open a GCC will remain, because India is still a very large talent supplier at scale, at quality, which not many parts in the world can offer.
Okay, all right, Abhishek, it's been a pleasure having you on the show. Thanks a lot for joining in on Finding Alpha, breaking down this entire tech tumble debate. And it appears you believe that, maybe tech still has a bigger role to play in the time to come. Thanks a lot for joining in.
Thanks, Nigel.
Well, on that note, we'll wrap up on this edition of Finding Alpha. Thanks a lot for watching. Stay tuned. More updates coming up.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Nifty implied open indicating as of now. It's indicating a positive start, a strong start, a gap-up start for the Indian market.
Any changes where they'll be paying tariffs, and we will not be paying tariffs. Our deal with India is they pay tariffs. This is a reversal from what it used to be, as you know.
The US Supreme Court, of course, threw out the IEEPA tariffs. But as was expected, this was widely expected from the market, so the US market reaction was next to nothing at all.
I believe this will unlock a lot of shareholder value, and that is the primary purpose of this.
The management said that it had assessed the difference in the balance from when the government asked for their balance statement was only about 490 crores.
All right, first rates coming up in just a bit, and what do we have, right? I mean, on your screens now, 25,667, about 1/3% higher.
The fact that the tariffs which have been imposed, they are of a temporary nature, 150 days maximum, and what comes after that we'll have to wait and see.
Like the inconsistency or the unpredictability continues. Right now, we fall under, auto is falling under section 232.
We have put out this number as we could best assess at this point of time.
Our expertise is what we say demo, design, engineering, manufacturing, assembly and logistics.
Well, yes, on Friday, UPL had announced that they are going to be merging their global and Indian crop protection businesses.
The Nifty, however, is off the day's high but is not building on any of its strength at this point in time. So just about at around 25,668.
Well, that is the day so far. Markets, of course, are popping up a little bit in the last, 4-5 minutes or so of trade. And I think we're up about 40-50 points in the last, from about 226 onwards. So this is about 7-8 minutes or so. And you can see that if you pull the Nifty intraday up. But 100 points essentially is what you have. This is Closing Bell. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. And of course, we'll discuss markets, get you lots of opinion over the course of the next 1 hour or so. So 25,670, that spike is what I'm referring to, starting at about 226 to where we are right now. Otherwise, I mean, through the course of the day, the market kept coming lower after opening up at the day's highest level, which was, of course, right at the word go. Well, lots to unpack in the last final hour of trade. Actually, you know, beyond indices, there is a lot of single stock action, big moves, and that is essentially going to be the focus here. So there is, of course, that's the market screen. PSU banks is the top gaining sector, IT is the top losing sector, and Nifty is up about 0.5 at this point. So we'll, of course, talk about markets. Now, there is a fraud which has left the shares of IDFC First Bank gasping for breath. I mean, AU Small Finance Bank is the other one which is selling off hard, about 5.5% at this stage. So that's going to be another focal point, focus area. UPL selling off hard. That restructuring has come through, but it's a clear thumbs down from the street. There are some downgrades which we will address in a bit from now. HAL is down about 4.5%. The last I checked, some reports indicating that the Indian Air Force has at least temporarily grounded the 30 single-seat Tejas LCA jets fleet. So, you know, that's the negative. We'll try and get more details on this one as the over the next 1 hour or so at this stage. Well, that's what's coming up here. How should you position yourself in terms of the trades, etc.? Mitesh is with us with exactly that. Mitesh, good afternoon. Good to have you here. What would you recommend?
Good afternoon, Prashant. Early in the morning, I was saying that we might go for consolidation, and if we don't get past 25,800, then expect this 25,800, 400 range broadly to prevail, and that's what is happening. Most of the volatility indicators, the directional indicators are flat, and I don't believe that, you know, we are breaking out of this minor range. Even if we do that, I think it's a slightly broader range of 26,000 to about 25,000. So it is still a market which is not giving you directional bias. On stock-specific basis, I have a buy on Marico and a sell on Mazgaon Dock. Marico is a buy with a stop at about 786 for targets of 820. While the other one, which is Mazgaon Docks, that's a sell. keep a stop at about 23.11. Look for targets of 22.20.
Yeah. Got that. Thanks very much, Mitesh, for that. So those are individual trades. More later. Now, the big story, of course, is from the financial space. Sharp falls in IDFC First Bank, and then there is AU Small Finance Bank as well. Ritu is here with just a brief bit about, of course, the news which has led to these falls. But now what ahead? What's the street making of it? Ritu, take it away.
Well, two private lenders, IDFC First Bank and AU Small Finance Bank, under pressure today after they informed exchanges that they've both been de-impaneled by the Haryana government from handling any government business effective the 18th of February. Let's start with IDFC First Bank, where the bank disclosed a suspected fraud of 590 crore rupees at its Chandigarh branch that involved the Haryana government-linked accounts. The issue surfaced when a government entity sought to close its account and transfer the funds, and that's when discrepancies were flagged. Now, since then, IDFC First Bank has suspended 4 officials. It has informed regulators and auditors, filed police complaints, appointed KPMG for an independent forensic audit as well. And the management says the issue is very much localized. It is restricted to one branch and one client account and does not impact other customers. Now, financially, 590 crores is not an insignificant hit. It is 28% of IDFC First Bank's estimated profit for the full year FY26 and equals roughly 19 basis points of the CET1 ratio, which stands at about 14.23%. Now, the bank has also clarified this 590 crore also includes a 100 crore precautionary buffer that is built in. Now, Haryana government deposits, they form about 0.5% of the total deposits for IDFC First Bank, and the bank has already seen outflows of about 200 crores from this account since the news came. The final hit, it says, is going to depend on the recoveries, the insurance, the legalities, but the bank believes the impact should be contained within this 590 crore amount. But the bigger question is whether there is any broader impact on all the state and central government deposits, which form about 8 to 10% of the total deposits for IDFC First Bank. Brokerages are constructive, though. Jefferies maintains a buy with a 100 target, while Investec also retains buy, but it has trimmed its target price to 92 rupees a share. Now, to AU Small Finance Bank, that was also de-impaneled by the Haryana government. It says it received the communication regarding suspected unauthorized transactions, and it is now also conducting an internal review. Some of AU Bank employees have also been placed off duty, but the bank says there is no indication yet of any financial loss or fraud that could impact the bank. Now, the Haryana government deposits there stand at 538 crore rupees, which is 0.4% of the total deposits for AU. So now going ahead, the key focus is going to be on the audit findings, whether the hit is any larger, the provisioning clarity and deposit stability, and also finally whether some of the PSU banks like Punjab National Bank in the northern region stand to benefit from these deposit outflows from the private lenders.
Through the reconciliation, we observed that there is a discrepancy of 490 crores. We have additionally estimated rupees 100 crores. That's how it comes to a 590 crores of impact, which we have put out in the press release. We have put out this number as we could best assess at this point of time, but we feel that the number is broadly appropriate to the situation, current situation. We don't anticipate this to broadly move from here on to a great extent. We expect credit costs to keep coming down, and we also expect improvement in net interest margin during the fourth quarter. And hence, whatever is the outcome of this exercise, we should be in a comfortable position to subsume that.
Let's also hear from the RBI governor on the fraud at IDFC First Bank.
As a policy, we do not comment on any individual bank or regulated entity. We are watching the developments. There is no systemic kind of an issue over here.
Okay, all right. Well, let's get in Atul Mehra, fund manager at Motilal Oswal Asset Management, who joins us on the show. Hi, Atul. Good afternoon. Good to see you in. The banks have gone into a bit of a tizzy, post this disclosure coming in from IDFC First Bank. Various queries being raised with regard to, the kind of built-up we saw on the short side and some put buying as well. That argument for another day. But what's your view on these stocks? They're seeing a sharp correction.
Yeah, hi, Nigel. Good afternoon. Yes, so obviously this is in context of a couple of these banks that have come out with these disclosures over the weekend. But I don't know from the perspective of in terms of a broader, if this is a broader issue in terms of system checks and balances across the bank, or this is a one-off issue. that is yet to be discovered. But I think the market's verdict here is, that at least the systems and checks and balances were definitely not in place for such a large amount to be in terms of kind of being fraudulent. The other thing is, in general, the general environment is for the larger set of banks to win market share in terms of deposits. The smaller banks have been making a lot of efforts over the last few years, either in terms of interest rates, either in terms of monthly credits, in terms of interest rates, etc. So they have been making a lot of efforts to gain inroads into deposits. And with this particular incident, what we've seen is, again, there's a question mark on whether they will be able to attract deposits going forward, and deposits being the raw material for the banking industry. And if it doesn't come in at the right price, then obviously even the asset quality on that asset side goes for a toss. So that is the kind of verdict the market has had in some of these names at this point in time.
Yeah, no, absolutely. Atul, what are the top conversations which are happening at that conference? Afternoon, Prashant here.
Yeah, hi Prashant, good afternoon. So yes, so I think to begin with, I think we had a very good session by Mr. Uday Kotak since the beginning of the day, where he was talking about the need for Indian corporates to be long-term oriented rather than quarterly earnings oriented. Because what tends to happen is, like in this quarter to quarter, in terms of focus on earnings, you tend to miss out on the big picture. Like one of the things that really stands out in the last 2 weeks is, despite the crazy amount of free cash flow generation Indian IT has had, today these stocks are selling off like these are like mid and small cap names. The largest of the companies are selling off like we've never seen. So perhaps the extent of focus on long-termism and willing to sacrifice near-term earnings, that is an important parameter for Indian corporates in general. So I think that for me, stood out by far in terms of a conversation at the conference. And other than that, obviously we have a lot of other companies participating, and the quarter has gone by, so Nifty earnings for the quarter have been closer to 10% growth. So things are looking okay. Next year, Nifty earnings growth is expected to be around 15%. So that is also looking fine. So those are the primary conversations that we've had so far.
Atul, number one company you want to hear from at the conference?
So a lot of, I think, so we just had HCLTech present at the conference. The previous session was with HCLTech. And obviously the biggest question is whether, Indian IT is positioned in what shape and form. So there was clearly a kind of an acknowledgement that we could have participated in this opportunity, but we have not as an industry. So that is definitely something that stood out. But having said that, from at least when you hear from like Infosys, that investor day that they had the other day, or even HCLTech today. So from the perspective of the management teams, what it appears like is, when it comes to enterprise tech, things are not going to change in a hurry. Although the perception has changed quite drastically in terms of valuation multiples being cut significantly for some of these names, but enterprise tech is not an easy game. Like for example, like if a lot of people won't ask their AI to process bank account payments or anything of that sort, right, to begin with. So, and a lot of enterprise tech is also about a lot of legacy systems, which just AI cannot solve in the near term. So what it appears as of now, at least when it comes to the verdict on tech, which is like the biggest conversation that we've had over the last 2-3 weeks, it seems that in the near term, you won't see earnings being hit to the extent that you've seen the stock sell off. In the maybe medium to longer term, you'll see some of these impacts come through, but the near term earnings hit is unlikely to come about.
Okay. Stock, by the way, the index has recovered a little bit. The IT index from the day's lowest level, it was down 2%, down about 1.6% as things stand right now. The other one is UPL. Atul, coming back to you. UPL is under pressure, announced a merger of its global Indian crop protections business. So the long-awaited restructuring is here, but of course the market's not only not impressed, it's unhappy. Ria, tell us more.
Well, yes, today UPL has taken a big hit in the trading session, and on Friday the company had announced that they are going to be consolidating their global and Indian crop protection businesses, and that will subsequently be demerged from the existing listed entity and then separately be listed on the Indian exchanges. They have announced the share entitlement ratio at 1:1, and the initial merger date will be the 1st of April 2026, and post that within 12 to 15 months the entire transaction is expected to be completed, and UPL Limited, which is the existing entity, that will continue to operate in the seeds and the specialty chemicals business. Now, after this, a lot of brokerages have come out with notes on UPL. Nuvama has downgraded the stock to a hold with a target price of 816. They have said that there will be no material impact on the current leverage overhang of the company. Investec has a buy rating on the stock with a target price of 925, and they have said that post restructuring, a consortium of private equity players will hold roughly 17% in UPL Global, but they will be holding less than 1% in UPL Limited, so that will be a negative for the holding company. Equirus has also, they have maintained their long rating on the stock with a target price of 850, but they have highlighted that the proposed structure provides a day one liquidity opportunity for private equity investors upon the listing of UPL Global, but value creation for minority shareholders remains unclear, and post this restructuring, minorities are expected to hold only about 12% directly in UPL Global. And apart from this, they have also highlighted that post the listing of Advanta, which is the seeds business of the company, UPL will only remain with the specialty chemical business, that is Superform, which has a structurally lower margin, so that will also be another negative for the company, and any post-structuring increase in the holding company discount could also lead to further value leakage for the minority shareholders. And lastly, even Elara has come out with a note on the company. They have also maintained their buy rating with a target price of 980, and they have said that this restructuring fails to simplify the structure and unlock value for shareholders, and this move is unlikely to generate incremental value for the shareholders, and they also believe that concerns will surface going ahead over the holding company's discount, but in the long term they do remain positive, as profitability gains and deleveraging should bolster growth for the company.
Got it. All right, Ria, thanks a lot for that. We spoke to the management of the company earlier today. Let's listen in to what they had to say about this restructuring and what, according to them, does it mean for shareholders.
So UPL One shareholders will continue to have their shareholding, that will be mirrored in the merger with UPL Domestic, and then the global business will merge into that. So there will be no loss. They will just get shares in the pure play crop protection business, which will create value for the shareholders, and they will continue to have the shareholding in the UPL Limited, UPL One company. So this will be incremental shares they get. They will not have any value erosion. When you unlock the value, they will see the value improvement through the ownership in Advanta and Superform, and the residual shareholding in the residual shareholding in UPL Global, which is a crop protection business.
Okay, all right. Atul, what do you make of this one? It's been an underperformer. It perked up of late. The street was buzzing with excitement. Something is coming. What came wasn't as expected. What do you think about this one? It was cheap. It is cheap. The problem is, I think the street is questioning, where is the value emerging for a retail shareholder? Someone who's holding the stock. For the PE, they get more liquidity. But out here, there is no real value discovery. What do you have to say?
So Nigel, on this one, so we as a house, we have not held this stock. We don't hold this stock. So I would kind of refrain from any particular view on this name particularly.
Got it. Okay. All right. Atul, how are you all placed with regard to this entire metal index? Because there's been plenty of excitement out there. Stocks have run up a goodish bit. Now, incrementally, people are getting a little bit sketchy whether or not, metal prices have run its course. But the question is that should you still be holding on to these stocks? Because as is, expectations are a far cry away from what current metal prices are. Case in point, just to cite an example, no one is assuming silver prices to be anywhere near the $70, $75 or $80 per ounce. Most are factoring in $55 to $60 an ounce at best. What's your view on this metals play? And do you all believe that maybe ferrous outdoes non-ferrous from here on?
Sure. So as a house, we are not in terms of heavily invested in metals as a space. Historically, also, like we've never had large holdings in metals as a space. So in general, what we tend to do is the focus is more on businesses which are more non-cyclical and long-term value creative in nature. And as a house, I think since inception, like we've avoided metals overall as a space. So we have minor holdings in one of few names here and there, but it's not a large sector by itself, and even in our portfolios, it's very thinly represented at this point in time. So that is the overall stance that we've had in metals as a space, Nigel.
All right, Atul, we'll leave it there. Thank you very much for joining us. Have a good conference, and more later. Appreciate your time here on CNBC TV 18. We'll take a break. N. Jayakumar of Prime Securities on the other side. Stay tuned. Coming up.
Welcome back. You're tuned in to Closing Bell. The markets continue to trade with a gain of close to under 100 points. That's the headline index, but Hormuz joins in to tell us about various stocks that are moving around in the market. Hormuz, run us through that list.
Well, there are some obvious ones in today's session, but the not so obvious ones are the moves that you're seeing within these names. And IDFC First Bank, after a ever so slight recovery that it saw towards the first half of trade, has now been sold into against a 16.5% lower on this stock, the biggest single day fall in 6 years. Today's trading volumes have crossed 60 crore shares. And of course, that's only a minor block deal that took place earlier in the day. So even if you remove that, it's still the highest on record. The turnover has already crossed 4,000 crores for today's trading session. So far, well, 35% of the total traded volumes have been marked for delivery. And an interesting bit is that the 85 put strike, which has been a bit of a talking point all across social media today, the premium for that for tomorrow's expiry has gone up 700%. Remember, the stock closed around those levels before the fall in today's session. So stock closed around 82, 83 last Friday. On the upside, though, Morpen Labs is one name that's doing well today, 15% higher on the stock. The top gainer on the small cap index today, the biggest single day gain since June of 2020. Today's volumes, nearly 10 crore shares, the highest that you've seen since August of 2024. Today's turnover, it's around 450 crore, which is around 30% of its free float market cap. And however, despite this very high trading volumes and turnover, only close to 14% of the total number of shares that have been traded have been marked for delivery. And lastly, on the downside, HCLTech is one name. Of course, almost the entire sector has sold off in today's session, but HCLTech, the fifth straight day of losses. The stock is down in 8 out of the last 9 trading sessions, and during these 9 trading sessions, the stock has declined almost 20%. And even in today's session, you had 20 lakh shares that have been traded. The 20-day average is around 14 lakh shares, and around half of the total traded volumes today have been marked for delivery. A big underperformer has been HCLTech, down almost 45% from its 52-week high, which is well over 1,400 rupees.
Thanks very much, Hormuz, for that. That's the lay of the land in terms of the broader market and what's buzzing around. And Jaykumar is with us, Group CEO and MD at Prime Securities. Jakes, good afternoon. Good to have you with us here. You know, there is a bit of a debate which is underway. I can frame it as a debate, which on one side is the idea that maybe after the Supreme Court ruling, it's better because, I mean, you know, the wild impulses perhaps that's peaked out. We've seen the worst of the impulses there in terms of tariffs, etc. On the other side is basically a lot of economists, etc. we've spoken to kind of say that, well, this is neither an advantage nor a disadvantage because you know, you'll base your from 18 to 15 and eventually you will head up to around about where you were. How would you look at it, Jakes, and are there any market implications?
Well, thanks for having me over. You know, I think the big takeaway from here is the fact that politically and otherwise, he's been significantly weakened. And I think that, to my mind, is the big takeaway, that whether it's 18 or 15, I think it's not, to my mind, that relevant as the fact that we will be pretty much at the lower end of the range compared to most of the countries. Now, if the deal, in terms of the deal that was originally signed as per the IEPA, was in the range of 18, and there would have been carve-outs, etc., those will continue to remain, to my mind, in some form or shape, even in this new modified version, if you will. I genuinely believe that the checks and balances in the US system are kicking in. And to that extent, I think he's been significantly weakened compared to what he was earlier. So you might have defiance and show of strength in terms of these announcements literally on the fly and, you know, on the top of his head being made almost immediately thereafter after the announcement of the verdict or the, you know, the Supreme Court judgment, if you will. So the way I see this is it's not very different from what it was earlier. And we still have come out, I think, reasonably ahead of it. I think a lot of other things in terms of, you know, whether Russian crude, et cetera, may have well been, you know, things that may just get, you know, kicked around and probably discarded. And so some more flexibility in some of our trade actions may well re-emerge. So I think some of those things are there. This is still early days yet, but I think he's come out very, very, very much weakened. And I think the big landscape here is that, you know, you're going to have a de-dollarization as a theme getting kickstarted all over again. And I think, to my mind, that's the bigger thing that we need to watch out for, that the de-dollarization theme, which started off 110 on the dollar index, came down to 96, took a pause, has been trading between 96 and 98, may well, you know, could test levels much lower than 96. The one good thing from their perspective in the US is that the yields have come off. And yields have come off noticeably, 30, 40 bips And to that extent, maybe they're refinancing their own debt may become a little easier. But other than that, I think there's very little going for them. Now, if you add or juxtapose this with issues like the Max 7, the capex issues around it, circular, revenues, etc., the reality is the U.S. markets are, to my mind, very close to peaking levels. Money will tend to start moving out. The smart money is already moving out. I think money will move into markets like India, whether in terms of an emerging market play or in terms of a play which involves just money moving out of the US and other developed markets. So I think India could be a beneficiary, partly because of default reasons, if you will, and partly because of, by design, we've been sort of waiting it out. We haven't gone out and done anything dramatic, but made our deals as and when required, especially the deals now with people like Europe and the UK, the Eurozone and UK, I think will stand us in tremendously good stead.
All right. Hi, Jakes. Good to see you in. Do you think that we are bracing ourselves for a very, very good run, particularly with regard to the broader markets? We keep talking about the headline index at the start of trade, at the end of trade. The problem is that portfolios have got absolutely smashed out of shape, down 10, 20, 30, 40, 50% as well. Given the kind of macros that we have seen, on ground, this trade deal actually, the entire direction actually seems to be positive. And FIs as it is have been underweight India. Do you think we're bracing for a very, very good broader market performance from here on?
I think we're bracing for a good market performance for a variety of reasons. One is that everybody around is nursing, portfolio, deep gashes on the portfolio. People have been sort of, worried about things, and especially, the kind of price movements that we are getting to see on a single day. There's a bank that talks about a 590 crore fraud and loses 13 or 15,000 crores in market cap on a single day, or a merger of a large chemicals company that was announced and the market drops 13%. So these excessive reactions at times like this, juxtaposed with the fact that we are in early stages of March, which is usually the tightest in the markets, leads me to believe that we're in the last 1 to 2 weeks of this kind of a bottoming out formation, if you will. I think the downside of the markets are limited. And I think if you add to it the fact that tech has been through a correction of some kind, so people have sort of moved out of many, whether stock specific or sectoral specific moves, especially things like IT. So maybe throwing the baby with the bathwater is what is happening in the market, and may well signal when we look back 3 months from today that we were in a bottom in this February-March period. And I, for one, believe that the next level of move, whether it's FIIs coming in or it's just the absence of selling, that will make markets move up. I'm extremely bullish on the market structure as we speak.
Okay, got it. Jakes, that seasonal factor will play out, I agree, in the initial part of March. That's what we normally see. But since you mentioned that one bank that is selling off, post the kind of news that we've seen over the weekend, would you be interested in it, IDFC First Bank?
I don't want to talk specifics, but I'm just saying it is symptomatic of the nervousness of the times. That, does anybody even remotely believe that this is not some, big banking failure of controls? No. I think it's, if there are people in the system who have attempted to sort of game the system and have created a problem, to put that bank down 20% or 15% in a day, is the way markets react. Do I agree with it? I think these are good buying opportunities in general. I don't specifically want to comment on IDFC in this particular case, but I think it is symptomatic of the nervousness of the times and the fact that portfolio gashes are evident and portfolio wounds are deep. And that indicates to me a bottoming out formation where when the next run happens, people will not have either liquidity or have the inclination or both to actually participate in the next leg of the market run.
Jakes, IT, what's the view?
I think the first fall has been severe, has been sort of brutal. I think everybody now is at least reasonably assured that it's not that these companies will shut down, but they need to kind of repurpose themselves. It still doesn't answer whether growth will happen. Markets ultimately pay up for growth. And if growth is going to be a function of dimensionally different, business models or new skill sets coming through, large amounts of training involved, etc. I'm not sure if we can factor all that in terms of the immediate next 2 years. But I think the disruption in the business models is real, is possible, and I think it is eminently doable that many Indian companies will adapt themselves. But will PEs and or prices continue to come down? I think these will become sell-on rallies for the moment. They will not be buy-on dips. And we may have to endure a lot more pain before we see some level of sanity being restored.
Yeah. Jakes, we'll leave it there. Good conversation as always. Thanks very much. A little bit of top down, a little bit of bottom up, and everything in between. Thank you for being here on CNBC TV 18. Well, I think we'll take a quick commercial break here. We'll come back in just a bit. We'll get you a check on what dealing rooms are talking about. Nimesh joins in on D Street Chatter. So that conversation coming up. Stay tuned.
Welcome back. Well, markets continue to trade with solid gains. Actually, there's been a bit of a pickup. Looks like we're the lucky charm today. The Nifty is up close to around 140 points, so that's good news. And the Nifty Bank, actually, that was underperforming for a larger part of the trading session, is now up close to around 100 points. So that's good news. But let's hop across to Nimesh in our special segment, D Street Chatter. Nimesh, what are you picking up from the dealing rooms?
Hi, Nigel. A big uptick in the last few minutes of trade, largely because of the MOC buying. So my sense is there is a small MOC basket buying leading FI desk. Again, largely in the Nifty names, so that probably explains that the Nifty has seen a bit of an up move in the last 15-20 minutes of trade. Largely, the flows have been mixed, is my sense, more towards PSU bank stocks. So again, the PSU bank index has gained another 1.5%. The drag is clearly on the IT side. So even after such a sharp sell-off, there was a Jefferies downgrade, and we're seeing selling pressure on most of the IT names, even in today's market. So that's one index which is dragging the overall markets down. From a broader market perspective, the Nifty, the mid-cap index looks down 0.5%. That's largely dragged by two stocks, IFL, IDFC First Bank, and UPL. They're the major contributors dragging the mid-cap index down. But broadly, it's been quite mixed. There are some gainers as well. And my sense is that in the broader markets, at least, there is a bit of nibbling happening from domestic mutual funds. So the flows largely towards PSU banks and to some extent into the broader markets as well.
Nimesh, the stock-specific chatter, what's on your list now? Well, so by the way, I think the UPL bit, the UPL story, which has now been, of course, put out, is something that you had highlighted months back. So some come soon, some take time, but they all come.
They all come, and this was anticipated as well. In fact, in the last at least couple of months, it was widely reported by the brokerages as well that there's going to be a demerger, UPL1 and UPL2. So that's come. It's largely in line. I still believe that the market reaction is a bit. The market has reacted a bit over in terms of the holding company discount for the UPL businesses. Still, the clarity has to come on the valuation, which they will report to the exchanges in the next few days. So that's something to track in UPL going forward. But nevertheless, there was anticipated and it has come. From today's list, the first stock on my list is Supriya Life. It's been under pressure, a bit of consolidation as well in this particular stock. But I believe that the selling pressure from a leading FI seems to be largely over. And one large HNI investor who's a big investor as well, he's bought of late again into Supriya Life. So that's the first name. Second, couple of stocks where there is delivery-based buying today. LIC Housing Finance, there was a recent city upgrade as well as Bank of India. Both are seeing delivery-based buying, so expect high volumes in both those names today. The third name is Oracle Finance. Again, part of the IT pack, even Oracle has been down from the recent highs. But I believe at least one domestic offshore fund is a seller in Oracle at these levels. And the last is Indegene. This is interesting. Almost at 52-week highs, some larger HNIs have bought couple of months back as well in large blocks, under pressure of late. But I understand there is a leading global fund who's been an active seller. They own close to over 2%. So that pressure may just continue in the very near term in Indegene as well.
Okay, all right. Cut that, Nimesh. Thanks a lot for that. Well, let's go back to Mitesh Thakkar from Bonanza Portfolio, who joins us with a couple of his picks. Mitesh, actually, today, though we'll go home with a gain of 100, 140 points, the problem is we couldn't build on to those gains. The top-class batsmen, the Nifty Bank, that really couldn't perform today. And that was the reason why we couldn't build on to those gains. But what do you do from here? You believe the bias is still on the upside? And also fill us in with your two picks.
Yeah. So my sense is that, yes, I think, the market is still sideways. The mild bias on the stock basis upside, while the Bank Nifty for the day has underperformed, I think it still remains the strongest of these stocks. So I have two VTST calls. One is SBI Life with a stop below 2095 and a target of around 2135. And Oil India is the other one. That's a VTST with a stop at about 468 for target of 42.
Oh, got that. Thanks very much, Mitesh, for that. What I'm going to do is now go across to RIA, because HAL, of course, was down 4.5%, 5% earlier. It's recovered. There's some clarification from HAL as well. So let's get the latest going on this one. RIA, take it away.
Well, yes, HAL has taken a hit in today's trading session, and earlier there was a report that said that the Indian Air Force has grounded the entire fleet of around 30 single-jet Tejas LCA jets after a crash earlier this month, and the IAF is going to carry out an intensive technical probe as a result of this, and this is as per a PTI report. Now, remember that this incident had actually occurred earlier this month during a landing after a routine training sortie, and the preliminary probe points to a suspected onboard technical glitch. Now, it is also to be noted that this is the third Tejas aircraft lost since the induction, since its induction into the IAF. The first one was in March of 2024, and the second one was in in November of 2025. As of now, there has been no confirmation from the IAF yet on the grounding of the fleet. And apart from this, HCL has also issued a factual clarification saying that there was no crash, but rather it was a technical glitch that led to this incident. But the key thing to be tracked later will be the grounding of the fleet and any further comments from the IAF or on HCL on this matter.
Got it. Okay, all right. Thanks a lot for that. Ria, Amrish Palika, independent market expert, joins us on the show. Amrish, good afternoon. Good to see you. And what do you do with HCL? You know, this news flow, this negative news flow, whether it impacts the business or not is secondary, but that's actually hurting sentiment. What is your view on the stock? It's now down close to around 4%, even after that clarification came in from the management.
Just not HCL. In fact, defense overall, I've been saying for the last, I think, 18 months or more, that the market has been discounting the order flows and most of these stocks have become multi-baggers. But no one is really talking about the execution issues. And that execution issue is going to come and hit at some point of time or the other, because the sort of orders which they've got is multiple fold compared to their past revenues. And it's not possible for anyone to upgrade at such a short notice. And there would be slips happening. And what we are seeing now of Tejas is a slip. So clearly, I think even the other companies in defense may also see execution issues going ahead. So one needs to be a bit careful at this point of time. I'm not saying that the story is over. I think the story is for long term, no doubt. But we need to take into account that these slips will happen, because of which there would be some review. We could see these stocks correcting, but at lower levels could be a buy.
How much lower from here, you said, Amrish? It's around $4,000.
See, something like a HCL, we could still see a further downside of about 15 to 18% more from here.
Oh, okay. And then you would be a buyer.
At those levels, I would review it. I mean, I wouldn't say I would buy it at those levels. At those levels, one should review it.
Okay, you told us about HCL, and tell us, what will you buy? You normally give us that one pick that you're looking at. I believe Kirloskar Engines is the stock you're looking at this time around?
Yeah, Kirloskar Oil Engines is the stock I'm looking at. They are leading manufacturers of diesel engines and power generation equipments. Large range of air-cooled and liquid-cooled engines, right from a small 4 HP to a mega 11,000 HP. Used in multiple sectors: agriculture, construction, mining, material handling, marine and industrial applications, and also across hospitality, QSRs, retail. And now going ahead, the fresh demand would be from data centers for their HHP segment, which is the high horsepower segment. Industrial segment demand is coming from railways and defense. And this is, there's also an increasing focus on mining and construction equipment segment. Exports are mainly to the MENA region. If you look at the Q3 numbers, they were quite decent: 29% growth in the top line, 31% growth in EBITDA. Distribution and aftermarket also grew, I think, the highest ever, quarterly performance of 14% rise on Y. So going ahead for the next 3 years, I expect a CAGR of about 18% on the top line. And my FY28 expected EPS is 55 with a target of 1,700 rupees.
Okay, 1,700 Kirloskar Oil. Amrish, good to hear that. Coming back to you for more, but just want to play out a couple of sound bites, right? So we spoke with two companies. One is Ramakrishna Forgings in the auto anch side and Pearl Global on the textiles front. With regards to, of course, this 15% tariffs and what happens from here on, just want to play out a few sound bites. Listen in.
I think it is as it is I think within next couple of days or weeks, I think the Section 232, how it works out, whether India gets an exemption on auto parts, we will need to look at it. Because of the trade deal said that US auto component exports to US, there will be certain carve-outs for zero duty and to move to 18%. We will need to look at the fine print. But as such, I think that becomes not very significant right now.
I don't foresee a huge swing, especially in my sector. See, the benefit that the retailers and the brands will get is most of the other countries were at 20%. So the bulk of import that was happening into USA was at the rate of 20% additional or reciprocal tariff on top of the MFN. Now, with this ruling and then Section 122, which has been invoked by President, it will come down to 15%.
Yeah, absolutely. And so, I mean, that's Pearl Global and the management of Ramkrishna Forgings with their opinion. Market's not doing bad at all. 140 odd points or so is where we're at. Amrish, UPL, any thoughts on the big fall that we had? I don't know if you heard Nimesh earlier. His point after conversations with many is that perhaps a bit overdone, excessive, but just go on. Your thoughts?
I mean, it is overdone, no doubt. I mean, like a 14% fall because generally demergers, there's not much of a downside for shareholders. There's generally an upside. But here we're talking of a holding company, and because it's a holding company, there will be a holding company discount. But can it be this large? Because and at the same time, I would say that I think market as a whole, I think we should possibly look at reviewing our valuation of holding companies, because recently we had a Religare announcement coming. And again, it dropped because of the holding company discount. Because end of the day, if the holding company is not doing anything else and just holding these investments, I don't think the discount should be that huge. And because of which I think the reaction has been a bit overdone. Maybe in the next 2 or 3 days, we could see a decent upside for UPL. So at lower levels, I would surely look at buying into UPL. And when I say lower levels, I would possibly start at these levels. And because of the sort of a fall which you've seen, we can see at the 5 or 6% more fall. And that's a buying opportunity.
Okay, Amrish, stay with us. Just coming back, 9 minutes to go for market closing. Take a quick break here. More coming up on the other side. Stay tuned.
Welcome back. A few minutes ago, before we wind down trade, Amrish Palika is still with us. Amrish, what do you make of IDFC First Bank? The stock is down close to around 15%. As a percentage of net worth or deposits, it may not look quite large, but the stock has got hammered. The street doesn't like any sort of news on this front. It's a negative, and they're fearing that maybe, in fact, it could have a contagion impact, which the management clarified no, but that's always a fear. Your take?
No, I mean, that fear is always there because of what we saw happening in IndusInd. And I think this is the first sort of a major issue which has happened after Mr. Vaidyanathan took over about 8 years back. And I mean, I believe it is the regulatory scrutiny which will follow now. I think will slow it down further. The stock was, in fact, struggling to cross 85 for a few months, and now the weight has fallen because of this issue. I think for it to get back, I think it will take a long time. And along with this, I would also like to say that possibly it's just not like IDFC or banks. I think the whole BFSI space, I think we should know that this sort of a risk exists because in the last couple of years, we have seen huge amount of wealth creation. At the same time, even the corruption has reached unprecedented levels. So I think, I mean, we could see these sort of issues erupting every now and then across the space. So I think one needs to be a bit careful from that part of it.
Yeah, no, that's absolutely true, Amrish, and lots moving, right, in terms of these news-related names. Usually we don't have such sharp moves, and we have 4 of them today in that sense. You know, the E2E networks and the netwebs, etc. Amrish, any thoughts?
I think we've already seen a decent move based on the AI story.
Yeah.
I really how much more it will move from here. I think, I mean, it's like the move has been more sentimental than anything else. And such moves don't really last too long. I think at these levels, I'll not really buy fresh.
Do you look at a company? Have you looked at a company called Blue Jet? They're basically in contrast media used in imaging,
Right.
etc. And I mean, complete 1,000 to 300 now, about 400 after today's 10% pop. Any thoughts?
No, in fact, I had looked at it when they had come out with an IPO. After that, I've not really tracked it.
Okay, all right. Amrish, always good speaking to you. Thanks a lot for joining in and giving us all of those views. Well, time to wind down the markets. You know, one would say it was a little bit disappointing. You would want a little bit more in terms of building onto gains. We start off with a gain of around 150 points. We go home with gains of close to around 140, 150 points or thereabouts. For the Nifty itself, well, there were a few stocks that batted for the bulls. You have Adani Ports that did well, Dr. Reddys did well, Kotak Mahindra Bank as well was up close to around 2%, and Nestle India, that one as well was up close to around 2%. On the flip side, the problem was Hindalco was down 2%. The tech stocks continued to take a bit of a knock after the recent pullback that we saw. So Wipro was down, Infosys was down, as well as Tech Mahindra. All those stocks, in fact, they went home with a bit of a negative bias. But the bigger problem was in the broader markets. And though the headline index did well and the number of stocks advancing as well as declining, both of them were pretty much even Steven. The problem was stocks that were part of the mid-cap index, they entered with deep gashes. So IDFC First Bank, there was a fraud that was detected, announced over the weekend, stock was down 16%. UPL, they announced a bit of a rejig in terms of their businesses. Scheme of arrangement announced. The street had sniffed it, but what actually came, street didn't like it. Stock down close to around 15%. AU Small Finance Bank as well was down close to around 5%. And Dixon Technology, the stock that's never been cheap, well, that one was down close to around 5%. But you had a few gainers. Indian Bank was up 3.5%. Bharat Forge was up close to around 3%. I recall Mr. Baba Kalyani talking to us here on CNBC TV 18 and saying FY27 is going to be a much better year. He sees various drivers with regard to the CV cycle turning as well as the defense space. Siemens was up close to around 3%, as well as Cummins was up and about in today's trading session. HAL, periodic bad news coming in there. They're clarifying, but the street not buying into that. So that stock as well went home with a cut of around 3.5%. From the broader markets, you had DEE Development. Stock went home with a gain of around 20%. Big order win out there. Similar is the case with Mopin Laboratories. Stock up close to around 15%. Hind Rectifiers as well was up close to around 8.5%. Went up on rather large volumes. And Tourism Finance was another stock that did pretty well. So net, it was that sort of a day when the Nifty goes home with gains. But the bulls will be a little bit disappointed that we couldn't drive home the advantage. The mid-cap index was under pressure because individual stocks did come in for a bit of a pounding. On that note, though, we'll wrap up on closing bell. You don't go anywhere. The team of Markets Forward comes up next.
Market closely largely higher. Nifty ends above 25,700. IT stocks extend losses, down for the third straight session. Mid-caps underperform the blue chips.
The Haryana government has barred IDFC First Bank and AU Small Finance Bank over irregularities in its accounts. IDFC First Bank labels it a fraud and estimates the variance at 590 crore rupees. AU Small Finance Bank claims it followed all RBI protocols, and the governor rules out any systemic risks.
UPL tanks 15% after Eats scripts a split and listing of Eats crop protection business that does little to deleverage its balance sheet or enhance shareholder value. HCL also takes a nosedive after reports suggest that Indian Air Force grounds Eats entire Tejas fleet after a malfunction earlier this month. There was a clarification that came in from HCL, but the stock didn't recover. Hello and welcome. You're watching Markets Forward on CNBC TV 18, your go-to show where we aim to get you all the key data points to gear up for the next trading session. I'm Winnie Motiwala. With me is my colleague Hormaz Fatake as well. Hormaz, it's been a day. Welcome back to you first. A day where we started with gains of 150 points. We saw a bit of a dip and then again closing 25,700, 140 point uptick. No complaining for the benchmark, but broader end of the market. That's where we saw the pain today.
You would take that, to be very honest, and especially since you're heading into expiry on Tuesday, the monthly expiry at that, 140 points on the index. Well, no reason to complain, especially considering the recovery seen in the US futures as well. So we managed to hold on to that 25,700 mark, as Winnie was highlighting. The Nifty Bank also saw a bit of a recovery from the lows of the day. At one point, it had even slipped into negative territory. But of course, the broader markets, the mid-cap index in particular, especially considering the accidents seen in IDFC First, in UPL, that too recovered from the lows of the day, but managed a close in the red, down around 0.5%. But here's a lineup of what we have in store for you on the show today. We start with the top movers and shakers with Gaurav. We decode the big fall in IDFC First Bank and AU Small Finance Bank, and also tell you why UPL was down 15% today, and put the spotlight on HAL as well. But last but not the least, delve into the key market events to watch out for going into the all-important expiry trading session tomorrow. But our first segment of the day, Gaurav is here with the big movers and shakers. Gaurav, over to you.
Yes. If you look at the market, it has actually it was actually able to regain that 25,700 mark. And if you look at the market participants as well, first let's talk about some of the gainers. First is Morpin Labs. If you look at the stock, it was not only up in trade, there were high volumes as well. And the reason being that company has bagged a deal worth 800 crores, and with this they will also be entering into high margin, high growth CDMO segment, and that is something that the market liked. Other than that, let's talk about de-development. There also companies saw an order win worth 170 crores, and that is something which cheered the stock. The stock was up more than 11%. We had some of the volume-led gainers like Indotech, Aegis Vopak, BLS International. Let's also not forget about Newland Labs, Jindal Poly, and Hind Rectifiers, where we saw movement happening on the last hour itself, and after that we saw some sharp uptick in these stocks as well. Nifty PSUs. Now this is something, let's not forget about this, because we have seen some rally earlier as well, and today also Nifty PSU remains strong. And let's also not forget about Axis Bank, because they have now made it clear that they will not be bidding for Credit Access Grameen, and that is something the market liked, because they were a bit skeptical about this deal anyways. So on the losing side, if we come to the stocks like IDFC First Bank and AU Small Finance Bank, these were the biggest casualties. For IDFC First Bank, there were discrepancies that were found in their deposit side worth 590 crores. But for AU Small Finance Bank, the news which followed this losses is because of the de-empanelment by the Haryana government, and that is something which hurt the stock. UPL, there also we saw some bearish stance, and the reason being that value creation for minority is something that market was not sure about, and that is something which took the stock down. And lastly, let's also not forget about stocks like Godfrey Phillip and E2E Network. In the last week, we saw sharp uptick in these stocks, but today we saw some kind of a profit taking. And last but not the least, Nifty IT. For the last few days, we are seeing some weakness in Nifty IT, and today also we saw this weakness continuing with fresh shorts actually building up in Infosys, Coforge and TechM. So all in all, we will be closely watching out on Nifty IT, but if we look at Nifty, we are seeing some green shoots, and we are seeing bulls actually coming a bit in a bit positive move in Nifty today.
Okay, Gaurav, thank you so much for that. But talking about a couple of names, IDFC First Bank as well as AU Small Finance Bank. Now, IDFC First Bank, that tanked 17%, while AU Small Finance Bank, that fell 5%. And this came in after Haryana government barred both banks over irregularities in their accounts. Now, Ritu is joining in with us to give us more details on this one. Ritu, what are the details, and take us through the highlights?
Two private lenders, IDFC First Bank and AU Small Finance Bank, were under pressure today after informing exchanges that they had been de-impaneled by the Haryana government from handling any government business starting the 18th of Feb. Let's start with IDFC First Bank, where the bank has disclosed a suspected fraud of 590 crore rupees at its Chandigarh branch that involved Haryana government-linked accounts. The issue surfaced when a government entity sought to close its accounts and transfer the funds, and that's when the discrepancy was flagged. Since then, IDFC First has suspended 4 officials. It has informed regulators and auditors, filed police complaints, and also appointed KPMG for an independent forensic audit. Now, the management says this is a localized issue that is restricted to one branch and one client account and does not impact other customers. Now, financially, 590 crore rupees is not insignificant. It is about 28% of IDFC First Bank's estimated profit for the full year FY26 and equals roughly 19 basis points of its CET1 ratio, which stood at 14.23%. Now, the bank has also clarified that this 590 crore rupees includes a 100 crore precautionary buffer that has also been built in. Now, the Haryana government deposits form just 0.5% of the total deposits for IDFC First Bank, and the bank has already seen outflows of about 200 crores from the account since the news. The final hit is going to depend on the recoveries, the insurance and the legalities, but the bank believes the impact should not exceed 590 crore rupees. The bigger question is whether there is any broader impact on all the state and central government deposits, which form about 8 to 10% of total deposits for IDFC. Brokerages are constructive though. Jefferies maintains a buy with a 100 rupees target, while Investec retains buy, but it has trimmed its target to 92 rupees a share. Now, to AU Small Finance Bank, which was also de-impaneled by the Haryana government, the bank said it received communication regarding suspected unauthorized transactions and is also conducting an internal review at the moment. Some employees have been placed off duty, but AU says there is no indication of any financial loss or fraud that is impacting the bank. The Haryana government deposits there stand at 538 crore rupees, or about 0.4% of the total deposits. So the key focus now going ahead is going to be on the audit findings, on the provisioning clarity and deposit stability, and whether PSU banks like Punjab National Bank in the northern region stand to benefit from these deposit outflows from the private lenders.
Through the reconciliation, we observed that there is a discrepancy of 490 crores. We have additionally estimated rupees 100 crores. That's how it comes to a 590 crores of impact, which we have put out in the press release. We have put out this number as we could best assess at this point of time, but we feel that the number is broadly appropriate to the current situation. We don't anticipate this to broadly move from here on to a great extent. We expect credit costs to keep coming down, and we also expect improvement in net interest margin during the fourth quarter. And hence, whatever is the outcome of this exercise, we should be in a comfortable position to subsume that.
As a policy, we do not comment on any individual bank or regulated entity. We are watching the developments. There is no systemic kind of an issue over here.
Okay, surely interesting commentary that's coming from the RBI governor as well as IDFC First Bank in terms of what they were saying and the clarification that they're giving on that part as well. But we are also joined by our independent market expert Amrish Maliga as well as Jay Thakkar of ICICI Securities. Amrish, Jay, thank you so much as always for joining in. Jay, before we jump to individual stocks, your thoughts in terms of the markets. We started on a high, we came off, then again moved back 25,700 above that mark. Tomorrow is the expiry. So what are we keeping an eye out on for tomorrow's trading session? What levels will be key now?
Definitely. Winning February series, I would say, has been reasonably better in terms of the numbers. If you see the February started, series started with the huge index short positions by the FIs, and it was more than 2 lakh contracts. right in January, and then heading into the budget, we saw that happening. But then, since then, we have seen some recovery happening, and we have seen almost like 50,000 contracts. That's been, there was short covering by almost 50,000 contracts by the FIs. So that's positive, one thing. Secondly, relatively, if we see since January, we have seen in February, the equity cash segment numbers by the FIs also have been positive, relatively. So that was also, I would say, the overall volume-wise or, the trade-wise numbers as far as FIs is concerned has been better in February. The only thing which has been, a bit concerning in Feb is that, stepping into Feb because of the start of the Feb with budget, we saw the, India VIX or the volatility index going up almost up to 16. But then post that, we saw with the announcement of the trade deal, we saw that, the VIX cooled off a bit and it fell back to almost 11.5, 12. But since last week, we have seen the VIX again going up. So that's the only thing, and is as much as high as the, budget levels or budget day levels, almost at 14, 15 levels on a closing basis, I would say, Vinny. So that's the only concern in the near term. I mean, rising VIX is not that positive for the market, and hence I would say that from the view of expiry, I mean 26,000, which has the highest call base, Vinny, that seems to be difficult, to take off those levels, tomorrow in tomorrow's trading session and going forward or stepping into the March series as well. I would say in order to see an upward momentum in the index, I would say that Nifty needs to take off 26,000 levels. Else, with this rising VIX, the markets might just trade sideways to a bit negative, and the range could be 25,500 to 26,000 at least until we get a breakout from this range. So the rising VIX is a fear.
Okay. Amrish, a quick take in terms of CDMO players today. We saw a buzz coming in these names as well. Whether you talk about a Blue Jet or you talk about Newland Labs, Cohen's Life Sciences, all of them were beaten down, and now today suddenly a run up.
Yeah, because see, if you're talking of longer term, clearly the sort of orders which have been flowing into them, I think that's going to keep increasing. And we've also seen margins improving for most of them. So if you're talking from a longer term perspective, I would be buyer at a lower level.
Indeed, and there's the kind of action that you have seen in a lot of these CDMO players, particularly Cohen's, after the block deal that took place earlier in the day. It'd be interesting to see who are the buyers in that transaction. But the other accident of the day today, barring IDFC First, was UPL, and that was down 15% as well after its restructuring plan. Ria is here with more details on why the stock is under pressure.
Well, yes, today UPL has taken a big hit in the trading session, and on Friday the company had announced that they are going to be consolidating their global and Indian crop protection businesses, and that will subsequently be demerged from the existing listed entity and then separately be listed on the Indian exchanges. They have announced the share entitlement ratio at 1:1, and the initial merger date will be the 1st of April 2026, and post that within 12 to 15 months the entire transaction is expected to be completed, and UPL Limited, which is the existing entity, that will continue to operate in the seeds and the specialty chemicals business. Now, after this, a lot of brokerages have come out with notes on UPL. Nuvama has downgraded the stock to a hold with a target price of 816. They have said that there will be no material impact on the current leverage overhang of the company. Investec has a buy rating on the stock with a target price of 925, and they have said that post restructuring, a consortium of private equity players will hold roughly 17% in UPL Global, but they will be holding less than 1% in UPL Limited, so that will be a negative for the holding company. Equitas has also, they have maintained their long rating on the stock with a target price of 850, but they have highlighted that the proposed structure provides a day one liquidity opportunity for private equity investors upon the listing of UPL Global, but value creation for minority shareholders remains unclear, and post this restructuring, minorities are expected to hold only about 12% directly in UPL Global. And then apart from this, they have also highlighted that post the listing of Advanta, which is the seeds business of the company, UPL will only remain with the specialty chemical business, that is Superform, which has a structurally lower margin, so that will also be another negative for the company, and any post-structuring increase in the holding company discount could also lead to further value leakage for the minority shareholders. And lastly, even Elara has come out with a note on the company. They have also maintained their buy rating with a target price of 980, and they have said that this restructuring fails to simplify the structure and unlock value for shareholders, and this move is unlikely to generate incremental value for the shareholders. And they also believe that concerns will surface going ahead over the holding company's discount, but in the long term they do remain positive, as profitability gains and deleveraging should bolster growth for the company.
So UPL One shareholders will continue to have their shareholding, that will be mirrored in the merger with UPL Domestic, and then the global business will merge into that. So there will be no loss. They will just get shares in the pure play crop protection business, which will create value for the shareholders, and they will continue to have the shareholding in the UPL Limited. No, there is no plan for any of that right now. So UPL, like a normal listed company, the promoters have to follow the guidelines, and so we are just following that, and the promoters have no interest in selling down any shares in the company.
Ria, since you are with us, also tell us about HAL. The stock was down nearly 5%, saw a bit of a recovery after the company clarification, but that didn't help matters either.
Well, yes, HAL has taken a hit in today's trading session, and earlier there was a report that said that the Indian Air Force has grounded the entire fleet of around 30 single-jet Tejas LCA jets after a crash earlier this month, and the IAF is going to carry out an intensive technical probe as a result of this, and this is as per a PTI report. Now, remember that this incident had actually occurred earlier this month during a landing after a routine training sortie, and the preliminary probe points to a suspected onboard technical glitch. Now, it is also to be noted that this is the third Tejas aircraft lost since its induction into the IAF. The first one was in March of 2024, and the second one was in November of 2025. As of now, there has been no confirmation from the IAF yet on the grounding of the fleet. And apart from this, HCL has also issued a factual clarification saying that there was no crash, but rather it was a technical glitch that led to this incident. But the key thing to be tracked later will be the grounding of the fleet and any further comments from the IAF or on HCL on this matter.
Okay, obviously we did have some comments that came in from HCL, some clarification there, but seems like the street didn't buy it. But Jay, on the technical front for HCL, what is the level that you're keeping an eye on in the near term?
Well, Vinny, I would say that the overall chart structure, first of all, is negative. We have seen a breakdown coming in, and that too, we have seen this with increase in volumes, which is clearly in the increase in open interest as well. So, which is clearly indicating short build-up out here. I think that another 10% downside cannot be ruled out from the current market price. So 3600 to 3650 is a level to watch out for on downside. I think there is where one can look out for, or one can review if at all it holds there or tries to come back. On the upside, I would say, Vinny, that 4200 now becomes a very stiff resistance. Unless 4200 levels aren't taken off, the overall trend in the near term will be negative.
Indeed, and HAL not having a very good session today, 3.5% lower. But the other sector that has been having a bit of a rough ride of late has been IT. And after Jefferies believes that they still offer more downside compared to upside after a slew of downgrades for at least 6 of these IT names. Rima is here with more on this. Rima.
Indeed. So Jefferies sees more downside in Indian IT names, and this is even after the underperformance of the cut that we've seen, 16% gone for the Nifty IT since the start of the year. And according to Jefferies, there is more downside. They've downgraded Infosys, HCLTech, Emphasis to a hold, LTIMindtree, TCS, Hexaware to an underperform, and the target price has been slashed quite a bit. In fact, it's more than a 30% cut in the target price for TCS and Infosys, about a 26% reduction in the target price for HCLTech. And even after that, they see a double-digit decline from here on for a TCS, for a Wipro, for a Kotak Mahindra and LTIMindtree. The only buy recommendations that Jefferies has is Coforge, Sagility and IKS. Now, the key reason for that is given what the growth is going to be for the Indian IT companies, Jefferies says valuations are still high. So they're saying the Nifty IT has been delivering lower earnings growth compared to the Nifty now for several years. yet it continues to trade at a premium. And secondly, even compared to, say, a company like Accenture, the Nifty IT index, so the large cap IT names are trading at a 32% premium, which perhaps cannot be justified. Back to you.
Thank you for that, Rima, and also thank you to both Amrish and Jay for sparing time and joining us today. Views on the index and on specific stocks as well. Take a short break. The top corporate wises and the key events to watch out for going into tomorrow's session. On the other side, stay tuned.
Welcome back to Markets Forward on CNBC TV 18. Time to shift our focus to the big corporate voices of the day. Starting with the major healthcare company, Narayana Hrudayala Health Management spoke to CNBC TV 18 that the company's GCC expansion is aimed at purely strengthening internal capabilities. The management emphasized that driving efficiencies across its hospital network remain a top priority as it looks to make healthcare more affordable and accessible. The management believes it can significantly improve back-ended operations at the acquired hospital and create meaningful long-term value.
Now, in a conversation with CNBC TV 18, Quality Power's management expects revenues of over 900 crore in FY26, margins of above 22%. The company added that the worst is behind in terms of metal prices. For FY27, they expect to see 15 to 20% growth from its traditional business.
Also, we spoke to Pearl Global. They say that uncertainty for textile industry continues but does not foresee significant swing in exports or increase in orders there. They expect volume from manufacturers to improve in the coming season if this is the tariff rate that continues. Pearl Global also says that most favored nation tariff rate applied to all countries, not just India, providing a level playing field for all the textile exporting countries.
And before we call time on the show, Gaurav is here with the important events to watch out for going into tomorrow's session. Gaurav.
Well, as Hormaz, if you look at the last week, it wasn't just you who was on a holiday, it was Chinese market as well. And now Chinese market is set to open. It was shut from February of 16, and after that we will see Chinese market opening. So let's see how it performs and how it does for the investors. Apart from that, from the Chinese market itself, we will be also getting PBOC loan prime rates. Now this is important because we have already seen geopolitical events happening. Other than that, from the US market, we will be getting ADP employment change weekly data and consumer confidence index, and that is something that we will be closely watching out for. For Indian market, first of all, let's focus on Tata Sons board meeting. Now, there are expectations that Mr. N. Chandrasekaran will get his third 5-year term, and that is something that we will closely watch out. Second is that if you look at the stock-specific action, we will be watching out for 5 Paisa because there is going to be a board meeting where they will consider fundraise. And from the IPO market, we will get a new company, PNGS Reva Diamond. Now, this company will open its IPO for investors. This is a 380 crores of IPO, and the price band is set at 367 to 386 rupees per share. So let's see how investors treat this IPO. But all in all, let's also watch out on the stock-specific action in the market tomorrow.
Thank you for that, Gaurav. Take a leave on this edition of Markets Forward from Vinny and me. Thank you for watching. More news and updates continue on the other side.
Hello and welcome to Business 360. I'm Arundhati Ramanan, and here are the headlines that we're tracking for you this evening. Stock markets tread with caution as investors react to U.S. Supreme Court ruling and Trump's new 15% global tariffs. White House appears defiant to carry out its tariff agenda. U.S. Trade Representative says Trump administration will stand by the deals it has signed and expects partners to do the same. Sensex and Nifty end in the green even as IT stocks continue to decline. Mid-caps also underperform the blue chips. Rupee gains over 10 paise against the dollar. Finance Minister Nirmala Sitharaman says Commerce Ministry is reviewing the situation after U.S. Supreme Court ruling and President Trump's fresh tariff threats. The visit of the Indian trade delegation to Washington this week has been delayed. Government sources say both sides need time to evaluate the situation. European Commission says it will not accept any increase in tariffs, demands the U.S. follow the terms of the trade agreement reached last year. China urges the U.S. to lift all the unilateral tariffs. Beijing is making a full assessment of the U.S. court ruling. Haryana government bars IDFC First Bank and AU Small Finance Bank over irregularities in its accounts. IDFC First Bank labels it a fraud and estimates the variance at 590 crore rupees. AU Small Finance Bank claims it followed all protocols. RBI governor rules out any systemic risk. The Indian Air Force has grounded the entire Tejas fleet after one aircraft sustained major damage to its airframe earlier this month, reports PTI. Hindustan Aeronautics calls it a minor technical incident and the aircraft did not crash. India advises its citizens to leave Iran as U.S. military buildup continues. Iran claims encouraging signals from U.S. ahead of the next round of negotiations in Geneva on Thursday. Those were the headlines that we're tracking for you, but the top story this evening, the world has entered a new phase of the trade war, which promises more uncertainty. U.S. President Trump is determined to carry out his tariff agenda despite the Supreme Court ruling calling it illegal. U.S. will need to stop the imposition of current tariffs from tomorrow after the court's verdict. But President Trump imposed a new 10% global tariff just hours after the ruling, and yesterday he raised it to 15%. That is the ceiling allowed under Section 122 of the Trade Act. U.S. Treasury Secretary Scott Bessent also made it clear that U.S. will invoke other legal options to replace tariffs. This includes Section 301 of the Trade Act. Under this section, the U.S. must initiate a probe first and then impose tariffs if needed. A Switzerland-based watchdog called Global Trade Alert says Brazil, China and India are the biggest beneficiaries under the new 15% tariffs. That's because the weighted average tariffs imposed on these three nations will drop substantially under a blanket tariff rate of 15%. On the other hand, countries like the United Kingdom, Italy and Singapore will see an increase in their weight average tariffs as their current effective tariff rates are less than the proposed 15% duty. U.S. Trade Representative Jamieson Greer said the White House will stand by the deals it has signed so far, and it expects all trading partners to honor the deals signed as well.
I've been telling them for a year, whether this case, whether we won or lost, we were going to have tariffs. The president's policy was going to continue. That's why they signed these deals, even while the litigation was pending. So we're having active conversations with them. We want them to understand that these deals are going to be good deals. We expect to stand by them. We expect our partners to stand by them. And I haven't heard anyone yet come to me and say the deal's off. They want to see how this plays out. I'm in active conversation with them on it.
And the rest of the world is coming to grips with the fast-paced developments in the U.S. and its implications for global trade. China's foreign ministry said it is making a full assessment of the U.S. Supreme Court's ruling. It urged Washington to remove all unilateral tariffs, calling it a violation of international trade laws. The European Commission said the current situation is not conducive to deliver a fair and equitable deal. However, the EU has refused to accept any increase in tariffs, saying a deal is a deal, citing the agreement signed between both sides last year. The head of the European Central Bank, Christine Lagarde, said people want business and not lawsuits. She hoped the new tariff plans are sufficiently thought through. Reacting to the U.S. court ruling, French President Emmanuel Macron said it's good to have checks and balances in democracies.
It doesn't seem bad to have Supreme Courts and therefore a rule of law. For those who think Supreme Courts create problems in political life, a Supreme Court looked at the Constitution and said, this is not in line with the Constitution. Now everyone says this is great. There you go. It's good to have checks and balances in democracies.
And back home, Finance Minister Nirmala Sitharaman said the Commerce Ministry is reviewing the situation after the US Supreme Court ruling and President Trump's new 15% global tariffs. India is yet to formally sign the trade deal with the United States, even though President Trump has announced the reduction of tariffs from 50% to 18%. An Indian trade delegation was supposed to travel to Washington this week to finalize the deal. Now that visit has been delayed. Here's the finance minister in the US on the US tariff situation.
On the Indian economy, I think it's a bit too soon for me to comment. But on the trade particularly, aside from the Indian economy in general, the Commerce Ministry is reviewing the situation. The delegation will have to take a call on when they're going to go for further negotiations. So it's a bit too early for me to comment.
Uncertainty continues to prevail over the extent and applicability of US tariffs on several countries, including India. The visit of India's negotiating team to the United States has been postponed and it will be rescheduled at a mutually agreed upon date. Commerce Ministry sources indicated that both the sides were of the view that the proposed visit should be scheduled only after each side has had the time to evaluate the implications of the developments which have unfolded in the past few days. Now, the US Supreme Court had earlier done away with the tariffs which were imposed by the Trump administration last year under the International Emergency Economic Powers Act, post which the Trump administration again indicated imposition of tariffs first to the tune of 10%, followed by 15%. So more clarity is still awaited, not just by India, but by several other economies in this regard. Now, last evening, the EU had issued a statement. The European Commission had sought fair treatment, predictability, and legal certainty on the steps the US aims to undertake post the Supreme Court order. The EU had also said that it wants full clarity on the steps which are being taken or the US intends to take post the Supreme Court order.
So, Abhimanyu there with the latest on the US tariffs. Onto the day's market action. The Lal Street closed largely in the green, with Nifty ending above that 25,700 mark. The mid-cap index underperformed, dragged down by IDFC First Bank and AU Small Finance Bank. Nifty IT continued to extend losses and ended lower for the third straight session. Bitcoin fell below the $66,000 mark, weighed down by uncertainty over the status of US tariffs. Investors' concerns about rising tensions between US and Iran also weighed on prices. The price of Bitcoin has nearly halved since it hit record highs of $125,000 in October last year. Iran has said that indirect talks with the United States on its nuclear program have produced encouraging signals. However, the country's president warned that Tehran is prepared for any scenario. The two countries will begin a second round of indirect talks in Geneva on Thursday. This comes amid mounting fears of a military conflict, with Washington building up its military presence in the Gulf. Meanwhile, India has advised its citizens to leave Iran. Indian citizens have been asked to leave by available means of transport. The Haryana government has barred IDFC First Bank and AU Small Finance Bank over irregularities in its accounts. IDFC First Bank labelled it a fraud and estimated the variance at 590 crore rupees. The lender to the bank said that discrepancies were observed when the Haryana government requested the closure of its account. The bank's shares clocked its steepest fall in 6 years. Meanwhile, AU Small Finance Bank has said it allowed all protocols after transactions of 47 crore rupees from IDFC First Bank were flagged. Ritu Singh is here with all of those details. Ritu?
Two private lenders, IDFC First Bank and AU Small Finance Bank, were under pressure today after informing exchanges that they had been de-impaneled by the Haryana government from handling any government business starting the 18th of Feb. Let's start with IDFC First Bank, where the bank has disclosed a suspected fraud of 590 crore rupees at its Chandigarh branch that involved Haryana government-linked accounts. The issue surfaced when a government entity sought to close its accounts and transfer the funds, and that's when the discrepancy was flagged. Since then, IDFC First First has suspended 4 officials. It has informed regulators and auditors, filed police complaints, and also appointed KPMG for an independent forensic audit. Now, the management says this is a localized issue that is restricted to one branch and one client account and does not impact other customers. Now, financially, 590 crore rupees is not insignificant. It is about 28% of IDFC First Bank's estimated profit for the full year FY26 and equals roughly 19 basis points of its CET1 ratio, which stood at 14.23%. Now, the bank has also clarified that this 590 crore rupees includes a 100 crore precautionary buffer that has also been built in. Now, the Haryana government deposits form just 0.5% of the total deposits for IDFC First Bank, and the bank has already seen outflows of about 200 crores from the account since the news. The final hit is going to depend on the recoveries, the insurance and the legalities, but the bank believes the impact should not exceed 590 crore rupees. The bigger question is whether there is any broader impact on all the state and central government deposits, which form about 8 to 10% of total deposits for IDFC. Brokerages are constructive though. Jefferies maintains a buy with a 100 rupees target, while Investec retains buy, but it has trimmed its target to 92 rupees a share. Now, to AU Small Finance Bank, which was also de-impaneled by the Haryana government, the bank said it received communication regarding suspected unauthorized transactions and is also conducting an internal review at the moment. Some employees have been placed off duty, but AU says there is no indication of any financial loss or fraud that is impacting the bank. The Haryana government deposits there stand at 538 crore rupees, or about 0.4% of the total deposits. So the key focus now going ahead is going to be on the audit findings, on the provisioning clarity and deposit stability, and whether PSU banks like Punjab National Bank in the northern region stand to benefit from these deposit outflows from the private lenders.
As a policy, we do not comment on any individual bank or regulated entity. We are watching the developments. There is no systemic kind of an issue over here.
जो IDFC फर्स्ट बैंक है, इसने सेबी को एक लेटर लिखा और ये कहा कि हमारे यहाँ पर ऐसे करके उन्हें अपने बचाव के अंदर, क्योंकि ऑथराइज बैंक होते हैं, अपने बचाव के अंदर उसने सेबी को लेटर लिखा है और कहा कि कर्मचारी ने गड़बड़ की है। हमने इसको तुरंत एंटी करप्शन ब्यूरो और हमारा जो विभाग, विजिलेंस विभाग है, उसको तुरंत हमने ट्रांसफर किया। पैसा पूर्ण रूप से सुरक्षित है, एक पैसा वापस आएगा। जो दोषी होगा, कोई बख्शने का सवाल नहीं, उसके खिलाफ बिल्कुल सख्त कार्रवाई होगी।
Finance Minister Nirmala Sitharaman and RBI Governor Sanjay Malhotra both believe that rising gold prices are not concerning yet. At a joint press conference with the RBI Governor, the FM said that the central bank is monitoring prices, while the RBI Governor said that India's current account deficit remains manageable.
We are watching it, but I'm not sure it has reached such alarming proportions given the tendency or natural things as it is in India for investing in gold, buying gold, and therefore I think it has not gone in that sense beyond a certain limit. But of course RBI will also be monitoring it.
There is a lot of fluctuation, seasonality in that particular demand, so we are not unduly concerned about that, especially because our external sector continues to be very robust and strong. The current account deficit is still very, very manageable as per our projections. It's within or about the 1% of GDP range. The government has now a number of agreements for trade, international trade, that it has signed, so that will help our current account even further.
The finance minister also flagged mis-selling of financial products by banks as a major concern. FM Nirmala Sitharaman said that banks must prioritize their core business and focus on lending while responding to actual customer needs. She added that lenders should also focus on improving their ratio of current account to savings account.
Mis-selling happening. My pet peeve has always been that you do your core banking business, you're spending more time on selling insurance, where it is not required perhaps. Glad that the RBI is coming up with guidance on why mis-selling is not going to be, entertained And I think the message should go to the banks that you cannot afford to missell. And this word missell, instead of offending anybody, seems to be one more word in the lexicon. Missell is an offense, if you ask me. Don't ask me under which section of Bharatiya Nyaya Sanhita. But it is misselling, right?
And on that note, it is time for us to head into a short break. But coming up, the Indian Air Force has grounded the entire Tejas fleet after one aircraft sustained major damage to its airframe earlier this month, reports PTI. More details when we come back. Welcome back. You're still with us on Business 360. The Bombay High Court has scrapped an interim order and allowed the Bank of Baroda, Indian Overseas Bank and IDBI Bank to resume proceedings to classify Anil Ambani as a fraud borrower. This comes less than a week after the industrialist who was caught in an alleged 40,000 crore rupee bank fraud assured the court he is not a flight risk. He is expected to appear before Enforcement Directorate on Thursday. The Telecom Department has directed the Noida International Airport at Jewar to allow telecom companies to deploy mobile networks. The department said that the airport must comply with rules about telecom infrastructure deployment as it qualifies as a public entity. The department had issued the same directions to Navi Mumbai International Airport just last week. Remember, telcos had flagged that the Noida International Airport set up its own telecom infra and sought to charge a fee. Shares of HAL declined nearly 4% in trade after reports suggested that the Air Force grounded 30 Tejas light combat jets. According to PTI, the aircraft sustained major damage during a routine training sortie, but HAL has called it a minor technical incident. Ria Bhatia is here with all of those details. Ria?
Well, yes, HAL has taken a hit in today's trading session, and earlier there was a report that said that the Indian Air Force has grounded the entire fleet of around 30 single-jet Tejas LCA jets after a crash earlier this month, and the IAF is going to carry out an intensive technical probe as a result of this, and this is as per a PTI report. Now, remember that this incident had actually occurred earlier this month during a landing after a routine training sortie, and the preliminary probe points to a suspected onboard technical glitch. Now, it is also to be noted that this is the third Tejas aircraft lost since its induction into the IAF. The first one was in March of 2024, and the second one was in November of 2025. As of now, there has been no confirmation from the IAF yet on the grounding of the fleet. And apart from this, HAL has also issued a factual clarification saying that there was no crash, but rather it was a technical glitch that led to this incident. But the key thing to be tracked later will be the grounding of the fleet and any further comments from the IAF or on HAL on this matter.
Violence has erupted across Mexico after the country's most wanted drug boss was killed in an operation. The drug lord known as El Mencho was the leader of an infamous cartel and died after being seriously injured in clashes between his supporters and the Mexican army yesterday. The Indian government has issued an advisory to its nationals living in Mexico, requesting them to avoid crowds and seek shelter when needed. Here's a report.
Cars and buildings were torched in Mexico's Jalisco province following the killing of drug lord Nemesio Oseguera, commonly known as El Mencho, in a military operation. That's according to government sources familiar with the operation who spoke to Reuters on Sunday. Mexico's defense ministry said a shootout left Oseguera seriously injured and he died during an air transfer to Mexico City. Oseguera, an ex-police officer, was the leader of the powerful Jalisco New Generation cartel. The Mexican government has been cracking down on local drug cartels after a pressure campaign from the Trump administration, including threats to intervene directly. The Mexican embassy in Washington said on Sunday that the U.S. provided information for the operation. Security forces conducted aerial surveillance on Sunday after the operation set off a wave of violence. Videos and pictures on social media showed vehicles ablaze, sending dark smoke into the sky. Mexican media outlets reported torched cars and gunmen blocking highways in more than half a dozen states across the country. Air Canada said it was temporarily suspending operations in Mexico's Puerto Vallarta. United Airlines and American Airlines said they were also canceling flights in the region. Mexican officials urged people to stay home until the situation was brought under control.
And with that, it is a wrap on this edition of Business 360. More news and updates on the other side. Stay tuned.
The Nifty IT index is down 15% in 2026 amid growing fears that the rapid AI advances could disrupt both Indian IT services and global software companies. Bears warn that AI could erode SaaS demand and shrink the addressable opportunity for IT services, potentially pressurizing revenues. The bulls, however, believe that valuations have turned attractive and argue that the sector has navigated multiple technology shifts before and can do so again. Well, to break the debate down, we are joined by Abhishek Bhandari, the Executive Director, Technology and Internet Equity Research at Nomura India. Well, Abhishek, thanks a lot for joining in. Hello and welcome to Finding Alpha. I'm Nigel D'Souza. We're coming to you live from the Mumbai News Center. Well, Abhishek, you've been writing off late. It's been a very, very busy time for you. So we thank you for coming down to the Mumbai News Center, and we're looking forward to having a good chat.
Pleasure is mine, Nigel.
All right, Abhishek, let's get straight to the point then. Before we get to this entire AI disruption story, give us a broad sense about the size of the Indian IT services, as an industry, and if you could break it down for us, services, products, as well as platforms.
Got it. So NASSCOM pegs the size of the IT industry at around $280 billion.
Okay.
And the rough breakdown is 50% of that is IT services, 20% is ER&D, 20% is business process management, or BPO as we call it, and the remaining 10% is the hardware and the platform business.
Okay, all right. And if we had to put a point, which is the sector or the segment that is most under threat, the BPO part of it would be under threat. Everyone would be in different forms. But if you have to, say AI is going to be the biggest threat to which part of it?
Actually, entire IT services and BPO, because the fear is more on the deflation because of AI.
Okay, all right. Let's talk a little bit about that then. A large chunk of Indian IT revenues, they are linked to the SaaS players. Salesforce, ServiceNow, as well as Oracle, which many believe those companies itself are under threat. Does this create a dual risk for our IT companies, both on volumes as well as on pricing?
That's a good question, Nigel. What has been happening in the US market of late is, the people have written off the SaaS industry, saying that in the AI world, SaaS companies can be wipe-coded away by some startup.
Yes.
And that puts a lot of pressure on their high gross margins, which is around 70 to 80%. The per-seat pricing, which is on the subscription side, which could come under threat because of SaaS. In some extreme cases, people believe SaaS companies can become obsolete altogether.
Okay.
As you would know, IT services companies derive a lot of value by implementing the SaaS products into the client's, IT landscape.
Correct.
That's a fear. Having said that, I think it's too simplistic an assumption. The SaaS players actually have built quite a big moat around the data, the regulatory aspects. They gave a lot of comfort to the enterprises who are buying their products. And the real moat, what they have is the data, what they have created over the last 15, 20, 25 years of existence. In fact, they are also pivoting toward the AI world by creating AI bots and AI agents. And who will be the guys who will be implementing the AI agents into the IT landscape? It will be the system integrators like the IT services.
IT companies.
So I'm not as bearish, on the premise that SaaS companies going away or SaaS companies shrinking will be a bad news for IT. In fact, the scope of work will increase because the work will now shift from just implementing SaaS towards managing the bots, what the SaaS companies are creating.
And that's when our Indian IT companies as well come into play. The software is created and then implementation is upon our Indian IT companies. Okay, all right. Let's talk a little bit more into this now. Since you spoke about the annual deflation, if you could give us an example with regard to these IT contracts. How long or what's the time duration of these IT contracts?
Yeah.
And if you could tell us a little bit about this annual deflation. I understand that over a lifespan of a contract, there is some kind of deflation that takes place. So what has it been in the past? And in the time to come, will that deflation of, say, a couple of percent go up by another couple of percent? Give us an example.
I think this is the most pertinent question, what investors are grappling with in the, wake of the AI disruption. Historically, if you look at it, the book of business for IT services companies typically has a duration of 5 years.
Okay.
So let's call it every year, 20% of the business comes from renewal. Pre-AI world, the typical discounts what IT companies used to give to the clients in a renewal used to range in the range of 15 to 20%. Okay. So the annual impact of deflation was 3 to 4% on your revenue per year in the pre-AI world. Now, what is happening because of AI is there is a lot of automation happening. A lot of automation means lesser effort needed for the same amount of IT work. So the deflation has now increased, from giving a 15, 20% discount to now giving 20 to 30% discount to the clients. And what is happening is, since the clients are seeing more savings upfront, they're also shrinking the renewal cycle from 5 years to a lesser amount.
Right.
So in total, we guess, we estimate rather, would be the deflation because of AI is now ranging in the range of 6 to 7% for the IT services company. That's almost 300 to 400 basis points higher compared to the pre-AI world.
So annual deflation could move from 3 to 4% to around the 6 to 7% mark, which will in turn put pressure on price. And not just that, the renewal time frame as well could come down. So it could be a double whammy out there. Got that. Let's focus on a couple of commentary, that we've got in the last 1 year or so. Nandan Nilekani, he said that around 60 to around 80% of IT budgets, they're locked in maintenance. But now he says that there's going to be a big shift from maintenance towards innovation. Can innovation, spending offset this potential pressure on maintenance? So as of now, when an enterprise or a client gives a particular contract, what is the mix between maintenance and innovation? And how do you see that changing? And do you agree with Nandan?
I think Nandan has made a very valid point that, IT spends are more towards maintaining the estate rather than innovating.
Yes.
And, the general psyche of, any IT spender, an enterprise IT spender would be to keep the tech spending flat, if not improving. Nobody wants to shrink the tech spending because it is very hard, once you drop the tech budget, to get a budget approval again for an increase.
Right.
What happens is typically the budgets are kept flat. Now, what it means is if you're saving some money because of cost savings, because of AI-led, automation, you'd rather reuse it somewhere else.
Yes.
So that's the, general thinking process of the IT, officers, the CISOs, and all those things. Now, since most of the spending is being hawked away right now by the maintenance, very little is left for innovation.
Yes.
Right. So if the maintenance cost comes down, definitely, even with the same tech budget being flat, you can actually spend more on the innovation side.
Right.
Do remember, tech is one of the few things in the humanity where people feel always dissatisfied or, unsatiated because of buying. You always want to buy more and more because the tech is improving constantly. The cycles are becoming shorter.
Yes.
So if the spending, shifts away from maintaining, I think a lot of it will go away into the innovation part.
Right.
So actually, I agree with him. I think the way to think about it is, AI is also making innovation simpler and easier and less risky. As an example, many of the banks are still running legacy mainframe, which may have been written in 60s, 70s. The coders who have written those codes probably do not exist anymore. Or the risk of migrating them, from legacy to modern apps is very high.
Right.
And a typical enterprise buyer is a risk-averse person. He always optimizes his career to reduce risk, focusing less on cost and innovation. With AI, this can actually change. A lot of the mainframe or migration or upgradation may happen at a significantly lower price and at a risk which is significantly lower compared to the pre-AI world. So I think AI definitely opens up a lot of opportunities. And I think the investments will definitely shift away from maintenance towards more on innovation.
So as of now, ballpark for the industry will be 70-30, 70 towards maintenance and 30 towards innovation. And in the time to come, innovation could move from around the 30% to 40, 45% or thereabouts.
It should go up. The pace of going up depends on the enterprise's willingness to adopt the new tech.
Indeed. And that's going to be quite interesting because as a customer, as a consumer, you're far okay to adapt to AI, but otherwise on the enterprise side it's going to be quite interesting to see how adaptation takes place. Since we spoke about Nandan, I also want to talk about Salil Parekh. He has pegged that AI first services opportunity could be $300 to $400 billion or thereabouts by 2030. How realistic is this? Because data sanitization or even cloud migration opportunity could be large, even in this sort of an AI world. Would you agree with this estimate, 300 to around 400 billion?
I wouldn't comment on the number, but the way to think about it is the typical IT landscape of any enterprise is very messy. They have been built over multiple enterprise solutions over a period of time. The data are often siloed; they don't talk to each other.
Right.
And the key raw material, as I say, to make your AI strategy successful is cleansed data. The data has to be cleansed, the data has to be sanitized, and data has to be harmonized across your enterprise.
Correct.
Who will do that work for you? A person who understands the context of your IT, none other than your IT vendor, who has been working with you for a long time, who's also a system integrator, by the way, who has implemented multiple solutions over a period of time, and he knows which is sitting where. So I think definitely the data migration and the cloud migration being the preparatory work for AI, for IT, for the enterprises to become AI ready will be a big opportunity. An IT services company will definitely play a role in that.
So data sanitization as well as cloud migration, there will be a role for Indian IT companies to play even in that.
Yes.
Got that. All right. But But the counter view is that, enterprise tech is far more complex than, say, a consumer-led AI. So adoption and deployment will take time. Where do you stand on the pace of disruption? That's going to be quite interesting. Because there is a bit of a gap right now, between, an AI tool coming about and it's getting implemented. And at the enterprise level, it will be a little bit more elongated. So what do you think about that?
Sure. I think, AI in that way is slightly different from the previous tech. In the previous tech, we have seen first the B2B or the enterprise adoption being faster and higher compared to the consumer side.
Right.
It's just flipped, because in the AI world. And you and I, keep getting better models, in our GPT subscriptions or Gemini subscriptions every week. So the pace of innovation definitely is, moving very fast. Every model maker, every large, infrastructure developer on the AI wants to become top of the podium, and that's the innovation which is driving the models becoming better and better every day. The reality on the, the enterprise side is that enterprises, customers are very skeptical yet. They see multiple unanswered questions. What is the, the legal sanctity of these models? What are the guardrails around compliances? Copyrights issues, etc. So they're quite cautious and slow in terms of adopting AI.
Yes.
So what they're doing right now is, they're starting off with POCs. Give me a small proof of concept with a small project. If it makes sense, then I'll probably roll out a bigger project for my entire IT landscape. So enterprise companies are going slower, but nowadays we have started hearing comments regularly from the IT companies, not only from Indian, but the global companies, that the projects have started becoming a little larger.
Yes.
From POCs, now they're moving to enterprise-wide adoption. Still, from a number perspective, if revenue numbers of Infosys, TCS, or Accenture is any indicator, AI is still just mid-single digit, between 5 and 6%.
Right.
So still small, but rising. I think the real wave of AI adoption will come once the macro becomes a little stabler, because that's, I think, is the necessary requirement for any big invention and a big investment to be made into the AI from an enterprise side. And also, once it's clear that AI can move just not from cost saving, which is the automation-led benefit, towards the revenue side, that's when enterprises will start coming through. So I think it's a matter of time. Even before AI becoming mainstream, the preparatory work of that will start. Again, going back to your previous point, in the previous discussion we had, the data migration and the cloud will be a prerequisite for any larger AI project to happen for any enterprise.
All right. The sense that I'm getting is, don't just throw in the towel with regard to these IT companies.
Yeah.
There still could be plenty of work for them to do, even in an AI-led world. So that's quite interesting. But the question is revenue growth, growth, growth. That's what the street looks at very, very closely. And you have outlined multiple growth scenarios. So if we could walk us through the key bull, bear, as well as the base scenarios. Depending on growth, what kind of multiple will you give our IT companies? They have come down a large deal, from the top. So highlight those three big scenarios.
Sure. If you look at the bear case, which is the topical theme in the market right now, the bear case is this company's business models becomes obsolete. They're not able to replace the deflation in revenue with a new stream of revenue on AI, and they struggle on growth. They may possibly have a negative growth, or in the best case, very early single-digit 2 to 3% growth. They keep margins stable, by optimizing on the workforce. You will work in a scenario where the EPS growth becomes zero or close to, -1, -2%. Now, those kind of companies, X growth, in our view, could trade at 10 to 12 times.
Okay.
That's the extreme bear, assuming these business models will become extreme. The base case is, the IT companies I would say adapt themselves, which they have done in the past tech cycles. Right now, we are going through the valley, as I call it, where the deflation of revenue is hitting first. The ascent into the mountain, which is the AI-led revenue, is taking longer than expected. But it will come. Ultimately, the AI models have to get monetized. If somebody has to monetize the model, somebody has to implement the model. And the implementers are nothing but the system integrators, which are the IT services companies.
Right.
In that case, I think the growth will come back towards mid to high single digit, in the range of 5 to 7, 5 to 8%, as you call it. In that case, I think the large cap IT may still go back towards early 20s in terms of multiple.
All right. That's the base case.
That's the base case. The bull case, is the IT companies pivot completely from just being, service providers to become value creators. What I mean by that is, the service model changes from labor, intensive work towards more like a platform.
Yes.
Where the company starts selling services as a software. This is, I would say, a low probability event right now because we don't see too much of evidence of it right now. But if this were to turn out to be true, you could see a lot of non-linearity in revenue and the margins. And the multiples, in that case could range even up to 30 times, for the good large cap IT companies. So I would say we are more of the base camp. We think IT companies in the past have demonstrated their ability to navigate tech cycles. Of course, tech cycle always has a deflationary curve followed by a volume increase curve.
Yes.
We are currently more in the deflationary side, and the volume is yet to come. But we think volume will come because the AI has to be monetized and AI has to be implemented in the IT landscapes.
Well put, Abhishek. You're helping us out with that. With regard, if things really go bad and there is no growth, there could be a marginal degrowth, then 10 to 12 times. If they get back to their growing base, 5 to around 7-8% odd, then maybe they get back to the early 20s. Yeah. And if it's all bombastic and things look very, very good, then maybe high 20s or maybe a 30 multiple as well. So we have got those three scenarios out of the way. Bear, base as well as bull. But my argument is, Cognizant. That's the large name, right, globally? That trades at what? 10.5, 11 times or thereabouts its forward earnings. But Indian IT companies, historically, we know they have traded a bit of a premium. Do you think in this sort of a scenario, does this valuation gap actually narrow between, say, an IT company in India that trades between, 16 to around 24 times, very, very approximately, and a Cognizant that's trading at around 10 to around 11 times? Will that gap narrow, or do you expect India to continue to trade at that premium?
See, traditionally, the US market is more software and innovation market, where the multiples for software stocks have been higher and the services multiples have been lower.
Yeah.
And Cognizant is no different. Cognizant actually has gone through a patchy period of growth. We cover the stock. We have seen periods of low growth and now, coming back on growth under Ravi as the CEO. Having said that, the other services stock in US is Accenture, which trades at around 15 times Bloomberg consensus earnings. So definitely the gap between the Indian IT companies and the large IT companies in the US has fallen quite a bit. We have seen the gap almost being 30 to 40%. Now the gap is hardly 15 to 20%. Having said that, I think we have to look at the multiples of Indian IT companies in the context of Indian markets, because there are certain nuances of the Indian market which give a premium to the IT stocks in India.
Correct.
Mainly the high dividend yields they have, which is higher than the market average rate, extremely strong corporate governance, free cash flow yields, etc. And for the first time, in the last 4 or 5 years, we have seen the gap between the broader market and the IT stocks now falling down to zero.
Right.
And even IT on their own standalone basis, they have fallen below their long-term average growth multiples. So I think right now the market is more, tilting towards the pessimism, which is why the multiples are under stress. I think the global multiples on services, especially in US, always have a local nuance. So, I don't think it's right to compare the two.
Not right to compare.
Having said that, the valuation gap between Indian and US stocks have converged.
Right. And just to, since you mentioned, one of the factors that investors are holding on to is the dividend yield as well as the cash flow yield. What is it at currently?
5%.
5%. All right. Got that. Abhishek, request you to hold on to that thought. We got a couple of queries as well coming in there, and we want to discuss your top picks. For the time being, we take a short break. Come back, we continue our discussion with Abhishek. You'll get a lot of your answers to your queries. Stay tuned. Welcome back. You're tuned into Finding Alpha, and we have Abhishek of Nomura who's helping us out with everything tech. And as you all would want to know, there are a couple of queries as well that have come in there because you all want to know which stocks are best placed. So let's get straight to the first query that's come in. We have a query coming in from Rakesh Arora, who writes to us from New Delhi. He wants to know the top IT stocks to invest in. And he's broken it up into 3 buckets: large, mid, as well as small cap stocks. Abhishek, what's on your radar?
Sure. So I think in the large caps, we like Infosys and Cognizant the most. We think they will continue to gain market share. They'll grow at a rate which will be higher than the peer average.
Okay.
In the mid cap, Coforge is the preferred pick. We think the company's ability to deliver mid-teens growth exists. And some of the large recent acquisitions, will help it become bigger in size and get access to more number of clients, the relevant ones. On the small cap, we like eClerx the most. It's a BPO company, but I would just like to clarify here the perception that BPO companies will all get disrupted, which is true partly on the BPO, voice side. The voice component for eClerx is quite low, is below 10%. I think they will be a beneficiary on the platform side of the BPO, and we see them sustaining close to 15% revenue growth in the medium to long term.
Okay, all right. So that's the top picks there: Infosys, Coforge, as well as eClerx, as you mentioned. All right, got that. We got another query that's come in there, so let's take that out of the way. Priya Datta writes to us from Kolkata. She wants to know the outlook on the Indian IT sectors over the next 2 years. Now, this is an interesting one. Will the sector emerge as an AI beneficiary, or is it going to be an AI casualty? Tell us, Abhishek, what do you think?
I think, the IT companies are going to be AI beneficiaries in the medium to long term. Taking a step back, the IT companies are system integrators. They integrate your different types of software tools, or they innovate on top of it. And the need of system integrators even become more and more important in the AI world, where the pace of innovation will increase. That's one. And also, remember, IT companies have worked with their vendors, with their clients for a very long period of time. They understand the context of every enterprise, in a much deeper way compared to maybe a software company. And AI is all about context. AI for a bank is different for AI for a services company, or AI for a consumer company. And even in the same vertical, the need and usage may be different. So I think the context understanding of IT companies is a very big, positive asset they carry. And that's the reason I think, they will be beneficiary in the medium to long term.
Okay.
Just to, recap, I think we are going through a revenue deflation first, where people have written off, the potential revenue gains, only thinking about the near-term revenue deflation because of AI. But the reality is, tech brings down prices. Eventually, it gets compensated by volumes.
Yes.
The ones who will be able to pivot by changing the business models, their operating models, those will be the winners in the AI world.
All right. Very quickly, Abhishek, before we let you go, there's so much of talk about GCC setting up shop in India. Now, if this AI adoption is going to gain momentum, do you think that's at risk? Because the entire cheaper labor argument goes out of the window. What's your take?
I think it's a myth that all the GCCs in India are built only because of labor, cost reasons. Many of them actually are kind of a internal IT department, not in the US, but in India. They're often created for innovation reasons.
Yes.
So I don't, completely agree that, AI will, swing the, mass away from GCC into something else. In fact, the GCC's role will become even more critical. Many of them will become a very important, strategy implementer of the AI side of their respective organizations. The numbers may change, the number of hiring may change, but the strategy to open a GCC will remain, because India is still a very large talent supplier at scale, at quality, which not many parts in the world can offer.
Okay, all right, Abhishek, it's been a pleasure having you on the show. Thanks a lot for joining in on Finding Alpha, breaking down this entire tech tumble debate. And it appears you believe that maybe tech still has a bigger role to play in the time to come. Thanks a lot for joining in.
Thanks, Nigel.
Well, on that note, we'll wrap up on this edition of Finding Alpha. Thanks a lot for watching. Stay tuned. More updates coming up.
Hello and welcome to Trump Watch. I'm Parikshit Luthra. The news of the United States Supreme Court striking down President Donald Trump's tariffs imposed under the International Emergency Economic Powers Act came as a major relief, with many businesses welcoming the prospect of recovering funds previously collected within hours. However, President Trump announced a new 10% tariff, raising it to 15% the following day, reviving the very uncertainty many believed the court's ruling had ended. While the Supreme Court's decision invalidated the use of IPA for those tariffs, it also made clear that clearer statutory authority, potentially granting broader, more explicit powers to the president, would be required going forward. Although the court ruling said that imposing tariffs under IPA was illegal, it stopped short of saying that the US should refund the tariff revenue collected from businesses. Meanwhile, Trump warned that the refund process could remain stuck in court for the next 5 years. Reports state that refunds could be worth around $175 billion. Experts fear the refund process itself could be messy, with cases likely heading to the United States Court of International Trade. Reports suggest that more than 1,000 refund lawsuits have already been filed by importers, and this number is likely to rise in the coming days. So what happens now? Do businesses have viable legal options, or will there be renewed uncertainty? And will this make further legal challenges even harder to pursue? Joining us right now to take this forward is Gaurav Ganguly, Head of International Economics with Moody's Analytics, former Indian Ambassador Mohan Kumar as well. Ambassador Kumar, let me begin by asking you about the Section 122 of the Trade Act of 1974, which Donald Trump has used to first impose a 10% temporary tariff, then raising it to 15%. Can this stand legal scrutiny?
Thank you very much for having me, Parikshit. My sense is that this is legally a little bit on a shaky ground, mainly because Section 122 is mainly used for international payments problem. You need to have a balance of payments problem. And it's hard to argue that the United States has a balance of payments problem just now. But the fact of the matter is, this does not require prior investigation by any authority like the Commerce Department or the USTR. There is presidential authority which has been used to impose 15%. It can last 150 days. And really, by the time you make a legal case against it, take it to the courts, my sense is the 150 days will be gone. My assessment is the Trump administration is using it as a stopgap measure until it figures out whether they want to use much more long-standing instruments such as 301, the national security, which is 232, or even 338. And we will talk about it a little later. But the fact of the matter is, right now, this does not reduce uncertainty. It merely gives the Trump administration some breathing space, because nothing can be done about this 15%. And I sense that this will last about 150 days. By the time the cases reach the court, this would have become an academic thing, whether you want to oppose it or not.
All right. We're also joined by U.S. Attorney Greg Huzishan. Greg, thank you very much for joining us on the program. Greg, a partner at Foley and Lardner LLP. Can people claim refunds right now? We believe there are thousands of lawsuits in the United States, but if countries try to do it at a government level, is there an option to do so?
No, governments cannot claim refunds. Refunds can only be claimed by the importer of record, which is the company that initially paid the tariffs. Usually that's going to be a US company, although it's possible it could be a company from India.
Right. But Greg, what about trade deals? India, just about 2 weeks ago, had managed to agree upon a trade deal with the United States for an 18% reciprocal tariff. They had agreed upon a joint statement. The deal was supposed to be inked in March. What happens to that?
So in all likelihood, foreign governments are going to stick to the deals because they're going to be concerned that President Trump would retaliate if they withdrew from the deals. Although the IEEPA tariffs were invalidated, there's still a lot of trade authorities out there like Section 232 or 301 that might be a little bit more cumbersome and a little bit slower, but they still give the president a lot of discretion to impose tariffs. So in all likelihood, companies or countries are going to stick to the deals because they fear the uncertainty of what would happen if they did not.
Right. Gaurav, thank you for joining us as well. Does this inject a lot of uncertainty into the global trading system? Do you expect countries like India to sit back and just watch and observe what happens over the next 150 days?
Thank you for having me, Parikshit. Yes, I think it does inject some uncertainty into the global economic system, but I'd like to point out that this uncertainty is less than the uncertainty we had in mind or felt, definitely, after the Liberation Day announcements. The world has become used to the concept of tariffs from the US, and what we have seen from the administration is largely a continuation of what has been in place for the past few months. So uncertainty definitely on the rise here, but not to extreme levels. I would say that countries are definitely in watch and see mode. From the announcements we've heard from various administrations around the world, countries are looking to see what's going to happen. In some cases, such as the European Union, there is concern that they're actually going to be penalized a bit further. UK and Australia in the same boat. Country like India thinking, well, actually, it's going to benefit because tariffs are going to come down. But I would say that it's in every country's interest to get into a wait-and-see mode to see what happens. Many countries, as part of their trade deals, have made infeasible purchase and investment pledges. There will be every incentive now to just sit back and watch and see what happens and slow walk the ratification of these deals. Yes, the US has measures it can take, and yes, I'm sure that they will come back and try and penalize countries that do not ratify these trade deals, but they've also lost a certain amount of power as a result of the Supreme Court ruling. And if I were a country on the other side of a trade deal, right now, I'd be watching and waiting.
Okay. Ambassador Mohan Kumar, to get you back in, the Indian chief negotiator Darpan Jain was supposed to fly to Washington, D.C. this week to finalize the terms of the trade agreement, which would have to be legally signed by Jamieson Gray and Piyush Goyal in the month of March, in the middle of March. That's not happening. They've put off the visit for the moment. Should India try and negotiate better terms, or should they wait and watch? Will the Trump administration honor the terms agreed upon earlier?
I think I find it interesting that the visit by the chief negotiator from India has been put off by mutual agreement. I was very keen to watch whether India is postponing the visit unilaterally or is it going to be done by mutual agreement. And I'm somewhat comforted that both sides talked and then they put out a joint statement saying both sides have agreed that this is not the time for the chief negotiator from India to go to the US, and that we will find another time to do it. Second, I echo the views of my co-panelists who just spoke. No question, everybody will wait and watch. Especially, this is a larger battle, Parikshit, on the major questions doctrine and the power of the Congress alone to impose tariffs. And I don't want to take time of your program, but there is a battle between the judiciary and the executive and the legislature. And this is a larger issue that will get sorted out over time, I suspect. And until that time, countries will be wary. As far as India is concerned, my mantra would be no reneging on the deal, which we agreed, at least in theory, but no finalization of the deal until we get some clarification. You don't want a situation where you agree to something with the US and then 3 months down the line, you see a Section 301 investigation against India. That is not something that India would want. So by and large, I see India essentially waiting and watching, but also trying to make a reassessment of the situation in the sense there are areas where India sought 0% duty. And what happens to those? Do we get 0% despite this omnibus declaration by President Trump of 15%? Or does it go back to 15%? Because that will make a difference to India's assessment of balance of benefits and concessions. But more than anything else, I would urge India to talk to the US so as to read their mind, get some solid assurance that, listen, if we do stick by the deal, then do we have predictability in terms of tariffs? You don't want a situation where after 150 days, you either go back to some other section. We don't have the time to talk of sections, but there is another section 338 in which there is no limit at all. And if the president were to use that section, which has never been used before, then if there is alleged discrimination against American commerce, then there is no limit to the tariffs that the president can impose. So I would say essentially wait and watch, but be in continuous dialogue with the US to seek clarity about whether we can stick to a deal which will then not be reneged by either side.
Right. Let me get in Greg once again. So, Greg, that indeed is the important question. If India sticks with this trade deal, where we concluded that the tariffs for Indian products going to the US will be at 18%, most US industrial goods and some agricultural items will become zero in India. India will also get zero duty access on certain products. Will Donald Trump be able to ensure that the deal continues on these terms after 150 days? Can he give some legal effect to this deal with India, which will further not get challenged in the US Supreme Court?
Well, first of all, anything he does on tariffs will be challenged and potentially go to the Supreme Court. I think there's two issues. One, it's a virtual certainty that there will be more Section 232 sectoral tariffs like we see on steel, aluminum, and copper. Anytime that there's some kind of national security angle, and we've seen that the president is treating them as, even when there's deals in place, that he can impose these sectoral tariffs. So that's one wild card to see how much the Section 232 sectoral tariffs expand. And the president can use Section 301 as a way to undergird the existing deal or as a way to punish companies that don't come to a deal. So my expectation is they're going to use Section 301, first of all, to go after countries that do not have a framework deal in place, and that in general, the president views the deals that have been struck as advantageous to the United States. So there's likely to be some stability with regard to the overall framework deal with India, taking into account that there may be some targeted tariffs that go after specific types of products under Section 232.
All right, we'll take a short break at this point, but I'll request all our guests, Ambassador Mohan Kumar, Gaurav Ganguly, and Greg, to stay with us. We'll be right back. Welcome back to Trump Watch, the discussion with Gaurav Ganguly of Moody's Analytics, Greg Hussein of Foley and Lardner, and former Indian diplomat Mohan Kumar continues. Gaurav, if I can ask you, do you expect the European Union and China to negotiate harder with the United States now?
I think that's a really interesting question because it's clear that China certainly has demonstrated its leverage in previous conversations with the US, and the EU is starting to become much more active in thinking about its leverage. So yes, I do think on both sides there is a case to be made here for both for the EU and for China to start to think about how to address this issue of negotiating with the US, knowing full well that the US now has its hands tied a bit. I'll take the example of secondary tariffs, which the US has been quite quick to use with regards to India, levying 25%, 50% because India's purchases of Russian oil. This sort of use of tariffs is going to be much harder now. And that's going to make it easier for big powers such as the EU and China to think about approaching the US the way they want to conduct their negotiation. However, I think on both sides, certainly in the short term, there is going to be an element of watchfulness, waiting to see what develops next, trying to understand the next moves the administration might make, how it may come back to these areas with further tariffs under Section 301, 232, etc. But yes, I think it's clear to say that these big powers will feel that they're in a stronger position.
All right, let me go back to Greg at this point. Greg, in terms of refunds, the Reuters agency reported on the 20th of February that the Supreme Court decision striking down the IPA tariffs made more than $175 billion in U.S. Treasury revenue generated by IPA subject to potential refunds. Will the Trump administration resort to some laws to prevent these refunds from taking place?
So the Supreme Court decision did not mention the word refunds. Instead, it sent it back to the Court of International Trade to consider that issue. And it is likely that the administration is going to push back on refunds because President Trump views them as very important and has promised them to be used in different ways to help reduce the deficit, to help farmers in all sorts of different ways. So we expect that there's going to be another round of fighting over the refunds and that the issue potentially will go back to the Court of Appeals for the Federal Circuit and back to the Supreme Court to consider again. But in the long run, it's hard to see how the US government can keep tariffs that were collected under a law that the Supreme Court has said doesn't support the tariffs. And so the fact that the administration used IEPA rather than other tariff authorities could turn out to mean that the US government can't keep the money. But it's going to be a long fight of probably a year or more until we know the answer to that.
Right. Ambassador Mohan Kumar, clearly this is a period of uncertainty for exporters for whom contracts are usually for 6 to 7 months. So even for people who are buying Indian products in the US, this will inject a certain amount of uncertainty. But behind the scenes, what do you think are the kind of clarifications the Indian government would be seeking from the United States?
So before I come to the clarification, let me say this. One of the ironic impacts of the Supreme Court judgment and the President Trumpian, resort to Section 122 is that countries which were on the mat, like China and Brazil, and to some extent India, now find themselves in a relatively better position. And countries which had negotiated a deal and thought they had a good deal, like the UK, EU, South Korea, and others, now suddenly find that these don't suit them so much because they had actually undertaken to invest a certain amount of money, buy Boeing aircrafts, etc., to get the tariff down to 10%. In the case of UK, and in the case of EU, 15%. So actually in the European Union, there is a tremendous demand in the European Parliament now to completely renegotiate the deal. It has not been ratified by the European Parliament, and they're saying, why do you want to ratify a deal like this? China, on the other hand, is relatively better off after this than before the Supreme Court judgment. So my assessment is China will make some noise, but it's not too badly off compared to before. And in any case, they will not do anything. Neither side will do anything to disrupt the all-important meeting between President Trump and Xi Jinping scheduled to take place in March. As far as India is concerned, I think we are not in such a bad situation compared to several others, but I would urge that we continue to negotiate with the United States, seek as much clarity and assurance as possible in the circumstances, if nothing else, to ward off future 301 or 232 assessments. The most important thing, Parikshit, is pharmaceuticals and electronics right now enjoy 0%, and they should remain that way. 50% of Indian exports are okay as of today. They continue to be okay while we seek concessions for other areas like textiles and garments and shrimps and so on. So all in all, India is not in dire straits, but we need to seek some assurance so that there is predictability and security for Indian exporters in a market that constitutes 20% of Indian exports.
All right. Thank you very much, Ambassador Mohan Kumar, Greg and Gaurav Ganguly for being with us here on the program. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
Welcome. You're watching The Global Reset with me, Prashant Nair. Today, I'll be speaking with two very important, distinct voices. First up, JP Morgan, Sajid Chinoy, needs no introduction, one of the top economists in the country, and of course, tariffs, the tariff changes which have happened over the weekend and what it means for India. A little later after that, we'll speak with GIB Asset Management's Kunal Desai as we unpack, of course, the return of tariffs, but more specifically, that's a market conversation that we will have. Now, let me just quickly run you through the big news, right? The U.S. Supreme Court on Friday struck down the global tariffs imposed by U.S. President Donald Trump. 6 out of the 9 Supreme Court judges, including Chief Justice Roberts, voted to scrap the IEEPA tariffs, which basically were the emergency law from 1970. The court said that this particular section does not authorize the president to impose tariffs on other nations. That power is only vested with the U.S. Congress. President Trump lashed out at the Supreme Court, calling the 6 judges who ruled against tariffs as a disgrace to the nation. And Trump, after initially announcing a 10% global tariff, post the Supreme Court decision, raised that number to 15% on Saturday. So now, as of now, and we still are waiting for the executive order from President Trump, from the post that he put out, the global tariffs now stand at 15%. The president, of course, went on to call the Supreme Court decision ridiculous, poorly written, and extraordinarily anti-American in nature. Well, this is President Trump at a media conference confirming that deals with other countries, including India, stand as is. Listen in what he had to say.
The India deal is on here.
Mr. President. Thank you so much, Mr. President.
All the deals are on. We're just going to do it a different way.
The framework which is to be signed with India sometime soon, will that stand now? And on the decision, nothing changes?
No, nothing changes. They'll be paying tariffs, and we will not be paying tariffs. Our deal with India is they pay tariffs. This is a reversal from what it used to be, as you know. India, and I think Prime Minister Modi is a great gentleman, a great man, actually. But he was much smarter than the people that he was against in terms of the United States. He was ripping us off in India. So we made a deal with India, and it's a fair deal now. And we are not paying tariffs to them, and they are paying tariffs. We did a little flip.
Okay, back home here in India, we've rescheduled the planned visit to Washington aimed at firming up an interim trade deal with the U.S. The development follows after that action by the Supreme Court in the U.S. Now, according to sources from the Commerce Ministry, the said meeting will now be rescheduled at a mutually convenient date. Additionally, the visit will be rescheduled after both sides have had the time to evaluate the latest developments and their implications in that sense. Well, let's welcome in Sajid Chinoy, who is with us. He's head of Asia Economic Research at JP Morgan. Sajid, good afternoon, I should say, and thanks very much for joining us. 10, 15, and then 15 for now. So where does it put us, Sajid? The earlier number was 18. It's 15 now, so slightly 3% better. So we'll take what we get. What's your sense?
Prashant, several layers to unpack here. Let's go one at a time. The first is, for those paying attention, like yourself, in the last few months, none of this should be a surprise, right? The first part is the Supreme Court back in November had expressed a lot of skepticism that the president had in its oral arguments. It had the power on IEEPA. So most market participants had expected the Supreme Court would reverse IEEPA. That's not a surprise. Neither is the fact that the president has doubled down using other sections of the law, because that was always the intent. I think it's important to get the numbers right. The effective realized rate in the US today, that is the tariff revenue collected divided by total imports, is about 9.4%, right? And that's what's the source of the tariff revenue. And the idea always was, the administration had signaled this before, that if IEEPA gets resolved, we'll have a plan B. We want to go close to that 9.4% rate. And that's exactly what's happened. That if the president had only imposed 10% under Section 122, the effective rate would have been 7.6, which is 2 percentage points below. Now with 15%, it's 8.8% or so. So on the surface, it seems like nothing has changed, because we're going to go back to where we started. The effective rate is going to be very close to 9%, the realized rate. But in the actuality, a lot has changed. And I think the tariff process, which has been uncertain and messy over the last 12 months, has just gotten messier, because the 122 is only applicable for 5 months, and the team will use that 5 months as a bridge to impose Section 301. But 301s, as we saw with China in 2018, can't be done with the stroke of a pen. It requires long investigations, sometimes at the product level. It requires public hearings. And so this is going to be a very messy process where a number of 301 investigations take place, country by country, and exporters and importers will get to know from the public hearings which goods may be tariffed at what rate. So we may end up at the same point in terms of a macro outcome, that the effective rate is going to be close to 9%, but the transition is going to be extremely messy. Now, what does this mean for countries like India? First and foremost, the effective tariff rate matters. Under the 18% deal, our effective rate was 16.9. Our calculation is if under 15%, our effective rate is about 15.1. So it's about a 1.8 percentage point decline, because remember, there are still exemptions that hold, and there are still 232s on steel, aluminium, copper, autos that also hold. So I think from India's perspective, the tariff rate doesn't change very much. But I'll say a couple of final things. Now the incentive to front load will be greater, because for countries like India, some sectors we're going to face 18%, which may happen in 5 or 6 months. Now you're facing 15%, so you want to front load. That said, there is no differentiation across countries, right? Because you had differentiation in under AIPA. Now India and its competitors, say for most sectors that are not under Section 232, will face the same 15% rate. So at some level, you're neither at an advantage nor at a disadvantage. Last point I'll make is there'll be winners and losers in this process. So immediately, Singapore's rate has gone up. Europe is worried that its rate is going up. India's rate has come down. So this is going to be a very messy process, in the coming months.
In terms of, it's all relative, right? The rate in that sense. Some are losers and some are winners, Sajid. You said Singapore has gone up, right? But if I look at the Asia-Pacific region, right? China gets a big advantage. Its rate drops quite a bit, perhaps the most. Bangladesh's rate drops by about some 4% or so. Cambodia, Indonesia, right? India also drops. But actually, relatively speaking to the countries I mentioned, if these numbers hold, we are kind of worse off than we were before. Would you agree, Sajid?
So again, Prashant, two things. This is all we're assuming for 5 months, right? Because the idea is that in these 5 months, you will use country-specific 301 deals to go back to the rate that existed in the AIPA. So President Trump would like to go back to a situation where there's a particular tariff on Bangladesh, a particular tariff on Singapore, a particular tariff on India. So firstly, we're talking only about the interim period. Now, in the interim period, you can define winners and losers in 2 ways. Yes, if you had a higher tariff rate and that's gone down to 15, you've relatively gained. But on the other hand, now everybody is at the same level of 15%. So if you think of this from a macro perspective, some of India's exporters will neither be at a disadvantage nor at an advantage compared to some other countries. What matters is then imports to the US are determined not by differential rates, but by what the tariff rate that US consumers face. And so US consumers are also going to face an effective rate very similar to what they saw at, during AIPA. So short point is the macro impact per se, at the highest level may not be that large for the US, because the consumers will not face a very different effective tariff rate. There'll be cross-sectional winners and losers. But remember, those winners and losers are for 5 months. And then the idea is tariff rates will again change under 301. So I think the only thing we can say right now is countries that had a higher tariff rate before, who've seen that tariff rate go down, those exporters will be incentivized to front load, knowing that after 5 months, rates go up. Think of this as what happened between April, May, June of last year.
Yeah.
Liberation Day tariffs were announced, then they were paused. Everybody knew tariffs were coming back in 3 months, and people front loaded.
Yeah. So in that sense, for this 5 months, right, at least, we are at a bit of a disadvantage in that sense. Tariffs, right, compared to some of these other Southeast Asian countries that I mentioned, Sajid. Because if we were at 18, somebody was at 20, now they go over to 15, right? But we were at 18, or somebody was 25 and they go to 15. We were at 18, we go to 15. Now everyone is 15. So that relative advantage just kind of disappears in that sense, at least for this period.
Yes, and Prashant, the question is, did we have a relative advantage to start with? Because under the trade deal that we were going to sign, our effective rate was going to be 16.9. which was very similar to the effective rate, again, not sector specific, effective rate of most countries in the region. Most countries in the region were between 16 and 18 to 19%. So I'm not sure that's a meaningful difference.
Right.
We were in the ballpark then, we're in the ballpark now.
Got that. I had a couple of managements in the morning, one from auto ancillary, the other from the textile space. And I asked that front-loading question to the textile player. But he said, well, not really. I mean, if there was a 10%, there would have been huge front-loading. But now it's like, 18, 15. And this is on top of the MFN. So 15 plus 15, especially, right? So now
that's fair. And I think it's that applies more to countries where the tariff rate, as you said, was higher. And has now come down to 15. I think the bigger point here is the uncertainty on investment. So just think of US investment and US importers. Look at the kind of uncertainty they're now facing. There was a certain tariff schedule until Friday. Those tariff schedules have now been completely replaced. In 5 months, you're going to have another tariff rate, right? In these 5 months, there are going to be messy public hearings about countries and sectors. So I think for me, the macro impact is that will we see investment slowing down because this is just heightened business uncertainty.
Yeah, I have a few other more questions, Sajid, right? And this is in the realm of theoretical now possibilities, right? Midterms are coming. Approval ratings are low for President Trump. Do you think it's possible he does nothing till November and he kind of sort of extends this or whatever? I mean, blames it all on the judges for letting go of revenue which was coming to America. And then post midterms, he kind of picks up on this. Is it a possibility?
Very unlikely, Prashant. Very unlikely. Okay. I think what we've consistently underestimated for 4 decades is Mr. Trump's ideological inclination towards tariffs, right? And so, and I think there are 2 things. One is he actually believes that tariffs are the way to resolve, balance of payments, imbalances, and current account deficits, which us economists don't think is the right way to go. I think a current account deficit fundamentally reflects an investment savings gap of the home economy. That's what you need to correct. But I think it's clear from all the actions. Everyone said this even in April that, is this taco? And will President Trump, and he didn't. The effective rate was quite high. So I don't think they're going to back out. Also, he believes in this, but also now there are real revenues at stake. The US fiscal deficit goes up by 0.5% of GDP if IPA revenues are not replaced. So I think that they will find a way to get to the effective to an effective rate very close to what existed under IPA.
Okay, quickly 3-4 more questions, Sajid, if I can. So 122, I've got a lot of people calling me saying, well, why 122 is also will be challenged. It's already being challenged. It's not tenable. So what do you say to that?
Again, I'm not a legal scholar, but there are questions to say that 122 is only applicable when you have a balance of payments crisis. Is there a balance of payments crisis? This will be legally challenged. But here's the interesting part, that first the court has to ask the question whether it has the power to decide what a balance of payments crisis is, which is something that falls under the executive. So first that process has to be answered, that, can a court decide on how to define balance of payments crisis? And then if it does, can it then decide on whether this is the right use of the law? Short point is, most people believe that process itself is going to take many, many months, if not years. And therefore, the bridge that President Trump seeks, will not be under threat. He's just using this for 5 months so he can push together Section 301. So as long as courts don't rule on this for 5 months, in his mind, he's achieved his purpose.
And 301 does not need a congressional approval or anything. It's got to his administration has to do it. You think that he can quicken the pace of these investigations to get an endpoint final result that he wants quickly?
I think that's the whole objective. They've already begun the investigations. Remember, he used this before. He's used this under China. So China's first set of tariffs under Trump 1.0 came under Section 301 because they were country-specific tariffs. At that point, the process took 5 months. The administration believes they can hasten that process. But remember, that was 301 for one country. When you're doing 301 for 50 countries simultaneously, can this be done in 3 months or 4 months? Remains the open question. And then there's one more possibility. After 5 months, you let 122 lapse and you reimpose it a day later.
And 30 seconds to this, Sajid, how will they decide who to go after out of 50 countries? You can't do everything together. I mean, there are limitations, right? Practical limitations.
I think this will come down to revenue. I think the end goal is very clear. They want to hit your revenue target under IPA. Which countries are the source of the greatest revenue loss? And we make sure we plug those gaps first.
Okay. Last question Do you believe, as many are, again, many have, messaged me and reached out and said, well, why don't you look at it as the judiciary functioning in the US again and pushing back? This is curtailing presidential power. He's not free to do the president is not free to do what he wants. He'll be a far more, for the lack of a better word, contained in his actions, etc., etc. He won't be able to lash out at will. How would you respond to that, Sajid?
I think prima facie, this is very positive from an institutional integrity perspective, that there's a separation of powers in the US, and the Supreme Court has ruled, and reversing its ideological bent that the separation of powers holds. That said, so I think that's clearly important and positive from the medium term. But I think, the president we have to also recognize the president has enough latitude under his executive authority that in the near term, a lot of this can be offset. So I think both things can be true, that President Trump can be quite efficacious in the near term, but in the medium term, this creates checks on what the executive can do.
Wonderful conversation, Sajid. We could go on, and I had more questions, but thank you so much for coming on an important day.
Always a pleasure, Prashant. Thank you.
Thanks very much. Well, I think we'll take a quick commercial break here, and on the other side, we'll speak with Kunal, as promised. Coming up. Okay, welcome back. Kunal Desai is with us, Portfolio Manager, Emerging Markets, GIB Asset Management. Kunal, welcome to the program. And good to see you in person in the studios. It's always on the line, and
exactly.
So this is good to do. So just tell us, I mean, you've been here, but what is interesting is where have you been before, which is Korea, which is Taiwan, and you're saying Brazil, etc. as well. So all the very well-performing emerging markets in that sense, right?
Yeah, so, I think what's interesting at the moment is when you look back to 2025, India's underperformed emerging markets by 45%. Huge. That's the biggest underperformance we've seen in 30 years. So the relative opportunity from a price perspective is something that global investors are now looking at India. Can India actually turn around some of this relative underperformance? What's required? And crucially, where's the trajectory of earnings growth globally? We just came back from Taiwan and Korea, and there you're seeing the Korean market seeing a huge upgrade cycle from an earnings perspective. So that's the question I think global investors are thinking about today. India has always been this beacon of quality, but in a quickly developing and changing world, where is that relative opportunity between some businesses and markets which have been priced for low earnings growth into perpetuity versus this inflection that we're now beginning to see?
Traditionally when we talked about Brazil versus India, it used to be Brazil is resource heavy. India's got everything, right? It's much more, the opportunities are very diversified in that sense. Same thing with Korea. I mean, the argument was always in favor of India being a much more, it used to be tech heavy and semiconductor and chips and all of that stuff. It's, as you said, because the world is changing so fast, it's kind of flipping back. Interest is kind of sort of, now not so much here.
And I think one of the, the biggest discussion points global investors are having is the role of hard assets, real assets versus intangibles. And at the moment, what you've seen is the durability and the duration of this AI infrastructure trade for the last 2.5 years is extending, and that's something which investors are now focusing on. And rather than it just being just on chip companies, it's who benefits in the whole supply chain. So it's power, it's data centers, it's now going into materials and basic commodities. So that favors markets such as Brazil, it favors markets such as South Africa, it favors markets such as Korea and Taiwan, because they're very much at the forefront of where this narrative from a growth perspective is focusing on. I think the biggest question global investors now are thinking about is the cyclicality of these end markets. So if you see AI infrastructure continue to lead the market, what is the cyclicality of basic materials? What is the cyclicality of power? What is the cyclicality of data and memory chips? So that's the question which I think is the most important for 2026, is if you believe that there remains inherent cyclicality in those key inputs, those markets are probably priced too rich, in which case the relative opportunity for India then presents itself much more favorably.
You think it will this year?
So I think the story for memory is an incredibly interesting one. Memory typically was a boom and bust. It was about building capacity and then having a glut. What's different this time is the way in which large language models, server, data centers in the US are framing the memory story today. It's much more about customized high bandwidth memory. It's much more where the bargaining power that these chip makers in Korea have is significantly higher, which means that actually order books are full to 2028. So you've got another 1.5 to 2 years of very strong volume growth, plus also this ASP, which is driving gross margins. I think what's very interesting is India always had about a 500 basis point premium from an earnings growth perspective relative to EM, and that's now contracted to a 600 basis point relative disadvantage. So for India to perform, really it is about that relative earnings growth story to come through. It's not so much about the fundamentals in India deteriorating, but it really, from a global perspective, is the relative opportunity of cheap markets, cheap industries, which are seeing the significant earnings improvement and premium to the Indian
somebody
market.
said Korea earnings growth is expected at 150% or something? This is in 2026?
For 26. For 2027, it's slightly less. But when you look at emerging
markets trading at what, 8 times, 10 times?
10 times, yeah. So on a price to book perspective, it's still kind of less than 1.2 times price to book. I think when you think of emerging markets as a whole, they're trading at about 12 times 2-year forward earnings, with 21% earnings growth and also 16% ROE. India today is at significantly high, 19 times 2-year forward, with the same level of ROE, but earnings growth of about 15%. So it's that relative bridge that I think is what's so interesting and has created this significant shift away.
So what's the hope for India, Kunal? That everything else tapers off, the cyclicality kicks in, and then interest comes back here? Is that the hope?
I think there's really three things. The first is the duration of this AI infrastructure trade. If you see any architecture shift from China, the DeepSeek moment 2.0, this creates concern globally about how long that can last. India is the perfect hedge, the foil for that AI infrastructure trade. The second is the role that foreign investors will play. Now, domestic investors have been pushing money in. That's a structural story. But last year, $20 billion was lost from foreign investment. If that remains on par at zero, there's more than adequate demand for equities versus the supply through primary and secondary. But third, I would say, is probably the self-help story, which we're now beginning to see from an Indian perspective. Fiscal monetary policy is becoming a little bit more accommodating. Aspects to attract foreign investors, to accelerate this earnings growth can surprise. But crucially, within India, you are now seeing businesses which are real assets, whether it's hospital companies, whether it is CNC machining equipment, whether it's power cables, which are now being exported globally. If you're able to see that earnings revision outstrip that 22% growth perspective, that creates a relative opportunity as well. So foreign investors haven't given up on India, but really it's more a case of if the relative advantage elsewhere fades, but the fundamental story of India continues to pick up, there's a very interesting switch at play today.
Kunal, I had more questions, but I think this is a punchy, nice chat to have. So well put. Thank you very much for joining us.
Thank you.
And hope you can sort of join in for a longer conversation at a later date.
Definitely.
Thank you.
Thank you.
Okay, well, that's macros with Sajid and markets, of course, in a foreign institutional perspective with Kunal of GIB Asset Management. We're completely out on time here on this program. Thank you very much for staying with us. Programming continues on the other side of this commercial break. Stay tuned.
Hello and welcome to Business 360. I'm Arundhati Ramanan, and here are the headlines that we're tracking for you this evening. Stock markets tread with caution as investors react to U.S. Supreme Court ruling and Trump's new 15% global tariffs. White House appears defiant to carry out its tariff agenda. U.S. Trade Representative says Trump administration will stand by the deals it has signed and expects partners to do the same. Sensex and Nifty end in the green even as IT stocks continue to decline. Mid-caps also underperform the blue chips. Rupee gains over 10 paise against the dollar. Finance Minister Nirmala Sitharaman says Commerce Ministry is reviewing the situation after U.S. Supreme Court ruling and President Trump's fresh tariff threats. The visit of the Indian trade delegation to Washington this week has been delayed. Government sources say both sides need time to evaluate the situation. European Commission says it will not accept any increase in tariffs, demands the U.S. follow the terms of the trade agreement reached last year. China urges the U.S. to lift all the unilateral tariffs. Beijing is making a full assessment of the U.S. court ruling. Haryana government bars IDFC First Bank and AU Small Finance Bank over irregularities in its accounts. IDFC First Bank labels it a fraud and estimates the variance at 590 crore rupees. AU Small Finance Bank claims it followed all protocols. RBI governor rules out any systemic risk. The Indian Air Force has grounded the entire Tejas fleet after one aircraft sustained major damage to its airframe earlier this month, reports PTI. Hindustan Aeronautics calls it a minor technical incident and the aircraft did not crash. India advises its citizens to leave Iran as U.S. military build-up continues. Iran claims encouraging signals from U.S. ahead of the next round of negotiations in Geneva on Thursday. Those were the headlines that we're tracking for you, but the top story this evening, the world has entered a new phase of the trade war, which promises more uncertainty. U.S. President Trump is determined to carry out his tariff agenda despite the Supreme Court ruling calling it illegal. U.S. will need to stop the imposition of current tariffs from tomorrow after the court's verdict. But President Trump imposed a new 10% global tariff just hours after the ruling, and yesterday he raised it to 15%. That is the ceiling allowed under Section 122 of the Trade Act. U.S. Treasury Secretary Scott Bessent also made it clear that U.S. will invoke other legal options to replace tariffs. This includes Section 301 of the Trade Act. Under this section, the U.S. must initiate a probe first and then impose tariffs if needed. A Switzerland-based watchdog called Global Trade Alert says Brazil, China and India are the biggest beneficiaries under the new 15% tariffs. That's because the weighted average tariffs imposed on these three nations will drop substantially under a blanket tariff rate of 15%. On the other hand, countries like the United Kingdom, Italy and Singapore will see an increase in their weighted average tariffs as their current effective tariff rates are less than the proposed 15% duty. U.S. Trade Representative Jamieson Greer said the White House will stand by the deals it has signed so far, and it expects all trading partners to honor the deals signed as well.
I've been telling them for a year, whether this case, whether we won or lost, we were going to have tariffs. The president's policy was going to continue. That's why they signed these deals, even while the litigation was pending. So we're having active conversations with them. We want them to understand that these deals are going to be good deals. We expect to stand by them. We expect our partners to stand by them. And I haven't heard anyone yet come to me and say the deal's off. They want to see how this plays out. I'm in active conversation with them on it.
And the rest of the world is coming to grips with the fast-paced developments in the U.S. and its implications for global trade. China's foreign ministry said it is making a full assessment of the U.S. Supreme Court's ruling. It urged Washington to remove all unilateral tariffs, calling it a violation of international trade laws. The European Commission said the current situation is not conducive to deliver a fair and equitable deal. However, the EU has refused to accept any increase in tariffs, saying a deal is a deal, citing the agreement signed between both sides last year. The head of the European Central Bank, Christine Lagarde, said people want business and not lawsuits. She hoped the new tariff plans are sufficiently thought through. Reacting to the U.S. court ruling, French President Emmanuel Macron said it's good to have checks and balances in democracies.
doesn't seem bad to have Supreme Courts and therefore a rule of law. For those who think Supreme Courts create problems in political life, a Supreme Court looked at the Constitution and said, this is not in line with the Constitution. Now everyone says this is great. There you go. It's good to have checks and balances in democracies.
And back home, Finance Minister Nirmala Sitharaman said the Commerce Ministry is reviewing the situation after the US Supreme Court ruling and President Trump's new 15% global tariffs. India is yet to formally sign the trade deal with the United States, even though President Trump has announced the reduction of tariffs from 50% to 18%. An Indian trade delegation was supposed to travel to Washington this week to finalize the deal. Now that visit has been delayed. Here's the Finance Minister in the US on the US tariff situation.
On the Indian economy, I think it's a bit too soon for me to comment. But on the trade particularly, aside from the Indian economy in general, the Commerce Ministry is reviewing the situation. The delegation will have to take a call on when they're going to go for further negotiations. So it's a bit too early for me to comment.
Uncertainty continues to prevail over the extent and applicability of US tariffs on several countries, including India. The visit of India's negotiating team to the United States has been postponed and it will be rescheduled at a mutually agreed upon date. Commerce Ministry sources indicated that both the sides were of the view that the proposed visit should be scheduled only after each side has had the time to evaluate the implications of the developments which have unfolded in the past few days. Now, the US Supreme Court had earlier done away with the tariffs which were imposed by the Trump administration last year under the International Emergency Economic Powers Act, post which the Trump administration again indicated imposition of tariffs first to the tune of 10%, followed by 15%. So more clarity is still awaited, not just by India, but by several other economies in this regard. Now, last evening, the EU had issued a statement. The European Commission had sought fair treatment, predictability, and legal certainty on the steps the US aims to undertake post the Supreme Court order. The EU had also said that it wants full clarity on the steps which are being taken or the US intends to take post the Supreme Court order.
So, Abhimanyu there with the latest on the US tariffs. Onto the day's market action. The Lal Street closed largely in the green, with Nifty ending above that 25,700 mark. The mid-cap index underperformed, dragged down by IDFC First Bank and AU Small Finance Bank. Nifty IT continued to extend losses and ended lower for the third straight session. Bitcoin fell below the $66,000 mark, weighed down by uncertainty over the status of US tariffs. Investors' concerns about rising tensions between US and Iran also weighed on prices. The price of Bitcoin has nearly halved since it hit record highs of $125,000 in October last year. Iran has said that indirect talks with the United States on its nuclear program have produced encouraging signals. However, the country's president warned that Tehran is prepared for any scenario. The two countries will begin a second round of indirect talks in Geneva on Thursday. This comes amid mounting fears of a military conflict, with Washington building up its military presence in the Gulf. Meanwhile, India has advised its citizens to leave Iran. Indian citizens have been asked to leave by available means of transport. The Haryana government has barred IDFC First Bank and AU Small Finance Bank over irregularities in its accounts. IDFC First Bank labelled it a fraud and estimated the variance at 590 crore rupees. The lender to the bank said that discrepancies were observed when the Haryana government requested the closure of its account. The bank's shares clocked its steepest fall in 6 years. Meanwhile, AU Small Finance Bank has said it allowed all protocols after transactions of 47 crore rupees from IDFC First Bank were flagged. Ritu Singh is here with all of those details. Ritu?
Two private lenders, IDFC First Bank and AU Small Finance Bank, were under pressure today after informing exchanges that they had been de-impaneled by the Haryana government from handling any government business starting the 18th of Feb. Let's start with IDFC First Bank, where the bank has disclosed a suspected fraud of 590 crore rupees at its Chandigarh branch that involved Haryana government-linked accounts. The issue surfaced when a government entity sought to close its accounts and transfer the funds, and that's when the discrepancy was flagged. Since then, IDFC First 1st has suspended 4 officials. It has informed regulators and auditors, filed police complaints, and also appointed KPMG for an independent forensic audit. Now, the management says this is a localized issue that is restricted to one branch and one client account and does not impact other customers. Now, financially, 590 crore rupees is not insignificant. It is about 28% of IDFC First Bank's estimated profit for the full year FY26 and equals roughly 19 basis points of its CET1 ratio, which stood at 14.23%. Now, the bank has also clarified that this 590 crore rupees includes a 100 crore precautionary buffer that has also been built in. Now, the Haryana government deposits form just 0.5% of the total deposits for IDFC First Bank, and the bank has already seen outflows of about 200 crores from the account since the news. The final hit is going to depend on the recoveries, the insurance and the legalities, but the bank believes the impact should not exceed 590 crore rupees. The bigger question is whether there is any broader impact on all the state and central government deposits, which form about 8 to 10% of total deposits for IDFC. Brokerages are constructive, though. Jefferies maintains a buy with a 100 rupees target, while Investec retains buy, but it has trimmed its target to 92 rupees a share. Now, to AU Small Finance Bank, which was also de-impaneled by the Haryana government, the bank said it received communication regarding suspected unauthorized transactions and is also conducting an internal review at the moment. Some employees have been placed off duty, but AU says there is no indication of any financial loss or fraud that is impacting the bank. The Haryana government deposits there stand at 538 crore rupees, or about 0.4% of the total deposits. So the key focus now going ahead is going to be on the audit findings, on the provisioning clarity and deposit stability, and whether PSU banks like Punjab National Bank in the northern region stand to benefit from these deposit outflows from the private lenders.
As a policy, we do not comment on any individual bank or regulated entity. We are watching the developments. There is no systemic kind of an issue over here.
जो IDFC फर्स्ट बैंक है, इसने सेबी को एक लेटर लिखा और ये कहा कि हमारे यहाँ पर ऐसे करके उन्हें अपने बचाव के अंदर, क्योंकि ऑथराइज बैंक होते हैं, अपने बचाव के अंदर उसने सेबी को लेटर लिखा है और कहा कि कर्मचारी ने गड़बड़ की है। हमने इसको तुरंत एंटी करप्शन ब्यूरो और हमारा जो विभाग, विजिलेंस विभाग है, उसको तुरंत हमने ट्रांसफर किया। पैसा पूर्ण रूप से सुरक्षित है, एक पैसा वापस आएगा। जो दोषी होगा, कोई बख्शने का सवाल नहीं, उसके खिलाफ बिल्कुल सख्त कार्रवाई होगी।
Finance Minister Nirmala Sitharaman and RBI Governor Sanjay Malhotra both believe that rising gold prices are not concerning yet. At a joint press conference with the RBI Governor, the FM said that the central bank is monitoring prices, while the RBI Governor said that India's current account deficit remains manageable.
We are watching it, but I'm not sure it has reached such alarming proportions given the tendency or natural things as it is in India for investing in gold, buying gold, and therefore I think it has not gone in that sense beyond a certain limit. But of course RBI will also be monitoring it.
There is a lot of fluctuation, seasonality in that particular demand, so we are not unduly concerned about that, especially because our external sector continues to be very robust and strong. The current account deficit is still very manageable as per our projections. It's within or about the 1% of GDP range. The government has now a number of agreements for trade, international trade, that it has signed, so that will help our current account even further.
The finance minister also flagged mis-selling of financial products by banks as a major concern. FM Nirmala Sitharaman said that banks must prioritize their core business and focus on lending while responding to actual customer needs. She added that lenders should also focus on improving their ratio of current account to savings account.
Mis-selling happening. My pet peeve has always been that you do your core banking business, you're spending more time on selling insurance, where it is not required perhaps. Glad that the RBI is coming up with guidance on why mis-selling is not going to be, entertained. And I think the message should go to the banks that you cannot afford to missell. And this word missell, instead of offending anybody, seems to be one more word in the lexicon. Missell is an offense, if you ask me. Don't ask me under which section of Bharatiya Nyaya Sanhita. But it is misselling, right?
And on that note, it is time for us to head into a short break. But coming up, the Indian Air Force has grounded the entire Tejas fleet after one aircraft sustained major damage to its airframe earlier this month, reports PTI. More details when we come back. Welcome back. You're still with us on Business 360. The Bombay High Court has scrapped an interim order and allowed the Bank of Baroda, Indian Overseas Bank and IDBI Bank to resume proceedings to classify Anil Ambani as a fraud borrower. This comes less than a week after the industrialist who was caught in an alleged 40,000 crore rupee bank fraud assured the court he is not a flight risk. He is expected to appear before Enforcement Directorate on Thursday. The Telecom Department has directed the Noida International Airport at Jewar to allow telecom companies to deploy mobile networks. The department said that the airport must comply with rules about telecom infrastructure deployment as it qualifies as a public entity. The department had issued the same directions to Navi Mumbai International Airport just last week. Remember, telcos had flagged that the Noida International Airport set up its own telecom infra and sought to charge a fee. Shares of HAL declined nearly 4% in trade after reports suggested that the Air Force grounded 30 Tejas light combat jets. According to PTI, the aircraft sustained major damage during a routine training sortie, but HAL has called it a minor technical incident. Ria Bhatia is here with all of those details. Ria?
Well, yes, HAL has taken a hit in today's trading session, and earlier there was a report that said that the Indian Air Force has grounded the entire fleet of around 30 single-jet Tejas LCA jets after a crash earlier this month, and the IAF is going to carry out an intensive technical probe as a result of this, and this is as per a PTI report. Now, remember that this incident had actually occurred earlier this month during a landing after a routine training sortie, and the preliminary probe points to a suspected onboard technical glitch. Now, it is also to be noted that this is the third Tejas aircraft lost since its induction into the IAF. The first one was in March of 2024, and the second one was in November of 2025. As of now, there has been no confirmation from the IAF yet on the grounding of the fleet. And apart from this, HAL has also issued a factual clarification saying that there was no crash, but rather it was a technical glitch that led to this incident. But the key thing to be tracked later will be the grounding of the fleet and any further comments from the IAF or on HCL on this matter.
Violence has erupted across Mexico after the country's most wanted drug boss was killed in an operation. The drug lord known as El Mencho was the leader of an infamous cartel and died after being seriously injured in clashes between his supporters and the Mexican army yesterday. The Indian government has issued an advisory to its nationals living in Mexico, requesting them to avoid crowds and seek shelter when needed. Here's a report.
Cars and buildings were torched in Mexico's Jalisco province following the killing of drug lord Nemesio Oseguera, commonly known as El Mencho, in a military operation. That's according to government sources familiar with the operation who spoke to Reuters on Sunday. Mexico's defense ministry said a shootout left Oseguera seriously injured and he died during an air transfer to Mexico City. Oseguera, an ex-police officer, was the leader of the powerful Jalisco New Generation cartel. The Mexican government has been cracking down on local drug cartels after a pressure campaign from the Trump administration, including threats to intervene directly. The Mexican embassy in Washington said on Sunday that the U.S. provided information for the operation. Security forces conducted aerial surveillance on Sunday after the operation set off a wave of violence. Videos and pictures on social media showed vehicles ablaze, sending dark smoke into the sky. Mexican media outlets reported torched cars and gunmen blocking highways in more than half a dozen states across the country. Air Canada said it was temporarily suspending operations in Mexico's Puerto Vallarta. United Airlines and American Airlines said they were also canceling flights in the region. Mexican officials urged people to stay home until the situation was brought under control.
And with that, it is a wrap on this edition of Business 360. More news and updates on the other side. Stay tuned. Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me as always is Ritu Singh. These are the top headlines from the startup world. Supreme Court issues notice to Meta over proposed 5-year advertising ban on WhatsApp, questions 2021 data sharing policy, next hearing on the 19th of April. The Cheesecake Factory Bakery to debut in India via the Gourmet Cafe plans 55 outlets with $60 million investment, targets rupees 200 to 250 crore rupees in revenue in 5 years. IAN Alpha Fund leads $3 million round in Mojro, SaaS logistics platform to expand in US and Southeast Asia, strengthen AI-driven optimization stack. Peak 15 closes $1.3 billion in new capital across India Seed, India Venture and APAC funds to double down on AI, fintech, consumer and deep tech. LiveSpace cuts 1,000 jobs at 12% off the workforce in AI-led reorganization. Co-founder Saurabh Jain exits after 11 years.
Well, in what's brewing today, AI vibe coding startup Emergent has achieved a staggering annual run rate revenue of $100 million in just 8 months since its launch, doubling the revenue in just 30 days. One of the fastest AI native platforms globally to reach this milestone. Now, at a time when India's AI ecosystem is debating foundational models versus application, layer disruption with players like Sarvam AI pushing sovereign AI, Emergent is taking a different route, enabling anyone to build a full-stack app using autonomous AI agents. 6 million builders, 7 million apps, and now a mobile launch that takes app creation beyond the desktop. Now, what's behind this lightning growth speed, and can it sustain? That's the question we're going to be asking its co-founder and CEO, Mukund Jha, who joins us now. Mukund, always a pleasure to have you here. And let me tell you, Emergent was very much the talk of the town at the AI Impact Summit last week. So we're very happy to have you join us here. You know, you've crossed this $100 million in annual run rate revenue at a pace which investors like Vinod Khosla are calling unprecedented. You know, so what's driving this hyper acceleration, and do you expect this kind of growth to sustain?
Yeah, I mean, we believe that there is a lot of latent demand in the market right now. And the market that we are opening up is a net new market, like where for the first time, people who did not have access to development resources, people who could not build software are now coming into the economy, building software. And I think it's just the beginning. And as AI sort of progresses, as platforms improve, we will see a lot more significantly higher revenue ramp-ups.
Well, Mukund, break down that 100 million revenue run rate for us. How much is enterprise? How much is individual builders? How sticky are the customers? Because you've onboarded 6 million builders globally. What percentage of them are actually paying, and how are you able to improve the monetization per user?
Yeah, so roughly most of the users who are coming to platform today are small, medium business owners who are trying to digitize their business. These people would have gone to a dev shop to create a software, and we are bringing down the price point. So typically they would have paid $500,000 to build a software. Now, on Emergent, they can get away with like $1,000 to $5,000 to build the first version of their software. And that's why we are seeing a significant, expansion of TAM, and a lot of people are sort of coming to the platform and using it. We do not have enterprise motion yet. We are still sort of starting to work on that now, even though there is a lot of demand from enterprise. A lot of the revenue, most of the revenue today is coming from small, medium business owners, solopreneurs, dev agencies who are using us to accelerate their workflows. And in terms of like the margin and other things, we have pretty good margins right now on the business, and we are seeing the margin also expand. And retention is also holding up pretty well, even though the growth is accelerating for us. Like, our retention number looks pretty strong.
Well, in that case, let me ask you, how soon do you think you'll start to serve enterprises then? And what should we watch out for next in your launch pipeline?
So there are a bunch of things that are coming. Enterprise is definitely something that we're going to look at in near future. Right now, we're very focused on just getting these users to success. We're also going to significantly expand the offering on the platform, and a lot of users actually, once they build a software, like they want to now distribute the software, they want to grow their business. We will be helping them do that. There's also significant push on the mobile side for us. Like mobile growth has been significant for us, so we're going to invest on that. We also launched this OpenClaw molded bot on the platform that has been growing very fast for us. And I think as the AI sort of progresses, you'll see us launch a lot of new things in the store in the coming weeks. But as we get closer to the launch, we'll reveal them.
Well, tell us about this mobile app you've launched for iOS and Android that lets users create apps and publish them directly onto the App Store. How widely is it already being used, and what kind of additional revenue generation can this unlock for you?
Yeah, so we launched our mobile app in beta roughly about a few weeks back, and it's already contributing to roughly, 8 to 10% of our revenue growth right now. And we are seeing significant demand in the market where people want to build mobile apps. We have made it really, really easy for them to build, download, publish these apps. Today, we are probably one of the best mobile building experiences on the platform. And because most of these agents now actually run for much longer time, the build on the go experience has been, like something that is ramping up for us really, really well. And it is also like adding net new sort of audience for us, like people like, who do not have access to laptops, people who want to build on the go. We expect this to continue to grow really rapidly for us.
Well, that's significant adoption. So, Mukund, let me ask you then, how soon do you get to the next 100 million at this rate?
Yeah, I think the growth rate is accelerating. Like, we don't have any forward-looking projections right now, but every time we make an announcement, we see like our growth rate jumps even higher, and we think that there is extreme amount of latent demand in the market, and as we continue to deliver on the promise of people being able to ship production-ready apps, we expect this ramp to continue and even sort of accelerate for us.
Well, let me also address this growing chatter around how AI can disrupt traditional IT services and jobs altogether, because where do you stand on this? Apps like Emergent, they're enabling non-technical founders to build full-stack production apps in weeks. So do you share this view that this is going to fundamentally reshape or even replace large swaths of traditional software development?
Yeah, I feel that there's definitely like a massive, job displacement that's going to happen in the near future. I think the role of people building software today is going to evolve to becoming more product owner, becoming more architects. But at the same time, I expect the economy will also sort of expand rapidly, and at least for the short time we'll see demand increase. But as AI improves, like I feel that a lot of these jobs will definitely get displaced, and we will find newer things to do. Good thing is that I think economic growth will sort of help us, counter some of these things.
Okay, Mukund, we'll leave it at that. Thanks very much for joining it, and we wish you and Emergent all the very best for your future endeavors.
Thanks a lot. Thank you.
Thank you, Mukund.
And moving on, in a country where over 230 million Indians trust fixed deposits to safeguard their savings, one fintech is betting big on making safe money smarter. Stable Money, the digital fixed income platform, has just raised $25 million in a pre-Series C round led by Peak 15 partners, taking its total funding to $65 million in just 3 years. With over 50 lakh users and more than 5,000 crore rupees invested through its platform, the company is now looking to double down on product expansion, bank partnerships, and even offline presence. But can fixed income truly become venture scale? Joining me now to discuss this further, Saurabh Jain, the co-founder of Stable Money. Saurabh, thank you so much for taking time out and being here with us on Startup Street. Stable Money was built around a simple idea, right? That fixed income in India was trusted, but not modern. So take us back to that moment. What gap did you sort of see in how Indians were saving, and why did you believe this was a venture scale opportunity?
Yeah, see, I think FD is the largest asset class in India, and we have almost 18 crore Indians who invest in FDs. But if you see last 4 or 5 years, the entire innovation on the tech side has always been on the mutual fund and the stock side, because that is giving a larger upside to a lot of users. But we have realized a large set of users still prefers to put 60-65% of their investment into fixed income product and largely in FDs. And the basic awareness about the DICGC insurance, opening a fixed deposit without a savings account, those features was not available to those users. So we thought nobody was taking this positioning in India. This will break the clutter and you can reach out to the larger audience. And that's how we started.
Sure. And you've raised this $25 million in funding, right? So how do you plan to use these funds? Any new products in the pipeline?
See, we have realized now in the last 2.5 years that now we have figured out the product market fit. We know what is the exact communication. 60% of my user base comes from a tier 2 city. So idea is to grow this significantly, reach out to the more audience and tell them about Stable Money and the features that we have. That's the larger spend that will happen from this funding round. The second most is innovation on the tech and the product side. We are launching more products. So we are trying to get US Treasury bills onto the platforms. We're trying to get into REITs and InvITs products as well, because those are mostly fixed income product. And also we're trying to build more bank partnerships and offline partnerships, because FD is still a very high trust product. We feel that though you are present online, it's good to have an offline present and build relationship with the customer, especially in the tier 2, tier 3 city. So these are the three large segments where the money will be spent.
Sure. So the large segments where you're spending the money, another question that you have about 50 lakh users, 5,000 crores in investments, but fixed income is fundamentally a trust business. So how are you sort of scaling this aggressively without diluting that trust first positioning? But also, the other question is you're catering to the tier 2 market, right? How are they sort of understanding all of these new, tools of investing?
See, I think first question on the trust, I agree that trust is a slow compounding thing, and that works as an advantage to us as well, because nobody with a large capital can come and start building and disrupting the business that we have built, because it takes time to build that trust. And what we are trying to do is through brand awareness, through a lot of education content, we're trying to build that trust. Offline is also one of that attempt for us to build more trust with our users. So that's one place. On the tier 2, tier 3 cities, I think we have already realized that a lot of people have gone from traditionally reaching out to an insurance agent or an LIC agent for all their advice on the wealth side. They're consuming a lot of content on how the investment should happen. These people are more aware. I think just reaching out to those users with a more tech-enabled platform is the goal that we have, because these are the users who are using Swiggy's and Zomato's of the world, Ola and Uber's of the world. So they understand how the tech product work. It's just that investment is slightly new to them. I think we are the first one, and that's another reason why we feel that we have a great opportunity to do that. Is FD is a product that is very well understood. It's a very trusted product. And if you start with that, the relationship becomes much stronger. We have seen the customers who have started with fixed deposit onto us have moved on to buying bonds, gold and silvers onto the platform as well, without them knowing about these products much before they started doing fixed deposit. So I think that's how it compounds.
All right. So it's sort of compounding in terms of, what they trust you with and where they're willing to invest. But you kept pointing out that offline expansion is really key, right? So if you could tell us what the scale of this offline expansion is going to be, take us through, the areas that you're currently present in and which geographies you're looking to expand into, or which states that you're looking to expand into with your offline presence.
Right now, we are only present in 3 cities. It's a very early experiment. We are present in Kolkata, Delhi, and Pune. But I have done Swiggy and I have launched Swiggy to 500 cities. I feel if Swiggy and Ola are the companies which can be in 500 cities, fixed deposit can go beyond 1,000 cities and towns in India, because wherever there is a bank branch or the people from different cities or towns who are doing fixed deposit, that's our potential market to go offline. The only question is, what is the playbook? How do you do it very cost effectively? I think that's what we're trying to figure out this year. But once we figure the playbook for reaching out to a tier 1, tier 2, tier 3 cities and beyond, I think the next year we'll keep pushing the pedal on scaling these cities.
Absolutely, because physical expansion sort of puts pressure on the margins, right? So for this year, how many outlets are you looking to open, and which will be are you going to remain in these 3 cities or maybe a few beyond it?
No, we're trying to get to 8 cities, the top 8 cities in India. That's the plan for this year. Obviously, the initial 3 cities that we have launched will scale to a much higher number. Other cities will be in very initial phases. But the tier 2, tier 3 cities expansion will start happening from the next year.
All right. And, before I let you go, where are your revenues at? What are you looking at for this year? What are the targets you've sort of, put for yourself for this year?
So we are currently at a 5 million ARR. This has gone almost 10x versus how we have started the year. But our idea is to triple the revenues by this year end and go from a 5,000 crore AUM to a 15,000 crore AUM by December.
So 15,000 crore rupee AUM by the end of December. And profitability?
It's very early stages for us to talk about profitability. But see, honestly, on the Excel, the profitability looks 2 years down the line.
All right, so 2 years down the line. All right, we'll stay in touch with you to see how the business grows. And if you make it to those 1,000 cities, if you believe Ola and Uber can do it, then you can reach a larger audience. So we wish you all the best on that journey. All right, Saurabh, thank you so much for taking time out and being here with us on Startup Street.
Thank you.
And moving on, it's time for us to head into a short break. But coming up, lab-grown diamond jewelry brand Ethira bags 25 crore rupees from Bluestone to accelerate retail expansion and brand building. We put the firm's co-founder, Sharad Arora, on the hot seat to decode Ethira's future plans. Stay tuned. Welcome back. You're still with us on Startup Street. India's jewelry market is witnessing a quiet but powerful shift. Lab-grown diamonds, once a niche alternative, are now emerging as a $500 million opportunity, growing at nearly 40% annually. At the center of this surge is Bengaluru-based Ethira, which has just raised 25 crore rupees from Bluestone to accelerate retail expansion and brand building. With 5 stores already operational and an aggressive design pipeline, Ethira is betting that the modern Indian woman wants diamonds she can wear every day, not lost block away. But as legacy jewelers enter the lab-grown space, can new age brands hold their edge? Joining me now to discuss this further, Sharad Arora, the co-founder of Ethira. Sharad, thank you so much for taking time out and being here with us on Startup Street. You know, like I pointed out, India's lab-grown diamond market is growing at 35 to 40% annually, right? What structural shift are you sort of seeing in consumer behavior that convinces you this isn't, you know, just a trend, but sort of a lasting category shift?
Sure. First of all, thank you so much for having me on, Arundhati. It's a pleasure to be on the show. So as you said, right, so there are broadly 3 or 4 macro trends which we are currently seeing playing out, right? So first one being rapid urbanization and workforce mobility, right? So India is witnessing a large scale migration from smaller towns to cities and metros, and as more and more people enter the workforce, this shift is increasing the demand for national trustworthy brands that people can resonate with, right? Aspiration is increasing. Everyone wants to buy from brands now. But the value consciousness is still there, right? India is not a cheap market, but it's a very clear value conscious market, right? People will pay as long as they see value in it. As far as if you translate this to jewelry, as and when more and more of this workforce mobility happens, we're seeing that people are going to lose touch with their family jewelers, which they or their parents used to buy from. That in which further increases the importance of more and more brands coming in, national brands coming in. Right. The second that we are seeing is a rise of non-bridal and everyday jewelry. Millennials and Gen Zs today are moving away from heavy occasion-led jewelry. They are not looking at jewelry as an investment, as you said, which is supposed to be stored away in lockers, but rather they're looking, they prefer minimal, versatile pieces that can be worn daily without the guilt of over-investing or, the fear of losing that expensive piece of jewelry. Also, people want to refresh their jewelry more and more frequently to match their evolving personal preferences. And the third trend that we are seeing currently is personalization over mass uniformity, right? Personalization is becoming, customization and personalization is becoming more and more central to the overall shopping experience. Customers no longer want to wear what everyone else is wearing. They seek jewelry which reflects individual identity, but also that comes with a shopping experience that feels more and more flexible and personal, right? There are a lot of customers, for example, who walk into our stores with a design already in mind. People exactly know what kind of jewelry that they want to design, right? So all of these things are things that we are seeing very rapidly changing the entire way jewelry is being bought or perceived in the country today.
Sure. And, you've raised this 25 crore rupees, right? So if you could tell us, how do you plan to sort of spend the money? What's on top of the agenda? Where will these funds go?
Absolutely. So there are 4 broad areas where we are going to use most of the funds. The most important being retail expansion. As you said, we currently have 5 stores live present across 4 cities, which is Delhi, Noida, Ghaziabad, and Bangalore. We have 4 more stores which are currently under construction and will be live by the mid of next month. So that will be 9 stores. Majority of the funds are planned for further retail expansion. There are multiple more stores which we've signed all over the country. We've signed Jaipur, we've signed Pune, we're currently looking at Hyderabad and a couple of other cities like Lucknow, etc. So most of the funds are going to be planned for this retail expansion. The idea is to have about 18 to 20 stores live by the end of this year. Besides that, we're also looking at utilizing the funds for, further strengthening our tech stack and, utilizing the funds for hiring and marketing.
So you're looking at opening these 18 stores by the end of this year, right? So if you could sort of explain to us what your omni-channel strategy is going to be, and where do you foresee most of, your business coming in from, the online channel or your physical presence?
See, the way we see it, jewelry is neither especially fine jewelry is neither an online only play, nor is it a very heavy retail play. Jewelry is a very strong omni-channel play where we feel that every touch point in the customer's journey, right from the point where a customer sees an online ad to when the customer lands on your website and interacts with your, let's say the online chat team, to the to the time when the customer walks into a store, that entire journey needs to be, that entire experience at every touch point needs to be seamless, which is where, omni-channel is the way to go. So we as far as most of our business coming in, we feel that from a value standpoint, majority of the business is going to be online. Let's say what we are seeing with more established brands like Bluestone, CaratLane, we see that about 85 to 90% of the business comes from online. Remaining comes from offline. Sorry, remaining comes from online. But online becomes an extremely important channel with respect to feeding into that customer base and getting them to the stores and experiencing. Right, jewelry is not a category which can be bought online, as I said, only because the inherent nature of the category is where people want to look and feel and how that jewelry feels on their body. They want to. It's a very touch and feel category. So we expect most of the conversion to happen offline, but online feed becomes an extremely important channel to feed into that offline conversion.
Sure. Online is what the people see, and then they're like, okay, maybe I want to come to the store and check out, how it looks in reality. But legacy jewelers and large traditional diamond houses are entering this lab-grown segment, right? So how does Ethira plan to defend its turf? How are you going to keep innovating to sort of bring the customers to your store?
Sure. See, firstly, I think it's a great thing that legacy players are entering into the industry. Tata coming in with Beyond gives a lot of credibility and visibility to the overall lab-grown space. One of the biggest challenges that the lab-grown industry faces today is educating the customers on what the product actually is, right? So players like Tata entering into the space gives a lot of credibility, visibility, increases a lot of trust for the for the customers towards the entire industry and product, right? Anyone who thought that lab-grown may be a synthetic product, who was on the fence thinking that lab-grown may be something synthetic or not real, will now start understanding and accepting that lab-grown is the exact same thing as a mined diamond, right? It's just is the location or the place on which at which the product was formed, which is different. It has the same physical, chemical, and optical properties as a mined diamond. So firstly, I think it's a great move. Lends a lot of credibility and creates a lot of awareness for the entire industry, makes it more mainstream. As far as Ethira competing or defending its turf and differentiating with legacy players, there's no fancy answer to this. The way we see it, there are two things that can be the biggest differentiator in this space: great designs and a great omnichannel experience, right?
Yeah.
The idea is simple, but it's the execution which becomes challenging. It all depends on how well you execute. Jewelry has always been a desire-based purchase. It is not a necessity. People don't buy jewelry because they want to. They have to, right? They buy jewelry because they want to, which is why design sits at the very heart of the category, followed closely by a trustworthy omnichannel experience. And that is exactly where we have been focusing on from the very first day. At Ethira, design and the people behind each creation comes first. Every piece that we create is basically with a single uncompromising objective that one, the piece must be beautiful, and the second is that it must make the wearer of the jewelry feel beautiful. We pride ourselves on building one of the strongest and most contemporary design collections in the market. Our teams are continuously innovating and adding more than 200 designs every month on our website. We currently have more than 2,000 designs already live. And this is where we have been, building a lot of capabilities in-house. We are one of the very few brands in the industry who have in-house designing as well as in-house manufacturing, which is
you've got in-house designing, manufacturing, and you've got 2,000 designs on your platform. That is how you're getting your customers. But, Sharad, we're completely out of time. But thank you so much for joining us on the show, and we wish you all the best on this journey going forward.
Thank you so much, Arun.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
This guy? These are quadruped. This is Tracker, which is a 5 kg payload robot, mostly for industrial surveillance.
This very comfortable job that you had at Asian Paints and decided to get into the world of artificial intelligence and robotics. Why?
There was this new field of robotics which was coming in, the mobile robotic field. We felt that there was not a single software enabling these technologies. So we thought, okay, if we solve this problem, we will solve it for the world.
Adverb, explain the name to us.
Verb is action, and add is adding intelligence to action.
So intelligent action. Now you've gotten to the humanoid space. We've got one of your humanoids right behind us.
Whatever humans can do with less dexterity, of course, these robots can do the repetitive tasks, the dangerous tasks.
When Elon Musk talks about the age of abundance, how do human beings benefit?
When we put this robot, there were 3 people who lost their job.
Yeah.
But then we created job for a technician, for a robo-operator, and at the vendor's end.
Reliance has made a very big bet on you.
They called 25 companies globally. We were small, but somehow we found that place in that room.
What is that one thing that you would get a robot to do for you?
Folding my clothes.
If you were to go into the engineering education system today, what would you train yourself for?
If you are mechanical, you know AI, but you also know electrical and other forms of engineering. And that is
so versatility is going to have to be key.
Yes.
Humanoid robotics is fast moving from science fiction to serious global investment. As artificial intelligence enters the physical world, companies are racing to build machines that can work, adapt, and scale in real-world environments. Elon Musk has called this one of the most consequential technological shifts of our time, but the real story today is execution, and increasingly, India is part of that story. Founded in 2016, Adverb has grown from a warehouse automation startup into a full-stack robotics company, building both the machines and intelligence that powers those machines. Backed by Reliance Industries and now pushing into humanoid robotics, Adverb is betting on physical AI built and scaled from India for the world. So, as governments debate capital flows, as budgets weigh defense, manufacturing and AI, and as the world inches towards Musk's so-called age of abundance, one question becomes unavoidable. Can India not just consume this future, but also build it? Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. We're at the Adverb's facility here in Noida.
We are now going to talk to a guest of ours who believes that India could be on the cusp of a big inflection point. Joining me now is the co-founder and CEO of Adverbs. Many thanks for joining us, Sangeet. It's great to have you on Young Turks Reloaded. I want to start by talking to you about the origin story, your origin story. IIT, you were working at Asian Paints with your now co-founders. You then decided that all of you are going to quit this very comfortable job that you had at Asian Paints and decided to get into the world of artificial intelligence and robotics. Why and what gave you the conviction to want to go it on your own?
So, in Asian Paints, we were setting up world's largest factories and warehouses. And in these factories, and where these were really automated, it was not only large, but automated. And we used to buy a lot of these robots from Europe and US and Japan. And we thought, and every time we used to buy, we thought, okay, it can be done in India.
We can do it.
Yes, that was one thing. Second, as a customer, so there were two different kinds of automation which was playing in. One was the conventional automation which has existed for 30, 40 years. And there was this new field of robotics which was coming in, which was adding the mobile robotic field. And we were, as a customer of these two technologies, we felt that there was not a single software enabling these technologies to help customer get benefit of these technologies. So we thought, okay, if we solve this problem, we will solve it for the world.
Right.
And at the same time, because there is huge opportunity in India, and
we'll solve for India.
For India. So that is how everything
And the
began.
big breakthrough idea was really this combination of hardware and software, so becoming a fully integrated, full-stack provider.
Full-stack provider. So we were users of this technology, and we felt that software will keep on improving and keep on adding more value to these robotics. So robotics always used to be considered as high precision electromechanical equipment. But with software coming into picture, we thought that the software will be adding more value to the customers' usages. And therefore, we built a company which was hardware and software.
Okay, and the company is called AdVerb. Explain the name to us.
So AdVerb, so verb is action, and add is adding intelligence to
so
action.
Intelligent action.
Yes.
That's the premise.
Yes.
So cut back to 2016 when you decided that this is going to be the baby, this is going to be your passion project, this is going to be your life's work. Investments, self-funded to start with, all of you pooled in your savings. How much did it take for you to get started?
So initial investment was in the range of 2 crore, 2.5 crore. That is what initially we put, and then later on we added something. But very soon we were out of money because hardware it requires money. And then we were working for Asian Paints, and Mr. Jalas Dani, who is one of the promoter of Asian Paints, we had worked with him. He trusted us. We trusted him. And so we went to him and we said, we need money to...
What an interesting twist of fate, right? You go to your former employer and say, write me a check for my current employment.
Yes.
And he was generous enough to do that.
Yes, he was generous enough. And from that day onwards, he has been one of the biggest mentor as far we understand technology, but building a business is a totally different ballgame. And he has been helping us. He is the chairman.
Yes.
Yeah.
But, how difficult was it? I mean, you and your co-founders clearly had a vision of what you wanted to do. But how difficult was it to get the team together, to get people to buy into your idea of building an robotics company in India for the world?
Okay, so first set of people were those people who knew us, who worked for us, or who worked with us in Asian Paints. Initially, we decided we will not take people from Asian Paints. So these were
Four
people,
was enough.
Yeah. These were people who had left Asian Paints and joined some other company. Okay. So we reached out to them, and they trusted us, and they came to us at a much lower salary than they were getting to a job which was almost not secure because the company would have closed any time. But
they believed in your vision.
They believed that we can do it in India, and we can do it for the world.
What was the vision statement that you started with?
So at that time, as I said, adding intelligence to action, but we said we will automate warehouses. We could have automated anything, factories, process industry, etc., because we had that experience, but we targeted warehouses that was coming up because of e-commerce and retail, which was changing during that time, and we targeted those.
So that was the starting point. Now explain to me, because there's so much attention and so much focus on what is going to happen with AI as far as the workplace is concerned. What will robotics do? Will they replace human beings? How quickly will they replace human beings? Now you've gotten into the humanoid space. We've got one of your humanoids right behind us. Of course, still far from commercial deployment, right? How long will it take for you to be able to deploy this commercially?
We launched it 2 days back at Mumbai, and we will start taking trials with 4 or 5 customers and doing their job, all the dexterous work which humans
So what can this wheeled robot of yours do?
So wheeled robot, it can assemble It can do hazardous work like changing the catalyst. It can be used in nuclear power plant, and it can move around, and whatever humans can do with less dexterity, of course, these robots can do the repetitive tasks, the dangerous tasks, the dull tasks, and which is what robots of other form has been doing. But these are robots which will be of human form factor, and therefore, because factories and warehouses have been built for humans to work, so these robots will be much more effective. And that is why there is so much of excitement about this technology.
There's excitement and fear as well. So let's address both those issues. What should we be most excited about in terms of what impact these humanoids, the advanced robots, can actually do as far as the workplace is concerned? What do you see as the use cases 12, 18 months down the line?
So humanoids, and why there is so much of excitement is robots earlier were designed for a specific task. And that task, they used to do it efficiently and with a lot of accuracy and lot of speed, etc. But today's robot is not designed for one activity. It is a generalist robot. So today it is doing one thing, but the same robot can go to some other place at the shop floor and do something else.
So the software and intelligence has added versatility.
Yes. And this robot, today it is trained on certain amount of data and it will be able to do something. But tomorrow, even if it is a totally new work, it will figure out based on what it has learned in the past and then reason out how to do that work.
So it can reason.
Yes.
And that's the big difference.
That is the big difference. So like human beings, when you are doing it for the first time, even if you have not done it, you break it into subtasks and then you figure out which subtask has to be done first, so that by the end of all these subtasks, you achieve the goal what you want to do. Similarly, the robots will do it. And in the process, one of the things which gave huge advantage to human being was if it failed, it tried to do it in some other way, which was recovering. And
you're saying robots can recover?
Robots can recover from the failure while doing a certain task.
As of today?
As of today, for certain tasks. But it is a long journey. I would say another 5 years or 10 years to become 90% of what humans can do. But it is an important thing. It is in the right direction and it will happen. That is what...
It will happen still maybe 5-10 years on, unless we see a big acceleration or some big breakthrough. But you know, we've got a bunch of these things walking around over here. Explain to us now, what are these being used for? Where are they being deployed? Who your clients are that are using some of these robots that are already in play?
So these are
Who is this guy?
These are quadruped. This is Tracker, which is a 5 kg payload robot. And so it came from MIT Cheetah or MIT Lab. And then different companies started making it, some in China, some in Europe, some in US, mostly for industrial surveillance. For inspection in hazardous areas. And then lately it is also getting used in defense application where they find out landmines. Yes. And or maybe carry load from one place to another, digital mule kind of thing. But apart from these robots, the robots which we make, the mobile robots or collaborative robot, which is 6-axis robot, it gets used in e-commerce in a big way, hundreds and 200s of them in one place, and then you have at several places, in consumer goods, in new energy, which is battery and solar and electronics. So these are the places where we sell most of our robots.
What kind of regulations do you have to put in place to ensure that there is also a safety net for human beings?
Yes.
I mean, you don't have to pay this guy overtime. You don't have to give them weekends off or any of that. And I think that's where the concern stems from, that when Elon Musk talks about the age of abundance, how do human beings benefit from this so-called age of abundance?
See, there are two things. One is, some of the activities which we do as human beings is something which we do because we don't have any machine for that.
Correct.
Our body was not designed for it. And I'll give you an example. At Asian Paints, our people used to lift buckets from the packing line and put it on a pallet. And it used to create, it was for 8 hours, if you continue lifting something 30 kg and putting it on a pallet, it does create problem, sometimes health problem, etc. So we decided that we will replace it by robots. Now, and after we replaced it by robots, every time people used to say, you are replacing human beings and you are not doing good and you are...
Well, you actually made the life of the worker better.
Much better in terms of, in fact, Jeff Bezos keeps on talking about MSD, which is muscular skeletal disorder, all the disorders which we get because we do repetitive tasks. And for that, now these robots, because they are flexible enough, they will be able to do these tasks. Yes, some jobs will get lost, and with any technology, that is what happens. So just to continue with the Asian Paints example, when we put this robot, there were 3 people who lost their job because not lost the job, they were deployed somewhere else, but these 3 people, the job went to a robot. But then we created job for a technician who had to take care of the robot, do the maintenance of these robots. We created job for a robo-operator. And at the vendor's end, in the whole ecosystem, it was at our end, at the vendor's end, we created job for a person who could, an expert whom we can talk to. And these jobs were much more highly paid than the job of doing or transferring the. So eventually in the ecosystem, more job gets created. And that is what we are seeing everywhere.
Going back to the Musk hypotheses on what this is actually going to do in terms of cost of manufacturing, what are you seeing today in terms of cost of manufacturing on account of the deployment of AI, of robots, etc.? And what could we be talking about 5-10 years on?
So, so 2 things changes with deployment of these robots. One, the ability of the customer to deliver products at speed, and at scale. And second, the cost definitely reduces because you remove all the non-value added work, and those non-value added work, sometimes it goes out of the system because you are rethinking the process once again with these robots, etc., or these gets done by robot, and per piece work reduces. So to the tune, we have seen many customers gaining to the tune of 15%, 20% as far as cost of manufacturing or cost of delivery is concerned.
And that's not because of a manpower cost reduction?
No, never it is because of the manpower cost reduction. It is, sometimes it is because of the capex which they deploy. So let us say if it is a completely manual system, you need 100,000 square meter. And for that, you need to have land, you need to have the construction going, etc. Same thing with automation. You can do it in 20,000 square meters. Okay. So maybe 5 times reduction
so the
in the area.
economics changes completely.
Completely.
Let's talk about your economics now. We're sitting here in your facility in Noida. This is one of the facilities that you have. You have about 900 people that are working with you at AdWorb. And it's been a very rapid expansion for you, all in a matter of 10 years. And this facility came up, about 6 years ago, right?
6 years back,
so,
yes.
And now you're servicing not just the Indian market, but you're servicing the world as well. What is the plan from here on?
Yeah, so today 60% of our revenue comes from, or used to come from, overseas market. There is, last year was a thing because of American thing, but
yes, because of the US tariffs,
yeah,
and
US
that
tariff,
impacted your business.
Yeah, but otherwise, going forward, 50% revenue will continue to come from India and 50% from overseas market.
Okay.
Today we have 900 people in India and around 150 people in overseas market. So we have 100% subsidiary in US, in Europe, in Australia and in Singapore, and we cover almost 25 countries from these 100% subsidiaries. And we export robots. So everything gets manufactured in one of our facility, which is world's largest facility, Botverse.
It's the world's largest facility for robots.
For mobile robots.
For mobile robots. Okay,
yes,
and that's
yes.
right here in Noida.
Right
What's
here.
the capacity? How many do you turn out?
Yeah, we can do 100,000 robots a year.
100,000 robots a year.
100,000 robots a year. We are not using the capacity yet.
How many are you currently doing?
10,000 plus robots a year, and all different kinds of robots.
Okay. So, in terms of competition, especially as far as the global markets are concerned, you're up against the Europeans, you're up against the Japanese, you're up against now the Americans as well. What is the key differentiator for you as you compete in the global market?
And Chinese.
And the Chinese, yes, of course. How can I forget?
Yeah. And with different companies, it is different. One of the biggest differentiator for us is the range of robots. There is no company in the world today which can say they have all these form factors of robot.
Okay.
And we have 22 families of robot today, and each of these families would have 5-6 versions, etc. We have Zippy, we have Dynamo, Tracker, Humanoid, and all different kinds of robots.
So 22 children.
22. Yes. And so, and that enables us to use it as a Lego and solve problem for our customers. So we never sell a product per se, we solve or we give a solution to their problem. So and that is what differentiates us today in this robotics automation market.
What is the current order book looking like for you? And, what do you expect in terms of adoption as you see the pace picking up? What could it potentially look like a couple of years on?
So India, if you see, it is still, all the factories and warehouses put together, we are less than 1% as far as automation is
Still less than 1%?
Yes, less than 1%. Our factories and warehouses. The large factories, of course, they are automated. The newer factories, the newer industry, let us say new energy, solar, battery, anyone who is putting it, it is automated, whether Reliance, Adani or Wari or any company. Similarly, electronics, whether it is industrial electronics or consumer electronics, mobile factories, these are automated and these are world class. But the traditional industries and the older factories of even these large companies are not that automated. The MSMEs, they have not tested the benefit of automation at all at this point of time. And these would be really, really large consumer base once they start using it. We have an order book of 1,400 crores for next year. This year we will do 800 crores.
Let's also talk about the fact that Reliance has made a very big bet on you. How did that come about?
So we were in 2018, from 2018, we started in 2016 and 2018, Reliance started investing in their e-commerce platform. And that is when they needed warehouses which are fully automated. And they called 25 companies, globally 25 companies came. And we were lucky, we were small, but somehow we found that place in that room. And
what made them pick you out of the 25?
Yes, because of the speed, which we promised. So all the, as I was telling, there were a lot of European companies and they said 18 months and 20 months, and Reliance does not wait for 18 months and 20 months for things to happen. So they asked us whether you can do it in 6 months. We didn't know.
You just said yes.
We said yes.
But now funding requirements, additional funds needed, and possibly the road to an IPO. I mean, everyone's talking about when will India have its own AI story as far as the stock markets are concerned. Is that something that you're working towards?
So, yes, we need fund, and right now all the funds we are getting from Reliance itself, and but we need massive funds if we have to compete with
what are we talking about? What's the ballpark? When you say massive, how massive is massive?
Okay, in the short run, at least $100 million or $150 million kind of thing. But it will happen, and we are on the right track as far as that is concerned. As far as IPO is concerned, we are very convinced that we have to be of certain scale. And we have to be profitable in all fronts, and then only we go to the public market. So.
And by when do you expect to be profitable, given the visibility that you have?
We are EBITDA positive, but yes, it will take another 2 years for us to be net positive. Maybe next year, but...
Maybe next year. Well, 10 years of adverb. What will the next 10 years look like?
Next 10 years, we have this dream of becoming one of the top 5 players in the world as far as robotics is concerned. Today, we are delivering at 25 countries. We want to be Toyota of the robotics, where we deliver it to 180 countries in the world.
Well, that's a big dream. It's a big task, and it's a big ambition to be the Toyota of the robotics world. From India, servicing the world, hopefully at some stage 180 countries, as you point out. It's been an absolute pleasure, Sangeet. Thanks so much for joining us here on Young Turks Reloaded, for giving us an insider's perspective on what it takes to build tools that will help the world automate faster, but more importantly, how India can play a strategic role in this journey going forward. Thanks very much for your time, and we wish you the very best of luck.
Thank you for having me.
Well, with that, it is time for us and from all of us here to say goodbye to you on this episode of Young Turks Reloaded. Do send us your feedback and your comments. We always like to hear from you. For now, from the team, goodbye and many thanks for watching. This guy.
These are quadruped. This is Tracker, which is a 5 kg payload robot, mostly for industrial surveillance.
This very comfortable job that you had at Asian Paints and decided to get into the world of artificial intelligence and robotics. Why?
There was this new field of robotics which was coming in, the mobile robotic field. We felt that there was not a single software enabling these technologies. So we thought, okay, if